Street meets Wall Street fashion. I've distilled the structural lessons from every major economic collapse since 1907, from the panic of 1907 to the dot-com era, and layered them over a 33-minute raw breakdown at the current SAS off. That's at the end. We're going to start off with a conversation with Adam Parker from earlier this year. Full conversation people have been asking for part ones and part two. See how this actually plays into the more economy. A lot of things that he said have come true or come to fruition, and approaches to your market and your portfolio. This one's full of value. Can't wait to get back to it. Thanks for joining. Hop in. Here we go. Main Street, when you hear the noise and the news that's happening, it can be as confusing as that great scene from My Cousin Vinny. Welcome to Main Street Meets Wall Street, a podcast that helping Main Street meet Wall Street with financial information, financial literacy. Honored to have Adam Parker on here today, coming to you from Wall Street South down here in Charlotte. Today, we're just going to jump in, let Adam talk about a little bit about all the information just came in today. A lot of stuff just happened right before we hopped on. We even just got off a call with a journalist from the Charlotte Business Journal talking about SCOTUS and tariffs. We'll let Adam tell you a little bit about how his industry and his firm can't be disrupted by AI, how it's actually a tool. And then Adam would tell you a little bit about himself. He's a Tar Heel, so I'm glad you didn't say you went to Duke because we probably couldn't have done this call. So without any further ado, here goes Wall Street. Here's Adam.
Hey, Marcus, thanks for having me. And for those listening, we do have a financial insights newsletter we publish. It's called Trivector Research, TRIVECTOR, like magnitude and direction vector. And you can just go on. We do monthly Zoom so people can ask questions. We do ETF analysis. We give people, advice about staying fully invested in the equity market or other kind of big picture items, sectors that we like, industries we like, et cetera. So let's sign up at our website. And if you say, Marcus, you get 1 month for free. So that's no problem. So yeah, trivectorresearch.com, check it out. So I guess you want to talk about my background, or what do you want to do, Marcus?
How about you talk about, you said you just had meetings this morning. What is institutional money talking about right now, right? What's Wall Street talking about versus Main Street?
Our other business, Trivariate is our core business. We sell research, insights, events, bespoke services to institutional investors, asset managers, hedge funds. And I was just mentioning to Marcus, nobody's really asked me about the tariffs today, despite today being the day of the, kind of a Supreme Court decision. I think it's kind of in the price. I don't think people expected, much that's different. So the market's rallying a little bit, kind of viewing this as maybe there's some costs that can go away for businesses. Maybe there's not, but I don't think people view this as a very big incremental. Most of the things that people are talking about in the meetings are around when will we see more proof cases for AI productivity. I think the expectations for earnings are more than 15% for the S&P 500 this year, 15% earnings growth. And so I think people are saying, well, wait a minute, that's embedding some AI productivity and cost cutting from the companies. Are we going to see that in the next couple of quarters, or are the estimates too high? Definitely that's one area. Two is software. Anyone who's owned software stocks in the last few months has seen some pain. So people are trying to figure out, are we near a bottom? Ideas, which ones do I buy? I think semiconductors always come up in the meetings. I used to be a semiconductor analyst, so I think maybe the questions I get over-indexed toward that sector. But for sure, the S&P is probably 60% an AI ETF at this point. So a lot of it comes down to the semi cycle. And so people are trying to figure out when maybe the memory trade ends. So SanDisk, Western Dig, Micron, et cetera, and maybe when they should be rotating into other stuff. So those are more the questions I think right now, as opposed to, policy at the presidential or Supreme Court level.
Gotcha. Yeah, I think, like you said, the market pretty much priced in these tariffs or the decision from the Supreme Court. In your research, and I know with all this being priced in already, have you already accommodated for the tariffs? I know we have 15% earnings growth projected this year. This earnings season was actually pretty strong, and the markets didn't respond as you would expect them to with all the micro and macro data that came out.
Yeah, Marcus, to get the stock market view, there's two things. There's the price to earnings, so that multiple you're paying, and there's the underlying earnings itself. And I think coming in this year, our view has been it's going to be not that likely that the multiple or the price to earnings expands. I think the earnings are growing. I don't think they're going to grow 15%. We think 10% is a better, safer number. But if the earnings grow 10, you would say normally the stock market would go up. And I think it could go up. We're kind of thinking flat to up 10 makes more sense than the double-digit returns we've seen the previous 3 years, just because I don't think that price to earnings is likely to expand. One, the Fed, at this point in the Fed cycle, you're going to get less boost from them cutting. And eventually, if they cut a lot, it's because things slowed a lot, not just, oh, great, there's a combination. And then two, I think people are probably maybe underestimating that whether margins can go up for companies, because margins are affected. Sure, they're helped if tariffs come off, but they really matter more on pricing. If you could sell something at a higher price and not lose any units, that's great for your margins. But I think it's getting increasingly hard for you. There's lots of anecdotes I could give people from companies, but my favorite current example is Doritos and Lay's are going to be 15% cheaper. Okay. I don't know many of us have gotten to the impulse purchase and been like, ooh, I'm not going to buy this but it finally got to the point where they took pricing to the point where it started hurting demand. So I think pricing is going to be an issue. I don't think the average company is going to see gross margin expansion. I don't think the Fed's going to be as helpful for that price to earnings ratio. So when I multiply the earnings side and the price to earnings, I come out a shade more cautious on the equity view than the consensus, which I think is just super bullish. And I'm a little bit more worried about the consensus.
Got you. And the way you broke it down when you mentioned, first of all, with the chips, they might get cheaper, but is the bag going to get smaller? Or are they taking a few chips out of their shrinkflation,
Shrinkflation, yeah, exactly.
But and then also shrinkflation, talking about all this free cash flow that is being affected by the capital expenditures being used by these hyperscalers now, right? Not even so much in the software as we've seen software flush out, and they've started to make these announcements, but we've seen, like, you do semi, so we've seen NVIDIA be range bound for the last, since November. It hasn't really done anything. It's gone up, it's gone down. It can't really go through 200, it seems like. Like, that's where it seems to get stuck. And I haven't looked at the market today, since right before we got on, but I don't know where it's at. But in that sense, how do you see these companies growing out of this if you're seeing margin expansion?
Yeah, I mean, look, the market, there's AI revenue beneficiaries, right? And NVIDIA, obviously, having been a monster stock from 2023 through late last year, was a primary revenue beneficiary. But I think the market's transitioning a little bit to who could the productivity beneficiaries be? So who can drive out costs by predicting their employee behavior, their customer behavior, maybe growing the revenue without new hires or net hires, and then margins can go up. And we've seen that from stocks like Walmart and Costco, where they're low margin businesses, but if people think the margins are going higher, they trade at very high price to earnings ratios, 35, 40 times earnings. So people are sort of transitioning away from the revenue beneficiaries, thinking that's more in the price and trying to find inefficient businesses where maybe their margins can go up. NVIDIA could still be a fine stock because it grows, but I don't think you're playing NVIDIA for multiple expansion and the growth. You're saying maybe the multiple continues to slightly erode, the earnings grow, and it can go up at a market rate. If the market goes up, 8% a year for the next few years, sure, NVIDIA could go up that much too. But I don't think people think there's as much upside because it's hard to sketch out their enterprise value to sales goes up a lot.
Yeah, law of large numbers when you get to those type of things. But even
it could be, but I think it's also just that they're probably over earning a little bit. And so, the space earns competitive and you're not going to pay a higher multiple because you're just worried that eventually they'll lose share on their high margin product. So I'm not negative on NVIDIA, but I think you have to find companies that can benefit and drive costs up because stocks go up when their margins go up.
Right. So a company like Intel or TSM, like Intel actually had a crazy year last year. People didn't really speak about it. Like, it went way up, but obviously it had privatization from the government, different things. They want Intel to succeed. Like, it's good for American business. I'm doing air quotes for those listening. But inside of that, so you see a shift back to the older companies, probably stocks you were covering before, like Cisco, Intel, but TSM, everything's built on these stocks. And then you mentioned Costco's and Walmart's. People, all this seems like the shift to the old stuff is a cyclical shift back to value, because these stocks are value stocks inside of these high growth IBM companies like that. So inside of all of this, how have you seen, because there are people, like you said, you're a chip analyst. There are people who are only going to invest in chips, and they can't invest in NVIDIA right now per se because they don't want to see 8% growth. Where are you seeing the shift inside of chips?
Yeah, I mean, so it depends how nuanced you want to get, but the semiconductor industry has lots of different business models. There are companies that make very inexpensive chips that go in every industrial application in autos, in
Texas Instruments.
doors, Texas Instruments, microchip, analog devices, etc. Those businesses had really underperformed for a long time because they had very high inventory after the COVID, and you started to see them act really much better over the last few months as they kind of predicted a slightly better industrial environment as they cleared out some inventory. Those businesses are different because if they overbuild, the pricing on the inventory doesn't go down. So just to make sure everyone understands, if I sell a $2 converter, maybe I sell $22 converters into the cockpit of a Caterpillar dump truck. It's a $100,000 dump truck. Actually, it's probably more, $200,000 dump truck. Me cutting my price from $2 to $1.90 for each of my 20 converters is not going to stimulate anybody to buy the dump truck. So if the economy slows and there's no dump trucks being bought, I just take my extra converters, I stick them in a warehouse, and eventually when Cat reorders more dump trucks, I just can still sell them for the same $2 that I had produced them at. So that business doesn't see huge fluctuations in their gross margins. They don't see huge pricing degradation because the value out of the product is high and the percentage of the bill of materials of what it goes in is low. On the flip side, memory, which is a completely different business, solid state stuff like Seagate and Western Dig, or classic like DRAM like Micron makes, these stocks have gone parabolic. They were all among the best stocks in the S&P last year and again this year because there's a shortage. But when they overproduce, their pricing will get decimated and it will go down 90% more because when they overbuild, in order to clear out the inventory, you have to massively cut pricing. And their product is a big percentage of the bill of materials. So what do I mean by that? Let's say it's a $1,000 Dell desktop that's got $200 worth of memory in it. If memory prices go to $300, Dell can't afford to not raise pricing from $1,000 to $1,100 for the box. They have to capture some margin. And so that higher price actually cuts demand. It hurts demand for the PC, right? Because it becomes too expensive. So memory isn't anywhere even in the same category of business as, say, what the analog businesses do. And then there's the companies that make the processors, NVIDIA, Broadcom, Intel, AMD. And then there's those that make the equipment that produce the semiconductors. So Applied Materials or AMAT, KLA, KLAC is a ticker, Lam Research, Testers, Teradyne, et cetera. So they probably, memory is one of their customers. And so if memory rolls over, their stocks could be hurt, but they actually are a lot cheaper in absolute terms and are over-earning a little bit less. So I think you have to kind of parse the industry in a bunch of different buckets. Marcus, I probably answered too long-winded of a question, but to me, I think you have to be careful. And I think the more memory goes up, the more you should want to sell it, not chase it, because they are over-earning and the stocks definitely will see a huge correction at some point in the next 12, 18 months.
Perfect. No, you definitely did not go too long in that answer.
Totally.
You can speak longer if you like on that. No, it's a good explanation because I don't think people realize, like you said, you can have one component inside of a $200,000 item that's only $2 goes down to $190, even if it went down to like $150, right? And they can just put that inside of their.
It's irrelevant. Yeah.
They can put that on the warehouse. So with that side, it's more about the orders, right? The demand, like what is like when
exactly.
you see
Industrial economy,
what are the orders, right? But with memory, it's more about the availability. Is that right? Would that be a good analog with that?
Right. Yeah, it's a shortage. It's a shortage that, and so that when they finally get demand growth slowing relative to supply growth, then the stocks get killed. So I think the problem with these things like Micron is, it maybe have 50% upside, but they also have 50 or 70% downside. And so when you look at like risk reward and up to downside ratio, stuff that's got 50% upside and 50% downside is a little less attractive than something that's got a lot more upside than downside. So I think you got to be more careful with the really cyclical parts of the semiconductor industry.
Gotcha. It's a great explanation, man. Great explanation. I want to transition a little bit into, so we've seen this rolling, I would call it a rolling recession, like inside of sectors as things come in and disrupt different industries. We have people, you had to come in with the fintechs, with Altruist. I use Altruist as a custodian, full disclosure. So shout out to Altruist and Jason Wheat. Look, they're great people. Hazel, that disrupted the industry. We had, what do we have? A karaoke machine disrupt trucking last week. Like people are just trying to pick what's next inside this industry, what's going to be disrupted next. Somewhere in that industry, research has to come in, right? How does your business not get disrupted by AI?
Oh, what we personally do at Trivariate?
Yeah.
Well, it could. I mean, look, I think it's healthy to have some paranoia. And I will go as far to say is if you're not worried about being disrupted at all, you're probably a psycho. I mean, you should have some doubts about what you do to motivate you. I guess I'm 56 years old. I've been doing this for a long time. So if I get disrupted, I'll probably just, learn how to play pickleball or something. I mean, but I think if you're younger, you have skills that are differentiated, and make sure that all the guys who work for me on the research side are, expert Python programmers. They're really well versed in natural language processing. We're trying to, the reason our institutional business is called Trivariate, and our retail business that I mentioned is called Trivector. But the reason it's called Trivariate is three variables: macro, quant, and fundamental, applied to U.S. equity. So what I try to capitalize on the fact is that I have a PhD in statistics, which I think is a somewhat differentiated skill. And I was a number one IA ranked semiconductor analyst for many years. So I had a lot of experience as a fundamental stock picker, and I worked at a well-known hedge fund that is a bottom-up stock picking firm. And, then I was a U.S. equity strategist at Morgan Stanley's most read research product at the number one equity business in the world. So that was kind of the side. I sat on a 7-person asset allocation committee for the 17,000 financial advisor network. At that time, it was only $2 trillion US dollars under management. It's bigger now because they bought E-Trade and other stuff. So I have experience doing kind of quant, fundamental, and macro. And so I think part of what I'm trying to do is puff a few less puffs on that cigarette of my career by combining those three things. But, I still think you have to worry about it. And I think for me, the advantage is just we have tons of institutional relationships. And it's funny, somebody the other day asked me, what do you do for a living? And I said, I sell research on the U.S. stock market. And they laughed at me. They thought it's just so impossible that a normal human being could do that. But they didn't know anything about the fact that I just spent my whole career doing that. I think in terms of the AI implementation stuff, though, Marcus, like taking your question more seriously is, look, we spent a lot of time doing that. I published a research note for my institutional investors this week where we took every word I've ever written and said, put it in Claude and said, is there any kind of sentiment that's coming from my words that actually has predictive value? We found actually there was kind of a 1 week predictive value. When we said more negative things about the market, on average, the market did worse the next week than we said more positive things. So I think that's because we're reflecting the questions we get from our institutional investors. We do whatever it is, 16 institutional investor meetings a week or whatever the average is over the year. It's hundreds of meetings. And so at the end of the day, I think at some level, we're reflecting the good questions we get from investors and trying to react to new information and new news to figure out where our mind's changing. The older I get, the more I realize that I have to unlearn things, or things have changed, or I have views now that I used to not have. Like, for example, I don't think valuation works to pick stocks. We can get back to that. But I think you have to always evolve your thinking. And if you're not at least somewhat open to that, then maybe you're more vulnerable to being made obsolete.
Perfect. So it sounds like you, for one, well, maybe you sound like you're on the back 50, as my stepdad likes to say. You're on the back side of 50. But two,
56. I'm going to get close to 60.
Hey, that's 60 is the new 20. Look at Bill Belichick. I probably shouldn't have said that. But you're embracing AI, right? Like, that's what you're saying. Like, you're embracing AI. You have guys.
We bought an NVIDIA chip 3 years ago, put it out on EQAX, the public data center read. We have a very quantitative firm in terms of how we do process. Every day for the biggest 3,000 U.S. equities, we download or compute hundreds of pieces of information, and then we use that to empirically test outcomes. And that's part of where the research on the institutional side started. The reason we started Trivector Research is because, I felt like we needed to make more, help advisors and individuals more. I'm a CNBC contributor. I'm on once a week. People come up to me all the time. Hey, how can I access your stuff? And so the problem with the Trivariate institutional business is we sell it for hundreds of thousands of dollars a year. So no normal person is going to buy it. So we started Trivector because for $100 a month, we can give them more practical advice. Why they should save, fully invest in the equity market. How do they think about, the cost averaging new investments? What they're actually getting when they buy certain ETFs, because they don't actually always give them the exposures they think.
IGV.
That kind of stuff. Yeah, comparing ETFs, that kind of stuff. So I think that business is kind of born out of just capitalizing the database we have. It took us 9 months to build a database. It's the 4th time I've done this in my career. We spent several $100,000 a year on data for the database. And then we're using a lot of technology to kind of quickly process information. So I'm hoping there's some harder to crack edge by all that investment. But your question's right. People should worry about that. And we're very open to embracing technology for sure.
Excellent. And so as we continue the journey and we're talking about AI, so you mentioned that it took you 9 months to build up your database, and you mentioned that
years ago,
you analyzed, and that was a couple years ago. So compared to then, like when you had to do some research back then, like you were writing a weekly newsletter or putting out weekly research, how long would it take you to do that then compared to with AI now? how long does it take you now? Like, how much does AI increase your productivity? How do
Well,
you actually use it?
I mean, I just maybe a fair thing is like when I was a U.S. equity strategist at Morgan Stanley, I had 9 senior people in New York and 4 people in India on the team, and now we have 4 people spread around the U.S. on the team, and we produce way more today than I did when I worked at Morgan Stanley. We can process information more rapidly and assess more. I think the challenge for me, actually, Marcus, is that it's one of my 27 weaknesses is I always say yes when one of my friends or clients says, can my niece, nephew, kid work for you as an intern? And the problem is no intern can add any value anymore because all these kind of Gemini and ChatGPT and Claude are like having a million interns. So it's hard to come up with projects where a young kid can add value. And I used to be able to, give them projects. Hey, tell me what all the acquisitions and divestitures Microsoft's made in the last 10 years and what technologies they're buying or investing. And they would go away for 2 weeks. But now they come back in like 15 minutes, right? Because ChatGPT is pretty good at that stuff. So we're constantly trying to figure out what we can use interns for. And that process leads me to a lot of it's in the natural language processing work and trying to figure out like where there's errors or where there isn't. We search every earnings call transcript and we really look for information there. And it could be anything related to AI or cost cutting related to AI. And then once we cluster the stocks, we then say, are they even seeing better revisions, higher multiples, outperforming? Are there any like tangible evidence of AI implementation? Because we spend a lot of time on like who's going to be disrupted by AI, who's impregnable to AI, who's a beneficiary on the cost side, because stocks that are getting more expensive are really just stocks that are more likely to benefit from AI or be impregnable. And stocks that are getting cheaper are really just stocks that are more likely to be disrupted. And so if I use mean reverting valuation to buy stocks, I'm just buying companies that have a higher probability of losing and selling stocks that have a probability of winning. And that I don't like that idea. So we use AI a ton all day, and it's massively increased productivity. One way that the normal people listening wouldn't appreciate is data ingestion. So if you buy data, it can come in all kinds of weird forms and columns and semicolons and all over the place, unstructured. It could be videos or it could be photos or whatever. And it used to be you would spend a lot of time formatting the data before you could even read it in and analyze if there's any information in it. And the AI tools are really awesome at data extraction and ingestion and save tons of time on that. I'm sure some of you've used that. I don't know if you've even used that in a very basic way in your personal life, but like, have you ever tried to email 25 people at once and there's like semicolons in between them all? Just you tell it to get rid of whatever stuff like that, but multiplied by 1,000 or 1,000,000 for big data sets. It's really efficient on that kind of stuff.
Excellent. Yeah, that's very cool. And I want to ask you another question as far as how is this disrupting with like interns? Like I know you said with interns, those are free jobs. So like people coming in from the industry, entry level. Like I would imagine if you're coming into the industry now and they're training kids in AI, people have AI courses in college. So you can come in with like an AI degree, or you can come in and really train in AI. So you don't need an entry level job. Is that affecting like how you're hiring people? And then I want you to go into like for Main Street, like the breakdown between like what the actual analysis is, technical versus fundamental.
Yeah, sure. So on the I'll do that first part first, and then maybe ask me the second part, so I don't get too sidetracked. But you were
Okay.
saying like the hiring stuff. Like, look,
Mhm.
I mean, I took an AI for healthcare course at MIT in the summer of 24. I was really interested in applications for healthcare. I learned a ton, but honestly, we're headed to an era where everybody's going to be a programmer, right? Where you'll be able to just tell your box, hey, I'd like to see this. Can you write the code that does this? And it will probably be able to do that. We're probably 3 years away from that.
3 years.
Well, I mean, for people who don't know anything about coding, it's already open source and really efficient on writing new code. And our team like is really good at that. But like, look, to me, um, the way the people that we hire, I mean, I have a small firm, right? So what can we offer? Content, they have to like doing analysis on the stock market. People, they have to like the people they're working with and for and interacting with. Autonomy, so the ability to think about what they want, when they want, or maybe control their own schedule. Um, and then some area under the curve to make money. And then the last thing people care about is brand. So like, we don't have that, right? So if you're somebody who's like, I got to work at Blackstone, I got to work at KK, I got to work at Morgan Stanley, then what do we offer versus them? We could probably pay more. We could probably, they get to interact with more senior people than they would if they work there. And they have a little bit more control over their life, meaning, at the big firms, you say, my brother's getting married in a month. Can I have off on Saturday? And they say no, right? So like, there's a little bit more schedule, but what we don't have is brand or whatever. So like, we sink into the fact that you're going to interact with senior people more, you're going to learn more, you're going to see more clients, and that we can pay just as well or more. And so I think that's usually enough for people. But people want brand, or they want a big kind of class of people that they can interact with. Then that's not what we can offer. So it starts with the human stuff, Marcus, on the hiring front for us. And then the AI skills, like I find, I'll tell you a funny story. When I was at Morgan Stanley, I had this incredible woman who worked for me with the greatest resume I've ever seen. Okay. I mean, this woman went to, went to Yale, was a Fulbright scholar, spoke fluent Mandarin, but she was Caucasian. She went to Yale Law School. I mean, this was incredible. And she left, and I was bummed. And so I told the HR team, I wanted someone who went to a not very good college and had not very good grades. And she said, what do you mean? I said, well, I want someone who's hungry like an animal. Okay. And the problem is we only hire people who went to the top universities and got great grades. And so they all want to, be senior when they're junior. Right. And I went to Michigan. I went to the University of Michigan undergrads. This is a joke. I don't want to offend anyone who's listening, but I said, I want someone who went to a bad school like Michigan State. That's a rivalry joke. It's like a UNC Duke joke or whatever.
Right.
Okay? But my point was like, we don't recruit at Michigan State, right? We only recruit at Wharton and Harvard and Chicago and Stanford, right? So like, give me someone who went to a totally fine university, but just not one of the best ones. Okay. And then I prefer someone who had bad grades. So he said, so what do you mean? I said, what I mean by that is I want someone who was like a track star or a musician, someone who was great at something, then like broke their ankle. And so they had like C's their first 2 years and A their last 2 years. So they show them the aptitude, but they present themselves as someone who had B's from Michigan State, like somebody we would never hire under any circumstance at Morgan Stanley. We don't hire people with B's at Michigan State. We hire people with A's at Wharton, right? But I wanted someone who was an animal, who was like, I'm going to come in and I'm going to work my ass off because I'm going to prove to you that I belong. And so to me, you asked me a question about hiring, like that's what I look for. I look for the person with a story, an aptitude, who's an animal. Okay.
Yeah.
And I don't want them to be, there's nothing wrong with someone with great grades from a great university, but I found the distribution of outcomes is skewed to the negative for me at my firm.
Yeah, so the pedigree is really important, right? Like, not important in the pedigree. What you want to have is the hunger and the chip on the shoulder. I'm sorry, not the pedigree. The chip on the shoulder.
I met a guy. It's funny you say that, Marcus. I met a guy. I also never told this story. And I do millions of podcasts. I've never told this story. I mentioned the phrase chip on a shoulder to a guy, and he pulled his shirt back and he had a tattoo of his chip on his shoulder.
Excellent. Did you hire him? Did you say come?
I made him an offer, but he turned me down.
Now you got a chip on your shoulder from that. That's pretty cool. Never heard before, Main Street. We let it out.
So then the second question you asked before was, I'm trying to remind me.
The second question was, so this is more for like Main Street literacy, financial literacy. How people say, you'll hear people mention technical analysis, fundamental analysis. First, explain which one you're doing, and then explain the difference between the two.
Yeah. So I think for technical analysis is, people say, well, I look at the chart, right? They try to figure out either momentum, things that are going up, continue to go up, things that are going down, continue to go down, or mean reversion. They think it's going down, it's going to go back up, or it's gone up and they think it's going to go back down. And so it's all looking at charts and recent price action. It's price action only. Fundamental analysis is much more digging into what a company does, how fast can it grow, what products do they sell, what pricing do they sell it at, to their peers, what are their margins, what are they doing, are they good stewards of capital when they make money, what do they do with it, do they do a dividend, do they buy back stock, do they buy other companies? So fundamental is much more kind of an assessment of the business, its strategy, are they implementing it, and technicals is much more just literally looking at the stock price and guessing on whether or trying to predict whether the trends on the price will continue or not. Ultimately, in some cases, they end up correlating. A business that's doing well and gaining share and growing fast and expanding its margins tends to have a stock that goes up, and the technical guy picks up on that and buys it because the chart looks good. Or so they're not completely unrelated in terms of how maybe stock behavior is ultimately, but in terms of how people come at analyzing things, they can be completely different. I mean, technicians might not care at all about when the company reports earnings, or that, if they're good stewards of capital, the stock went up and they want to buy it because the chart tells them it looks good. That might be all they care about. And they typically would have a shorter investment horizon. A technician, they probably would buy something for a few weeks or days, whereas usually a fundamental person is saying, I think this is going to be a good business and I can hold it for 6, 12, 18, 24, or 36 months.
Got you. So it sounds more like a technical trader, a technical investor is more trading tendencies. But you were mentioning when you were speaking about fundamental, right. Yeah, when you were mentioning analysis, your fundamental analysis, you were describing bottoms up. It's also an approach from like top down, right? Where you look at the whole industry. Do y'all take the bottoms up, where you go from the company from the bottom and analyze it that way, or do you take a top down approach, top down?
So we try to do both. I mean, we don't have like price targets and earnings estimates for individual names, so it's not bottom up that way. But we look at every company, analytically. So it could be where the margins forecasted to expand, or where they forecast to expand more than their business model average. So we're always trying to like search ideas. I mean, what we kind of focus on in our core business, institutional business, is risk and risk management. Their equity portfolios. We do custom work there, idea generation. So the ideas are where we think stocks could be outperform or underperform, tech strategies. So we do a lot of work on tech, on technology companies, just because the S&P 500 is just so filled with tech stocks at this point. We do a lot on like management decision making, so analyzing the deals and buybacks and dividends and those kind of things. So the institutional crowd's very focused on that. I think for Trivector research, where your listeners hopefully go to the website, there it's going to be much more big picture things, like what do we think the S&P can do per year for the next 5 years, and why you should stay invested in the S&P, and what are the sectors and industries that we think have better estimate achievability or not. So it's more bigger picture things. Most institutional investors, they run big funds, and they're not like looking for advice about should they buy equities or not. It's kind of a different animal. So, but listen, for $100 a month, anyone can just go to Trivector Research and check it out.
Got that right. And we'll put the link in there. You said use Marcus, you get a month free. I don't know if that was
free.
free.
Yeah, that's right.
But yeah, we'll put it in there. We'll definitely share it with our listeners and viewers alike. Yeah, it's good stuff. Very good stuff. So now, folks, when you hear people speak of research and you hear people talk about those type of things, Adam is broken down for you. Adam, I want to transition a little bit more into more about you, man. We were talking earlier offline about, you said you did your post-grad down here in Wall Street, South Charlotte, but you did at Chapel Hill. So tell me a little bit about that and what you saw literally with financial literacy. That's one of the big reasons for this whole podcast.
Yeah, I guess the root of that is I did a master's degree in something called biostatistics, which, back then, I was in Chapel Hill from 1991 to 1993. Really the only places where there were a lot of data were basically the credit card industry and healthcare. And so in the time, a North Carolina-based company called SAS Institute was the software folks used to ingest and analyze data. And I was a statistics major in undergrad. And so I thought, well, this statistics applied to medicine, public health could be interesting. And so I got free tuition and a stipend to teach undergrad calculus and study in Chapel Hill, and ended up doing a PhD in statistics. But I never came back to UNC from when I was 24 years old till I was about 40. And I got a call when I was a U.S. equity strategist at Morgan Stanley from some fundraising guy in my early 40s at Morgan Stanley. And I thought, I wonder why they waited to call guys who graduated 20 years ago and live in New York City this long to ask me for money. Because normally in New York, you get asked way faster.
So I gave slower down here in the South, Adam.
I gave some money. I don't remember, but I gave a few bucks. And in my mind, it wasn't very much. And I thought, I'll probably never talk to this guy again, but good for him for hustling to call a young kid. See you later. But evidently the amount I gave for public health was a lot. For Wall Street, it was not. And so fast forward, I flew down, I started meeting some of the professors, whether they're in maternal and child health or environment or nutrition or health policy or health behavior or whatever. And I really found it uncorrelated to what I did for a living, interesting and rewarding. And so fast forward at blah, 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 I ended up, being the chair of the board of the Gilling School of Public Health at UNC. And it really gave me a window into a lot about public health. And then in particular, it's a global school, but in particular, obviously a lot of knowledge about North Carolina and it's a very interesting state. As I started to tell you, Marcus, you got very high churches per capita and a lot of people who rely on the church for information. You got a lot of people who don't have access to, fruits and vegetables and clean water and, good, maternal health advice, and then you also have like very rich people. So it's and then you got very different in the western part of the state is very different from the coastal part, both topographically and politically and, in every way. So it's a super, I think a great thing you're doing to try to get people's literacy up. I think generally the stock market's complicated and you're competing against incredibly smart people with lots of money and resources. And so you want to make sound decisions. And I'm a little worried about young people in particular who tend to put too much of their wealth in one particular, they don't have any wealth and they make huge aggressive bets into crypto or one stock and they end up with, kind of a view that it's that easy to do things. And honestly, I don't think that's a prudent way to accumulate wealth. We do on the trivector thing, we talk a lot about taxes and we talk a lot about fees and other things that I think can really eat at somebody's wealth over time. But for those listening who are just starting on their financial literacy, I would be consistent about it. I would try to put a little bit of money each month into some really low fee S&P long only fund. I would try to maybe trade a little with a small amount of money just to get used to it and then some low fee account. But I would not put all of your money into some fart coin or whatever and pray that it goes up. I think that's not a good way to establish, discipline in your career.
Man, that's great advice. Speaking of retail investors, you didn't particularly say this, but you said younger investors. You deal with institutional investors a lot. And I know that for a while, institutional investors just kind of laughed at retail investors. But if you look at like last year in particular, retail investors carried the market. Every time it went down, they went and bought the dip. And people just kept saying the retail investors are dumb money. How is that like the change inside the retail investor, the amount of money they've been putting into things? You saw a lot of it with like the Robinhood trader, quote unquote. Anyone not institutional, how's that influencing maybe even your research and how institutions are talking? Or they're starting to take notice?
Yeah, for sure. I mean, well, our clients include the large, private wealth networks, so the biggest ones that are almost like institutions, all of them are Trivariate clients. And then obviously individuals, advisors there could also be Trivector clients. But you're right. I mean, the retail money was steadier, certainly in the March and April lows from 2025 and the real acute fears on tariffs. But I think the way money is run now is different than history, right? Like so much more money is run high frequency. I mean, I'll give you some interesting data. I think something like 70% of all of options today are 0-day. And something like 70% of all 0-day options are retail investors. So
Say all those numbers again real quick.
So 70% of all options are 0-day. So they expire at the end of the day. And 70% of all 0-day options are retail. So 49%, 70 times 70 of all options are retail investors 0-day. So you got a bunch of people out there who are making options bets between now and the close. I don't think that's a great way to accumulate wealth. And I think it's highly risky, but it's just an example of why you see really volatile performance in and around earnings reports. And I think institutional investors that are used to lower turnover are, seeing and observing a lot of that. There's a lot more ETFs than there are stocks. There's a lot of levered ETFs. And so you can see big moves in stocks that are, in those ETFs, so whether it's Palantir, NVIDIA, Tesla, whatever. And I think the third thing that's probably underappreciated is just the way quantitative money is run. So most quantitative money is run where there'll be a lot of leverage. So what that means is, let's say I'm running $100 million in my quant fund. I might have access to running it at 10x, or if now I'm running $1 billion because I can borrow money from the prime brokerage firms and lever the bet. So now I might only be running 100 million, but really my balance sheet's $1 billion. And there might be 35 guys like me at one firm, and there might be 30 firms like mine.
1929.
Right, these guys run hundreds of stocks, long and short, with a very short investment horizon, 3 hours to 2, 3, 4 days. And so their impact on the market is massive because there's all these firms that are huge: Citadel, Balyasny, Millennium, Schoenfeld, LMR, Bullridge, Volition, and Cube, point 0.72, whatever. There's a million of these firms, and they all have 25 or 30 teams that are running money quantitatively, and they all have a 3-hour to 2-day investment horizon. And so sometimes they purposely don't play when the company reports earnings. They're only in when it's not earnings, price, liquidity, whatever. So the impact that this has in the market is also enormous. And so I think if you look at the quant money and the retail money with the 0-day options, like those are things that weren't the case 10, 15 years ago that are impacting a price discovery all the time. And by the way, these people are doing incredibly well and making money doing it. So it's not like, some of the smartest people in the world with the, best access to information that are doing that. So it's just a dynamic you have to deal with. And if you have a big asset pool, permanent capital, and you care about taxes and you care about fees, then you have to kind of say, all right, I'm going to see myself through that kind of volatility to accumulate wealth over the long term. It's a different mindset than trading with a 2-day horizon.
That's a good breakdown. Also, inside that same move, you mentioned how much liquidity, or not illiquidity, I guess, the margins that people have on this money, how highly levered it is. So when these moves happen, that kicks in the algorithms, and that can just, where you see these huge moves, you just probably as investors just sit still on those days. I know we're running up on our time here. I want to ask you, what are you seeing 2026 that you already kind of anticipated, and two, that has caught you completely off guard with the markets in regard to the beginning of the year?
Well, I think the stuff that's hard, Marcus, I mean, we do a pretty good job of trying to figure out who could benefit from AI, who could be disrupted. Um, but I think you have to take the tact of, like, if a company has high margin, then a CEO is going to try to predict their employee and customer behavior and not pay that firm. So I'm not shocked when I see S&P Global or Gartner or MSCI or FactSet or consulting companies or software companies suffer because people are trying to get rid of them and they know they pay a lot to them. The part that's harder is when the president comes down and says certain things that impact, whether it's credit card caps at 10%, you see the credit card stocks go down, or when you see the stuff on tariffs or rolling tariffs and the metals move up and down a lot, or when you see stuff on the GSEs, so Fannie and Freddie, it was mentioned that maybe they have to buy back some mortgage-backed securities or whatever. When you get introduce volatility that way, that's hard to predict. And like, I've done a lot of meetings recently where people saying, what industry could be next, or how do we get in front of housing? There was some comments about home builders and antitrust from the president a couple of weeks ago. Like, those things are really hard to predict because I think quantitatively we try to look at where estimate dispersion is narrow, where people have some confidence in the estimates, and some industries, that people had confidence in the estimates have gotten disrupted. So I think that part's harder. I think the AI stuff's hard, but not as hard. I think most institutional investors say, Taco, like the Trump always chickens out, right? So let's not overreact. If he does something that causes volatility, we can still stay the course. But I think with the AI stuff, I have the opposite view. If the multiples are coming down, it's probably because they have a higher probability of being disrupted. And so we'll let the price action inform us a little more if we think the volatility comes from something AI related than we think it comes from something policy related.
Got you. And on policy related versus AI related, you said you were meeting with your investors this morning, some of your clients. Anyone mention anything with Iran or the tensions in the Middle East right now because the geopolitical issues going on?
I think only from the standpoint of what it could do to the oil price. I mean, energy has been the best performing sector in the S&P this year. That certainly caught people off guard. We took the 15 largest firms' year-ahead outlooks and stuck them in at Gemini and ChatGPT at the end of December, the 2026 outlooks, and none of those people, none of these experts thought that energy or materials would be the best performing sectors in the market. So, one, I think it is prudent to do the opposite of the bulge bracket firm consensus in a lot of cases. And two, I think the energy move has caught people off guard. And I think that's how people look at the risk there. We've seen so much geopolitical risk in the last couple of years, and the wrong thing has been to sell U.S. equities as an aggregate thing because of it. And we could say, hey, I'm worried about stuff, but I mean, a few weeks ago, a missile got pretty close to Western Ukraine, like to Europe. To Eastern Europe, and the market was up that day, right? So I think people are in this sort of like, I don't want to, worrying about geopolitical risks is it wouldn't have helped me make money or choose securities that much in the last 10 years, and maybe it will in the future, but it hasn't in the past. And so I think that's mindset about it. I don't think there's panic selling about it at all. I think it's more, could it drive up an oil, a demand supply imbalance in oil, and what does that mean for input costs, or should I just own some more oil related securities? And that came up a couple times today already.
Gotcha. Exactly. And inside of that, with the geopolitical, we see where countries and the tariffs and things, just going back from last year, we've seen ex-USA, you mentioned that, outperform. These other countries are starting to invest in their own economies and make different trade deals and things that impact their government. They're starting to build their own defenses. So that's why you see when these missiles fly, those stocks go up, maybe perhaps part of the reason. But
Well, yeah, European defense, people like European defense stocks, and they've liked them. And then same with the U.S. I think some of it's kind of a government investment, and Trump's view that these countries should defend themselves a little bit better. And some of it's kind of where they are in the cycle. I'm on the board of joining the board of later this year of a public European company, and it's been interesting the perspective that Europeans have about the U.S. I think it's changed a little, and so I think it could cause some fragmentation in the U.S. market versus non-U.S. I mean, people think the dollar's going to weak. Certainly, they've been pushing at our events we do more non-U.S. equities over U.S. than any time I remember in the last 10, 15 years, whether it's European defense, as you mentioned, whether it's the European banks, which have actually been better than the big U.S. tech stocks in the last 5 years, whether it's Japan or new economy China or Brazil or whatever. So I'm hearing a lot more non-U.S. From people. I think if people are going to do that are listening, putting a small percentage of money in some sort of fund, EM fund or non-U.S. fund makes sense. But I think picking individual stocks there for most people is not going to be a great risk reward.
Gotcha. Yeah, and another region, South Korea. When you speak about memory, that stock market did extremely well last year.
Well, Samsung and Hynix are huge percentages of the whole index, though. So it's like the same conversation about SanDisk, Micron, or whatever. You got to remember, Hynix and Samsung are just massive percentages of the entire stock market there. So when memory goes up, the market looks good. But if and when memory rolls over, those stock markets will massively underperform. So that's just a levered memory call, I think.
What about Japan? You saw people speak of the curry yen trade. I don't know if you can see where that played into your semis and trades, because that was a huge thing last year. I know I'm getting you pick your mind. You said you're 56 and go back in the time, but like Japan is outperformed as well. I know they're usually a country where the baseline is set for interest rates, right? People do see that.
I think that Japan's historically been about the yen and rates. But I just think individual investors are seeing more on the technology side there, more optimism about, a shareholder-friendly management team. So, again, if global MSCI is 65, 70% US stocks out of that 100, then if people are making like an equity allocation and they're buying a fund, I don't think it's imprudent to own 10 or 15% of their total allocation of Japan equities. That's not crazy to me. I've been a little more cautious on EM equities historically, just because a lot of them are more geopolitical, and so I still think somebody should own a pretty sizable chunk of their equity exposure in the U.S. But my comment was just more than I can remember. Institutional investors are favoring non-U.S. or thinking that it won't be as correlated as it was in the past.
Perfect. Yeah, I know we're coming up. We got literally like 2 minutes, Adam. I appreciate your time today. If there's one thing you want to tell Main Street, tell them, and then let them know where they can find you, where they can see you, where they can reach out to Adam Parker.
Yeah, no, thanks for that, Marcus. And my view is, that the industry that I'm in is filled with incredibly smart, hardworking people that have tons of resources. So, be humble about investing. If you make some money doing something, it's probably more luck than good. So try to be diversified and don't take too much risk, because I feel like I see too much of that. And yeah, I'd love people to come to my website, www.trivectorresearch.com. Again, it's $100 a month. We do we do monthly Zooms where people can ask me whatever questions they want. We publish 3 or 4 short 2-minute reads a week about what's going on, and we give people insights. So hopefully they'll find that valuable. I do CNBC once a week. I'm a CNBC contributor, and we obviously get quoted all the time in Barron's, Bloomberg, whatever. So you can see all that on our website. So thanks so much, Marcus. Pleasure to meet you. Thanks so much for including me in your.
Yeah, man. Thank you so much for jumping on, Adam. And if you know anyone else over there, CNBC, Wall Street, who wants to come down, have a conversation, tell them I'm open.
Okay.
Seriously, that's like as serious as I can get about that one. Main Street meets Wall Street. We're bringing some Wall Street smarts with some Main Street heart. Just really excited to have Adam on. You're welcome, Adam, to come back on anytime and speak, about anything you like. You got an open invitation. Main Street, we'll talk to you next time. Thank you.
We just finished a high-level audit of the market's trajectory with Adam Parker. But here's the reality. Adam's great insights, as valuable as they are, they don't exist in a vacuum. They're symptoms of a system that has repeated itself for over a century. And he takes in all these factors when he does his research, as you can tell from the episode. What we just discussed, the hypersellers' dependency, the tariff volatility, the fragile sovereign floor, these aren't just phenomenons. They are simply the 2026 iteration of a pattern that has defined every major market reset since the Panic of 1907 and the Great Depression of 1929. Before we move into the tactical reallocation strategy for your own portfolio, we need to ground ourselves in the evidence. You cannot protect your capital if you don't understand the DNA of the crashes that came before. We're going to take in true Main Street meets Wall Street fashion and go into a deep dive into the history of Wall Street crashes, some of the symptoms, some of the things that we've done since to try to correct and marginalize them. If a crash like 1929 can happen again, and if this time is actually different. So that's a deep dive, a solo version, about 30 more minutes coming. One more thing, if you're finding this useful, you find value in the fact that we don't do the hype here, only data, this is the moment to support that work. Hit that like button. It helps the YouTube algorithm to get this intelligence to other allocators who are currently being misled by the mainstream narrative. If you want to remain part of this ongoing audit, if you want to be notified the moment we drop the next sector rotator report, make sure you are subscribed. We're building an archive of structural intelligence here that you won't find anywhere else. Take a second to do that now. It helps Main Street meets Wall Street stay independent, uncompromised, and dedicated strictly to this Main Street ledger. Done? Good. All right, let's check out the history of market crashes right now.
Main Street, Marcus Stern Senior here from the markets right now. Dow Jones hitting 50K, bouncing around that level. We're going to talk about that. We're going to talk a little bit about the history of the Dow a little bit. Dow Jones theory, something that can show you why. We'll explain a little bit about that. And then also we'll talk about investing versus trading. It's a big topic. People use those terms interchangeably, and they are not the same. We're just not the same. So just going to sit back, a little more laid back tonight. Going to talk to you at Main Street, just let you know, help you come from one of my main missions. I help Main Street meet Wall Street. So we're just going to jump right in. Just jump right in. We've seen the markets just move crazy begin 2026. We saw a sell-off in software. It all started with Claude integration, right? Claude came out with an app with an upgrade to their tool that could do clerical legal work. And we saw services like LegalZoom and those stocks in those sectors take a flush last week. They just went down as we saw that AI could replace that sector, replace some work in that sector. Then we saw earlier this week, we saw disruption by altruists and the integration of an announcement of their tool, Hazel. Full disclosure, me and my firm, BABC Squared, we use altruists as our custodian. But that really, really shook the markets. It shook the financial firms, fintech firms. We saw Charles Schwab, we saw Raymond James taking really big hits after the release of altruists. Altruists are true disruptors. Big shout out to Jason Wink and the team over there doing big things. You'll hear more from them. But one big thing with altruists and Hazel's here to help advisors like myself serve folks like you all. It's a great tool. And we also saw earlier this week with the data that came in. So we saw data that came in, the jobs report, and revised jobs reports that showed that we actually lost more jobs last year than was reported initially. Once we got this data in, we saw the housing data was really weak. The stock market was just not prepared for that today. So it seems that we've been able to find areas to hide in. There are areas in the stock market that are growing, but today was just a really, really rough day for investors all around the globe. You gotta stay focus. You got to stay invested, okay? Don't go rushing. Don't go out making any brash decisions inside your portfolio based off one day, okay? 1 week or even 1 month. Well, we'll get to that later. That's investing versus trading, all right? So, like I said, so we're seeing this massive sell-off in the SaaS, software as a service area. So like I was mentioning earlier, you have areas like you have areas where software can replace paralegals or assistants. So we saw Salesforce and Adobe and companies like that just sell off. One thing to looking at is okay, so these AI agents will be able to come in and replace some of this work, but some of these companies that have stickier relationships, they have the data with some of these providers, they have large enterprise systems with these providers. I speak about the model and how this stuff actually works in an earlier video. I can put the link in the description, or we go deeper into the SAS Apocalypse that just happened a couple weeks ago. But for now, just knows that it was based on a model where revenue is charged per seat. And when you lose the seats, you lose your revenue. So henceforth, they see the revenue leaving Salesforce and their peers, not just Time Salesforce, but other peers, ServiceNow, other type of companies that provide services that can be eliminated by AI or AI software. So like I said, then we saw the altruist news. With the altruist news, we saw the move where people were worried about they won't need their financial advisors anymore. I think this is similar to, robo advisors when they first came out years ago. There were people who were worried that they were going to wipe out the financial advisory industry. These tools will revolutionize the financial advisory industry as well as other industries. And there will be people who will use AI eventually completely for their financial advisors. More power to them. But there are going to be people who value the tools and value that financial advisors bring, mainly the personal touch, the stickiness and deepness that we can go into the actual human relationship. These AI and these advisors won't realize when not to panic sell. They'll be trading like algorithms. Algorithm trading, that's a video for another time. So if someone wants to, if y'all want to hear more about algorithm trading, just let me know. I'll drop a comment in the video below. But so, like I said, these AI tools will come in and integrate. You have to think back when Robinhood first entered the scene. Robinhood came into the scene as a disruptor, and they had free trades. And this was back when companies like Charles Schwab and Fidelity, they were charging money for a trade. Sometimes $5 for a trade. And for people who are making a lot of trades, this can add up. So Robinhood came in and dropped the floor. Everyone thought Charles Schwab and these companies would be destroyed, but these companies just adapted. They have very huge balance sheets. They have a lot of leverage to pull, and they have a lot of money on their assets under management. So they have a lot of tools that they can activate. They adjusted. Robinhood is actually one of the companies that was hit the hardest with these fintech innovations, but that's kind of tied to crypto as well. Robinhood has been played as a proxy to crypto. So as you see crypto go up, you see crypto go down, you see Robinhood move. I actually have another video on crypto, Bitcoin. When I speak of crypto, I'm usually only referring to Bitcoin or the blockchain. The other stuff is just way too much to go into with it. Not necessarily a recommendation for crypto or blockchain, but if you want to learn more, there's another video that I've already went deeper into. I'll leave a link in the description. But for now, Robinhood, fintechs, tied to crypto. When you see crypto going down, you'll tend to see these companies going down. So we saw Bitcoin really get hit pretty much this whole year, pretty much since about October at the end of last year. It's been cut in half, like 125 to 60. And in that move, Robinhood stocks been hit really hard as well, especially in the last few weeks. So you see these moves, we see money coming out of fintech, these AI software stocks, as people are looking for things to replace them. Investors, money managers, they're trying to figure out what industry can't be impacted by AI now, right? We're like, what can AI come in and disrupt? What hasn't it already disrupted, right? We saw it hit the Microsoft and stocks like that. What has it not already hit, or what hasn't already been impacted? What's a safe play? So people think, I don't know, maybe a safe play. We see a lot going into industrials. Industrials are up this year, materials, things like that. Energy's up this year. So we're seeing a rotation. So the money that is leaving AI and software is not completely leaving the market. It's just being redispersed into different areas. We're seeing it going overseas. We're seeing, well, we saw it going into gold, but gold has kind of leveled off, as I said, you play. But we see money is being reinvested. A lot of money going into ETFs, just like indexes. But this is a time where stock picks will matter. You can't just go out and just say AI and think that you'll have a stock that's going to win. You have to know what you're doing, do your research, check the spending on these companies. The spending levels really matter. When you hear CapEx, how much are they spending on capital expenditures? How much money are they spending? And what's the return on this investment? ROI, return on investment. How much are they getting back for every dollar they put in? If I spend $1, am I going to get back $1.50? Am I going to get back $2? Am I going to get back 98 cents? I'm going to get back 98 cents for every dollar I spend. That's not a good investment. So people just wonder how much exponentially you're getting back for every investment that you're spending. You don't want to lose money on investments. And they also want to see, they're just interesting with the type of funding that's been going on with the AI move as well. We have Google that just introduced 100-year bonds. So I don't know who's going to be here for 100 years. Maybe these are two that can be used for endowments or for, I don't know, a family legacy type investment. I'm not sure who's going to accept those bonds, although life expectancy is up. That's a whole nother topic. Not one I'm going to cover, life expectancy. But I can help you with how much money you need to have to live with this new expanded life expectancy as well. So it's just another thing where you may need to talk to someone. So talking about AI, software sell-off, the whole market sell-off that we're seeing right now, people are just worried that the whole AI play is flawed, right? So if the AI play was flawed, people are worried about the Mag 7 and the move out of software. We still see moves into semis. People are still making chips. NVIDIA's still getting chips. So some of those companies have seemed to perform well. Some of these chip companies have backing by the government as well. You can think of Intel and their partnership with the government. I do think of other companies that have made commitments to the government. And just know that there's a balance. These things are normal that we're seeing right now. You see markets go up, you see markets go down. These are pullbacks right now. So you see 10%, that'll be a correction. You see something going to 20%, that would be bear market. That's where you start to get to maybe recession talk, where people start thinking about those type of things. But we're not there. This is just a rotation right now, volatility. You never know what moves the markets from day to day. You never know what will move the market from day to day, I should say. It could be one tweet and one post, or it could be economic data, which is another thing that we've gotten. Like I said, it's coming in just lowering the chances of a rate cut, depending on which camp you're in, or some say perhaps we may have to have a rate hike if the economy is running so hot and inflation is out of control. We need to tip it back down. We'll see. We also still have the tariff interplay. We have Iran, which is pushing oil prices up a little bit. So we see that increase in inflation. We see that increase in the oil stocks right now. Just a lot of moves aside. So the stock market right now, if you've been invested, say, since COVID, you haven't really seen this. But this is natural. This is a rotation. This is what happened last year. I don't know if it's going to be the same duration. I don't know if we're going to have the same V-shaped recovery. But if you remember last year, at the beginning of 2025, there was a lot of economic detoxes. We had geopolitical petitions. We had to figure out if we were going to get the legislation enacted with the one big beautiful bill, tax reform. We had to see if the tax cuts would expire at the end of the year. We obviously had a government shutdown at the end of the year, or in the middle of the year, and a later one, which we're kind of partially in right now. So there's a lot of stuff happening right now. And we have a debt and deficit that are just expanding. Interest rates are high, and the Fed they're on pause right now. They cut rates at the end of the year, 75 basis points, 3 cuts, but they're on pause for now. We have Kevin Warsh coming in, and that seemed to have routed the markets. That was also around the same time as the software sell-off. So those things happened on pretty much the same day. It was just a big shake with the market. What I'm saying is, what we're seeing is natural inside the market. We actually witnessed last year, even as the market was up 18 to 20%, we saw rolling recessions in certain areas. We saw areas that were down, areas that were up. This brings me to my next topic. So I said you can kind of tell when these things are coming, right? They're movements, they're different theories, right? One is Dow Jones Industrial Theory. You hear people talk about the Dow Jones. All right, what is that? It's a stock index started by Charles Dow Edward Jones, another man, Charles Stressenberger. That's quite the name, or Bergstresser. Charles B. But so Dow was a journalist. Edward Jones was statistician. Back in 1896, they started this index with 12 companies that pretty much encompassed the U.S. Economy, different sectors. Obviously, as the world changes, the companies change, the sectors change that represent the U.S. economy. Right, railroads was a much larger part in there than it would be today. Dow Jones now has expanded to 30 stocks. So it's one thing to hear people speak about the Dow Jones all the time. It's only 30 stocks in Dow Jones, but it represents the total economy. And one big thing with Dow Jones is the Dow Jones Industrial Theory. So Dow Jones Theory, transportation theory. So inside of it, you have Dow Jones Transports. Part of the economy and stocks that move the goods. Other side, you have the industrials, the parts that are making the goods. So if the stock market, so let's take for instance where we saw 50,000 in the stock market, might be 50,000 now, depending on the time of this video that you're watching, but on the Dow Jones. But when it hit 50K, what we saw was the Dow Jones transports were down. So those companies were down. Why would they be down if the stock market's that high? Okay, so that's because they don't have things to move. There are orders being made and orders being moved, or there's something delaying the movement of those orders, right? So you need the transports to be transporting items. You need industrials to be creating items and goods to be transported to the consumers. That shows that the whole cycle, economic cycle is working. People are consuming, producers are producing, transports are moving the goods to consumers into households. So when both of these things, when the industrials, the industries that are producing goods and the ones that are transporting them are up, and you see the economy up, like the Dow Jones up, stock market economy, two different things, and you see the Dow Jones up, that lets you know that this is a more healthier move. So and what we saw recently was a state where the Dow Jones was, the transports were and are in their territory. It took a hard hit today. Most of them, FedEx had their investor day recently, and that helped them a little bit. But in general, we saw the Dow Jones investments or Dow Jones transportations have been in the bear market here lately. So think about, like I said, companies like FedEx, UPS, these are just some of the Dow Jones companies. So Dow and Jones, they would read the reports, take them to the New York Stock Exchange. That was your thing back then. That was how they started and just grew into what we know today. That's the stock market in the U.S. Or the Dow Jones industry. Another thing to note is that people worry about bubbles, and you should be concerned with your investments. You know what you're investing in. We've had several of these, have a lot of these. 1907, we had a big hit. The government responded with the Federal Reserve. 1929, obviously the Great Depression, that many people remember. Well, not living people remember, but we've read about the Great Depression, one of the greatest financial depressions in history. That was started by speculation and bank runs. We created the SEC. It was a lot of margin calls in there too. So we created the SEC after that to help with governance and regulations of traders. Because the stuff that they were doing while it was terrible, it wasn't illegal back then. All these margin calls, insider trading. Then you have 1987. So in 1987, you just have, also it was another incident where it was somewhat of a scare. People started kind of running on banks. You had a bad day on Thursday and Friday, and it just kind of carried on. But there were definitely underlying issues inside of the economy. We had run it hot for a while. The Reaganomics had run it very hot. So there were other actions inside that. Then you had the 99, 2000, 2001 bubble, which people like to compare this time to, where you had the dot-com bubble. Anything and everything that was dot-com was going up and going up and going up. Stuff that didn't even make sense. You had to build out. I was speaking up with the board group that I meet with earlier, an advisory board. We were talking about just the investments, the bubble, what people were seeing, what they're talking about with their clients. And I just mentioned, back then, people weren't really sure. They were really overbuilt, and well overbuilt for AI too. But they built, I think it's 5 times the amount of fiber that goes around the world. And actually, like with AI, we'll probably only end up building 2 or 3 times as much capacity as we need. Same thing happened with railroads. When railroads came out, we overbuilt railroads, which is ironic because now we're trying to get the railroads connected. We'll have a cross-country transit. But that's a whole nother story. But so like I said, you have the dot-com where you have overvaluations, you have cheap money. It's also a thing that's usually custom to all these things is cheap money with low interest rates. So you had cheap money and the bubble burst. You had a lot of things that actually didn't earn any money. You know, things that just, like I said, just said .com and the stock price went up. Kind of like you can just think about things that just said AI and the stock price went up. Then we have 2007, 2008, the housing recession that was built off of those structured notes, those terrible mortgage-backed securities that were created. The movie The Big Short's a really good explanation of all that. But basically what they were doing is they were lending money to people who possibly couldn't pay back the bill. Let's say that you make $10,000 a year. They will sell you, these numbers are arbitrary, not exactly real numbers, but the way that people couldn't pay them back or not. So say they would sell you something for, say you were earning $10,000 a year, they would give you a loan for a home that's $500,000, a $500,000 home, something that you couldn't pay off in 50 years if you wanted to. And they would just approve it because they were just trying to get those loans approved because they were catching fees on the backside. So they were taking these loans that were trash, packaging them with other loans that were good, people who were credible, people who would pay back their loans, putting them inside these notes, putting them all together out in there and then going out and getting insurance on these notes, selling other people. Sometimes they're also shorting the same notes, right? So they were playing both sides of the fence. They knew these notes were trash. They knew that the housing market was going to, they knew that eventually the bubble would pop. They just were figuring out who was going to get caught with the bag. Who's going to get left with the bag? That was the question. So that's 2007, 2008, the housing market. And it was a terrible, detrimental time. And this time plays into a lot of investors now, because a lot of people who are investing now were children then. So they remember the stress and the pain that they saw from their parents or people losing their homes or not being able to move into their home. Another big thing with that is a lot of those loans they made to the individuals were adjustable rate mortgages. So in my opinion, and there are various opinions on this, you want to get a fixed rate on your mortgage. That way, when the interest rates go up or even when the interest rates go down, your mortgage stays the same. These people are getting financed. Like I said, they're $10,000 a year paying for a $500,000 house. Maybe they got financed at 3%, but then interest rates started going up with inflation, as we saw, and these mortgage rates could just shoot up 1% or 2% in a month, 3%. I know people personally who just saw this same thing happen to them, so their payments would change like drastically, and then their houses weren't worth what they paid for them, so they were underwater. People would just leave their homes. So 2008, 2009, the housing market bubble was a terrible thing. A lot of people lost a lot of money, lost their homes, just probably lost relationships. It's a bad time. Then we get COVID, 2020, right? The world just shuts down. And that kind of stuff happens, they're just events that you can't plan for. It's always going to be one of those. They're just going to happen. World just shuts down. In response to it, the government stimulates the economy with a lot of free money at low interest rates, low to zero interest rates. People go out and spend this money. Inflation just begins to run wild. We do not catch inflation in time. Chairman Powell even said that they missed time and probably shouldn't use the word transitory. Although some of those things may be transitory now. Maybe they just had the time frame wrong on the transitory inflation. But so we saw inflation go up to record highs, levels we haven't seen in 20, 30, 40 years in the last few years. So inflation goes up like that, and your price goes up 20% on something. Even when inflation numbers come down in the following years, and they say inflation is 2.5% compared to estimates of 2.5%, people are happy about it. Inflation instead, that's still 2.5% on top of whatever it already was. So people are feeling this pressure from prices. So inflation, prices, and then we just saw. So we're still feeling that bubble. We're still working through that right now because these things take time to recover. That's where we're at now. We're at the point where fiscal policy has to figure out we've been working on bringing inflation down, how to cap this inflation. Are we going to grow out of this economy? Are we going to have productivity that outgrows the inflation? We've had some tremendous GDP, but we also have tariffs now, so that's a whole different dimension than we experienced before. So inside of the tariffs, it's just get a whole different experience. You can have a whole different level that we really haven't had a high level of tariffs, I should say, since the early 1900s, but we've had tariffs. President Trump enacted some tariffs before in his first term, and President Biden left those tariffs. So he just took the tariffs. President Trump has just taken the tariffs to a different level now. Another thing that can move the market is depending on what the Supreme Court of the United States has to rule on tariffs, and the tariff ruling that is imminent. We're expecting it soon. So that's just kind of how you get to these bubbles, kind of different ways, right? Some things are different inside these bubbles. One, the speed of information, right? So we have so much speed that moves inside information. Inside, two is after all these moves, all these scares, these depressions, there were tools implemented to help curb future events. Some say they made them better, some say they made them worse, right? One of the things that, like in 1929, the Fed was there, but the Fed made the wrong move. The Fed didn't. The Fed tightened monetary conditions when they should have loosened monetary conditions. So just because you have the institution there, they still have to have the people there to make the right decisions, right? So you had the Federal Reserve, like I said, in 1929, but it still didn't stop because they made the wrong moves. And hindsight's 2020. The Federal Reserve Chair at that time had never experienced anything like that. But here we are, 2026, coming into a new Fed chair and a new government in the middle of what may be a bubble, the end, the beginning. I don't know. We'll see. Stay invested is a big thing. So that just brings me to my next point. Investing versus trading. Way too many people just say investing and trading like it's the same thing. And it's not. Okay. So think about investing like gardening, farming, right? Like you got to plant the seed. Actually, first you have to go in there, you have to get your soil, you got to pull out the weeds, you got to get all that stuff right. Then you plant your seed, then you fertilize it, you do all that stuff, and you got to let it grow. You got to tend to it, you know, you got to tend to it, you pull the weeds. When you first put it in there, you got to do a little more work, right? Before it gets established. Once it gets established, you just pretty much tend to it. It's a tree plant, you just go out and prune it, maybe once or twice a year, once it grows up to its maturity. But while it's growing, you have to make sure the trunk is stable. You have to make sure that things aren't out there. You make sure that that's messing with the tree. You just have to make sure that it's nourished. But as it grows, it can take care of itself a little bit more. So that's like investing, you know. You want to take your time. You want to make a move. You want to invest in something. You want to have it. You want to make something. You want to buy something that you can hold 3, 5, maybe 20 years. I don't know. Plus, and I'm not just talking about investing in stocks or bonds. When you invest in anything, a lot of people invest in homes. Their homes is their largest investment. But yeah, I mean, you're not buying your primary home and moving out of it in 6 months unless you're, you know, a person who flips houses. But most people, you know, think about that's an investment. You invest in your house or you invest in yourself, you invest in your education. If those are things that take time, those things that you put the work in at the beginning, you get the results in the back end. Invest in. You invest in your relationship. You invest in a lot of things, right? So those are investments, longer commitments. Trading, on the other hand, is something that just happens fast. Boom, boom, boom. Trading's like speed dating, I guess. I don't know if that's still a thing. I guess I think the 40-year-old version every time I think about speed dating. That was fun. But yeah, so those are like moves that you're in, you're out. I usually consider it less than a year that you can be in a trade, right? You can see something that you like now. It could be something that you like later. But a trade can be a minute, a second, a day, an hour, months, a year. It just depends. Depends on your time frame when you're jumping in or you're jumping out. One thing I will say is that you should be knowledgeable in what you're investing in, and you should be knowledgeable of what you're trading in. The same amount of knowledge, whether you're investing in something or whether you're trading in it, because it's your money both ways. So you need to know what you're investing in. What you're investing in, you need to know why you are investing in what you're investing in. What's the reason? Why am I doing this? Because the market's going to get choppy. Look at where we're at now. Don't go out making drastic moves. If you're an investor, you're not out making drastic moves in your portfolio right now. Maybe if you balance some, maybe if you reduced a little bit of risk, maybe you've gone a little bit less risk on, more risk off. I got a good video on that. I can leave a link for it in the description, risk on versus risk off. And you're just reducing your risk, you're reallocating some of your assets. But if you're a trader and you see this stuff, you're jumping in, you're jumping out, you could miss time like that. You could get it timed perfectly and make a lot of money. Could. You see those people on TV, like the one or two who actually timed it perfectly and they like write books about it. But generally you see people who tell you don't try to time the market, especially trades. Stay in the market. Time in the market dwarfs time in the market all day, every day. The longer you can stay invested, generally the better your returns will be. Why is investing going to, over the long run, work out better for traders? One, it requires a lot of time to trade. Time, effort. Unless your job is a trader, if you're a person who has another job, it's hard to trade and have a job and a life because it just takes a lot of time to watch the market, see how things move, especially in the markets we're in right now. The markets today, for example, the futures were up in the green to start the morning. Market is down a few percent, just a deluge, just a flush. I usually see when the futures are down in the morning, the market ends up. It's very interesting juxtaposed. But if you're not in there, and you're watching this stuff, you can make the wrong trade. You could have bought this morning, sold this afternoon. That's not how you want to do it. Unless you're short in the market. Different story. But mainly you want to invest, or if you want to trade, just make sure you have the time, make sure you have the knowledge, make sure you know what you're trading, make sure you know your why. So investing versus trading, just the basics of it. If you're using your retirement account, your 401k, something like that, you do not want to trade inside of that. That's just not prudent. You probably want to invest in that. There's a different pool of money for trading if you want to trade, but not inside your major retirement account. It's just prudent, right? Also, before you get into investing or trading, if we're talking about stocks or bonds, you need to make sure you have the basics set up. I got a video. I'll leave a link for it on the basics of investments, the blocking and tackling, the building blocks. I can leave down in the description. But so there we also have it. So we talked about a lot here. Talked about the market sell-off earlier. Talked about Dow Jones, a little history on Dow Jones. Dow Jones theory maybe is one of the things that you can see. It's how you'll know if the market is going to move or if you know if goods are moving in the economy. Spoke a little bit about inflation. We did a little tour about the history of some of our economic failures, recessions, depressions. Some of the 5 big ones: 1907, 1929, 1987, 2000, 2001, if you want to call it, amid the 2020 COVID crash. I missed the housing market and the housing market. We talked about the housing market crash as well. So 2012 as well. So we covered all those, just some general things to remember when we're talking is remember that if you're investing, stay invested. These are opportunities. If you're a long-term investor, if there's a stock or a bond, or even, I don't know, if you're investing in property like something you see come down that you think is going to be a better investment in the long run, take a shot. But know that anything you're investing in, you need to give it time to grow. It's going to ebb and flow. It'll go up. It'll go down. Eventually, it should go up and to the right. Right. Don't be intimidated about these stats and these numbers people are talking about. I'm getting some education about it. If the stuff sounds tricky, one of my main things, like I said, I do this. I help Main Street meet Wall Street, and I do that with just disseminating information to people. So you can check out my channel, subscribe, like, share. I'm here to share a little bit about what I do. Like I said, this is me by night, but by day, I'm a financial advisor. I have a firm up there at the ABC Square, do financial planning. I love the markets. I love financial literacy. That's one of my big things as well. So if you need help with that, give me a shout out. Remember, the market sell off today. Know some of the reasons why. I know if you want to jump into some stocks, think about whether or not one of these AI stocks that we saw in the sell off can be disrupted and completely eliminated, or will it just innovate and continue to grow? Maybe those are the ones you want to invest in, the ones that will continue to grow versus the ones that will be eliminated. Remember the Dow Jones, 30 stocks, 1896, Dow Jones investment theory, the transports, watch those. And when you hear people speak about it, because part of my mission is to help people understand the stuff you hear when people don't want to go deep and dive into this information. Let me know what you want to hear on the street. I'll help you to the best of my ability. I will be bringing on other folks to chat with me, so there'll be some other conversations where we're going deep as well, sharing some other things. We're going to bring some guys on, talk about some crypto, just the markets, different things, some things that I want to give you the information so you can make your own informed decision. I'm not going to tell you what to invest in on here. That's what I do in the daytime. We can figure that out. Here's just giving away information for the masses, people who want to talk. Like I said, the data, we spoke about data, the jobs data, what that means, why people are thinking maybe or not we'll have more or less rate hikes, whether this economy is running hot, whether the economy is not. We didn't even jump into immigration and the role that it plays in this right now with the job market. See, that's another thing. Let's just take a second in that. Immigration in the job market, inside the job market. So typically you need a lot more jobs. We spoke earlier about jobs and the level of the jobs being revised down. But with immigration now this year looking to be at negative for last year, net immigration, you're losing a lot of jobs. A lot of immigrant jobs were filled up in like farming roles. So you have a lot of people out here producing your food. Those roles are gone. People who have to fill those roles that aren't being filled by AI are going in there at higher wages. So you're feeling that come through the immigration effect. You're feeling that come through in your prices. As it costs more to get this stuff off the field from the farm to the table, per se. It costs more to get it from the farm to the table. And every little step, it costs a little bit more. We're all paying a little bit more in the process. So that's how immigration impacts labor one way. You also have a lot of people who built houses inside the industry, and a lot of construction jobs inside the industry. So now you're having to pay people more to do that as well. So you're going to see housing inflation. That's another reason why you see housing inflation. But housing is also a big part with demand. So we lack supply, and the demand is there when interest rates are going to be right. People are worried about interest rates. That's a whole other tricky interval. Then we spoke about investing versus trading, difference, the moves. And lastly, I just want to share, like I said, Marcus Sterling, Main Street, Wall Street. I do have a partnership with Monarch Money. It's a tool. It's a budgeting tool, a personal budgeting tool that I use sometimes with my clients. We can work together. It's a good tool. They can use it. You can share it with your partner. You and your partner can share it and see your budget live and live in color when it's happening. You can share it with your financial advisor. They can log in as well. You can all take a look at it all in live at one time. It uses AI to help integrate. It's a great place to see all of your accounts in one place. Helps with can I afford to make this payment right now? Not payment, can I afford to buy this right now? Or should I wait? Do I need to move this money here or do I need to move it there? So it's a really good tool. I'm going to check it out on the desktop. It has a great app as well, which you want to go set it up right on the desktop. It's a good tool. So yeah, it's Monarch Money. I'll leave a link for Monarch Money in the description. If you use the link that I'll leave in the description, I can be compensated for that. So full disclosure, but Monarch Money is a good tool. The link will be for a discount. You can start a 7-day trial. You can get 50% off the first year. But once again, Monarch Money. So yeah, that's check out my channel. I've got a lot more stuff already on there, and there's a lot more to come. Marcus Sturban. There it is, my name. Firms, the ABC squared. What I do. It's right there. Got any questions? You want to chat? Got any video ideas? Share this with someone? Let me know. Check it out. I appreciate your time. Thanks for joining me this evening.
We've walked through the archives. We've dissected the 1907 panic, the 1929 collapse, the 1987 reset, and the 2000 dot-com bubble. You've seen the evidence. History is not a warning, it's a blueprint. The structural DNA for every crash we just reviewed is visible in the current hyperscale media. Mania. I don't know. The sovereign floor is shifting. The energy bottlenecks were tightening. We just had renewed strikes with between the U.S. and Iran and the Strait of Hormuz. And the disconnect between AI-driven CapEx and the real-world yield is wider than it has been in the last few decades. But knowing the history is only half the battle. You have to know how to play the positions with your capital today. We only looked at the depth. We only looked at the history of market crashes, actually high level. If you want to get deeper into it, check out my latest episode on Main Street Meets Wall Street on my YouTube channel with David Snyder, the mystery broker on CNBC. He predicted the market crashes, and he's calling for an AI market bubble. But for now, your direction, next steps, you need to look at your portfolio through the lens of the patterns we've seen tonight. If your exposure is built on the assumption that markets only go up, you are structurally vulnerable. Pivot assets or just cut back some of that exposure to some of these things that make parabolic moves. Continue to audit. This archive was the foundation, but the conversation is evolving in real time. To see how these structural lessons apply to current AI bubble specifically, like I said, I recorded a very intensive briefing with Mr. David Snyder. David and I spent over an hour and a half diving deep into the AI hyperscaler mania, exactly where the cracks are forming and how to rotate your trust assets before the market recalibrates. The conversation is the follow-up to everything we've documented today. It bridges the gap between historical patterns recognitions and the 2026 tactical execution. Is this more economy what we're in? More things going to work? If you found value in this audit, hit subscribe. Check out Marcus Sturban Sr.'s YouTube channel. It's where we provide real-time briefings, different intelligence. Love to premiere live videos when things are happening. Ledger's open. The war for the Main Street economy is going on. We can't slow down. It's not slowing down. I'm Marcus Sturban Sr. Main Street meets Wall Street. Allocate accordingly. Let's get to work. Main Street Heart meets Wall Street Smarts. Thanks for listening. Is Bitcoin a scam? Welcome to the first part of our 4-part series, where we dive into the heated debate between crypto bears and bulls. In this episode, we'll explore the skeptical side of the crypto world, questioning the legitimacy of the Bitcoin and other digital currencies. Our guest, Clem Miller, a seasoned trader and Georgetown professor, will unravel the myths surrounding crypto, challenging the notion of Bitcoin as digital gold. Get ready for a thought-provoking discussion that sets the stage for the upcoming episodes, where we'll hear from both sides of the crypto world. Check those numbers. Let me know. But make sure you listen towards the end, where we talk about a phenomenon that I hadn't heard of until Clem enlightened us. So check out Main Street Meets Wall Street podcast with Clem Miller, part 1. Thanks.
Main Street. Welcome to another episode of Main Street Meets Wall Street. I'm here with Clem Miller, and we're here to talk about crypto. Why is this really a scam? Is this really anything? Is it digital gold? Clem's going to give us a just tell you a little bit about Clem. Clem's a retired trader. He's now a professor over at Georgetown. He's been a little skeptical of crypto since he maybe first heard about it. He's just going to hop on and let you know where he stands and, the pros and the cons of crypto, or maybe just the cons. But here goes. Thanks for coming.
Thank you so much, Marcus. I'm happy to be on the podcast today. Sounds like you're doing great with the podcast so far. So all the best luck for this. So, we're talking about crypto, Bitcoin, crypto today. And as Marcus mentioned, I've been a big skeptic of this area for a long time. But that's primarily, I think, because I come from a background of looking at stocks and equities. And, when you look at stocks, you're dealing with, for the most part, you're dealing with real companies that generate sales, that generate profits. Hopefully the companies you're investing in generate profits. Some of them would pay dividends to you every so often. These real companies, right? Real companies, real businesses. That's what I like to invest in. And crypto offers none of that. Crypto is not a company, right? It's not something that inherently generates revenue. It's not something that produces profits. It's not something that pays dividends. It is, ephemeral, to use a highfalutin word, right? It has an existence that is only electronic, right? Despite the marketing presentations which try to show it as a gold coin, that's kind of nonsense. And in reality, it's just sort of bits and bytes, right, on computer screens, and that's all it is that. So I want to talk about a few aspects of it. One of the problems with delving into crypto a lot and delving into the mechanics and the technical aspects of it is that it tends to give crypto a credence that I don't think it deserves. And so, with that sort of caveat, I'll mention a few specifics that go a little bit deeper than what I just said about why crypto is not great, why it's speculative. It's not really an investment asset. Crypto is being marketed, or has been marketed, in various ways to try to appeal to different audiences, right? So it has been variously described as, some kind of new technology, which it isn't. It's been also described as a commodity, which it isn't, right? It's also been described as a currency, which it isn't, right? It's none of those things, right? It's sui generis, as you would say in Latin, one of a kind. And, it's not the best kind of asset either, right? It's not a stock, as I mentioned. It's not a currency. It's not a commodity. It's none of those things. It has no tangible presence. Uh, and what's bizarre is that the crypto promoters, and using all this razzle dazzle terminology that they use, they'll essentially diss currency like the dollar and the euro and so on, and call them, quote, fiat currencies, as if, to say that they've got no value to them, right? And implying that Bitcoin is of much greater value than the so-called fiat currencies, using their terminology. When in reality, there couldn't be anything further from that situation, right? Currencies, regular currencies, let's call them what they are, regular currencies, real currencies, like the dollar and the euro and the yen and so on, are backed up by the full faith and credit of their respective issuing governments. And also, there's this element of, sort of power, geopolitical power underlying those currencies. So, the US dollar is not just, a printing machine, as the Bitcoin people will tell you it is, right? It doesn't just come out of a printing machine. The US dollar is backed by the treasury, by the revenue receipts, receipts from revenues. If you were to ask, the Trump people, they would say, oh, it's the tariffs, right? The tariffs are generating it. There's real revenues, right, that are coming in to support the dollar. And ultimately, you've got the geopolitical power of the United States supporting the US dollar. If you look historically, take a longer term geohistorical lens on this, Marcus, you will see that, the US dollar replaced the pound sterling as the global sort of reference currency after World War I, and especially after World War II, because of the rising geopolitical power of the US relative to the declining geopolitical power of the pound sterling of the UK. And so you can see that there was a geopolitical element. And in the past, there were similar points where currency use changed with geopolitical changes. So it's kind of, those who don't study history are not going to be aware that in the past, at times, the Spanish Thaler, Thaler, the Austrian currency, the French, the Dutch. All these were currencies that were used more globally, ultimately replaced by pound sterling and then by the U.S. dollars. It's a function of geopolitics, and we'll see. We'll see that if China should come to the fore, and that's a whole different subject, Marcus, about China. But you might see a situation down the road where rising Chinese geopolitical influence might make their currency a more important currency in markets. But the Bitcoin, these bits and bytes on a computer screen, don't have any of that geopolitical substance to them, don't have any of that actual revenue support. There's none of that, right? So what's the real fiat, right? It's Bitcoin is the real fiat. It's not the so-called, it's not the real currencies that Bitcoin promoters describe as fiat. So that's kind of nonsense. Now, the Bitcoin promoters will come back and say, well, the value of Bitcoin is in the fact that, only so much can be issued, right? There's this limit, 21 million Bitcoin that can be issued over time. And they have this whole process of mining Bitcoin using computers doing crypto games. Not exactly mining, right? I mean, by using the term mining is misleading, right? Because you think of like gold being mined or copper being mined. It's not mining, right? It's computers using up a lot of energy and water, right, to solve puzzles. And once a puzzle is solved, it creates an extra link in the blockchain, and then you get and then whoever solves the puzzle gets a Bitcoin, right? I mean, that's kind of crazy, right? But the folks will say, the Bitcoin promoters will say, okay, well, you've got $21 million max, a 21 million Bitcoin max volume, and as a result of that, you've got a scarce asset that should rise in value. Okay, now there are several problems with that. Of course, the promoters won't go into those problems, but there are several problems with that. First of all, first and most important of all is that the price of something depends not just on the supply, but on demand. And so when speculators rush out of Bitcoin, doesn't matter how many Bitcoin there are, when speculators rush out, the price is going to fall. So it's a function of both supply and demand. So the fact that supply is limited doesn't by itself predict that the price will go up. And that's what all the Bitcoin promoters are trying to pretend. As we reach our maximum limit of Bitcoin, the Bitcoin price will soar. That's what they say. It's nonsense because it depends on demand as well. And I forget who said this, some famous economist. Not that we should always listen to economists, but they said supply, does not create its own demand, or supply creates its own. It doesn't. Supply does not create demand. You could have a supply of something and it doesn't create demand. You could have, huge supplies of various product, any kind of product, right? And unless there's demand, you're going to have just lots of inventory sitting around. The same thing could happen with, and could happen and has happened. If you look at the year to date on Bitcoin, it's down over 20%. And, anecdotally, there's been a lot of folks leaving Bitcoin, selling Bitcoin. So there you have a live example of demand diminishing for Bitcoin, even while the supply stays the same and the price goes down. But Bitcoin is not exempt from the laws of supply and demand. No asset, speculative or investment asset is exempt from that. So that's one issue with the whole notion that Bitcoin is somehow an attractive asset over the long term. But there's also another concept too as well, which is that there are alternatives to Bitcoin that your typical Bitcoin investor will try to exploit as well. So there's
hold on before we jump into that.
Yeah,
that's going to be a deep one. You just unloaded a lot of good stuff to us, man. A lot of great information.
Yeah. Well, we'll come back to the alternative thing.
Yeah, we're going to come right back to the alternatives in just a minute. I just want to kind of unpack it for people who might, we just say a lot of interesting things. So when he's saying fiat money system or fiat system, he's referring to like money, dollars, paper. That's what people refer to as fiat. One big thing when you were mentioning that the U.S. became the backing for the for the global economy, the dollar. When it started, we were on the gold standard, right? So that's a whole different thing, right? We had gold to back the dollars before Nixon changed that in the 70s. So like every dollar was backed by hypothetically physical gold asset. And now just in your conversation, and I love how you're breaking down the cons.
Yeah.
I love how you're breaking down the cons in the conversation. It seems like someone could just replace the word gold with Bitcoin.
No, right. So, okay. So a couple of things there. First of all, between World War II, Bretton Woods, right after World War II, and 1973, when Nixon took the U.S. off the gold standard, indeed, gold was priced at $35 an ounce, right? But, the question then becomes, was it gold that was supporting the dollar? Or was it the fact that the U.S. was the most important, power in the world? I don't think it was gold. I think it was the fact that the U.S. had achieved global domination that made the dollar so important. The dollar, the dollar was used to help rebuild Europe, for example, right? Now, you had the Marshall Plan. In the 70s, when oil prices went up and you had the Gulf states and others making a lot of dough off oil, where did that money go? It went into dollars, right? Dollar assets, the so-called petrodollars, right? So the dollar is a dominant asset, was in up to 73 a dominant asset, not because of gold, but because of geopolitics. So and the role of the U.S. in the world. So I think that needs to be revisited. An interesting thing, this question of, well, is Bitcoin the new gold or whatnot? You mentioned that, right? First of all, gold is actually physically mined. It actually has a limited supply. It has been used for thousands of years as a store of value. Thousands of years, thousands and thousands, right? And Bitcoin is what? A couple of decades old, right? So I mean, it's kind of ridiculous, right? I mean, you think Bitcoin will be around in 100 years? No. You think Bitcoin will be around in 10 years? I don't, right? It's not an investment asset. It's speculative, right? So, which brings me around to, well, I want to mention one thing first, then I want to get back to the alternative discussion that I wanted to talk about. So, one way to think about crypto and to address this question of whether crypto is more solid than, what the crypto promoters call the fiat currencies, or what I call the real currencies, is this whole notion of stable coins. You've heard that term, Marcus, stable coins?
Yeah,
Yeah. So stable coins. The idea of a stable coin is you have a crypto token. Let's call them what they are. They're not coins, they're tokens, right? That's the real term, tokens. Like, some of you from New York may have heard the expression that in a token will get you on the subway. All right. I don't know if so I think so with these stable coins, the idea of a stable coin is that it's basically linked to the dollar. Okay. So think about the contradiction involved in the concept of a stable coin. The people who promote stable coin are saying that our product is valuable because it's linked to the dollar. But crypto promoters in general are saying Bitcoin should replace the dollar because the dollar doesn't have value. So go figure, like, who's right? Either you can be a Bitcoin promoter and say that, the dollar is weak, Bitcoin is stronger, Bitcoin is digital gold, blah, blah, blah. Or you can be a stable coin promoter and believe that the only reason your stable coin has value is because the dollar has value. So what is it, right? Pick a side. Do you pick the stable coin side or do you pick the Bitcoin side? You can't pick both because there's an inherent contradiction. So I'd mention that. Okay. And then let me come back to the alternative to Bitcoin question, right? So where I was going with that is that, Bitcoin, everybody talks about the value, all the promoters talk about the value of Bitcoin being in the fact that there's only a limited supply. And I already mentioned the fact that demand is a part of that equation too, not just supply. But also there are supplies of other things that your typical Bitcoin speculator might want to put their money in. And one of those would be various kinds of prediction markets and gaming and so on. And a lot of folks speculate on prediction markets. They speculate on gaming, right? And, so Bitcoin is just another one of those games, so to speak, right? You, you can have speculators, dump Bitcoin and decide they want to speculate on the Super Bowl, right? So, you got that as an alternative type of speculative instrument. Not to mention the fact that you've got, various kinds of meme stocks that are out there that people put their money into as well and try to speculate on those. And those also are alternatives to Bitcoin. And I also want to mention, in addition to that question of alternatives, that, even within crypto space, there are alternatives to Bitcoin. We mentioned stable coins already. And there are other types of crypto tokens as well that are out there. Lots of different kinds, not just Bitcoin. So how do you measure the volume of the crypto tokens? How do you measure that volume? As other crypto tokens are issued by other kinds of crypto tokens are issued besides Bitcoin, how do you measure that supply? Do you measure it only as 21 million, or do you measure it as the supply of all crypto? If you can dump Bitcoin and buy other crypto tokens, and I'm sure there are folks out there who speculate and say, well, I think Bitcoin's going to go down and I think, Ripple or whatever is going to go up, right? Then, what is the supply? How do you measure the supply? The supply is infinite, right? It's not 21 million. The supply is limited to only by the amount of crypto tokens that are being issued in general, not the 21 million, in general, all of the tokens, right? So you can't measure it by that. And then the last thing I'll mention on alternative instruments and the supply of Bitcoin is that there's a process known as forking, forking, right? And I can't, I don't pretend to understand the underlying computer logic for this, but currencies, tokens, crypto tokens, depending on their underlying technology, can fork, which means that they create replicas of themselves. So there was a forking episode, I think one, maybe there were more than one, involving Bitcoin itself, where Bitcoin spawned off a baby Bitcoin and created 21 million more tokens. So or you can look at it as kind of a clone, right, of the original Bitcoin. And right now, I can't remember what that Bitcoin is called. It's got a different name and it trades differently. It's at a price that's lower than the regular Bitcoin, than the parent Bitcoin. So, you could have, and I have not seen any research about whether the forking diminished the value of the regular Bitcoin, but you have to believe that if you're, spawning a baby Bitcoin, that it's got to affect the value of the parent, right? You got to, because it's creating additional supply. So one has to worry about forking episodes too, which would, make the supply of Bitcoin larger, despite this, this initial concept of the 21 million Bitcoin.
Wow, that forking thing is very fascinating. Sound like it's just missing a couple of letters or changing for what might have really just happened to people who invested in that. Like just creating a totally different coin, like just cloning it is, I haven't heard of that one. So that's very
yeah, look it up, forking.
Yeah, no, don't worry.
All of you listeners to Marcus, look it up, forking, forking. And I think you'll be shocked that this can actually happen.
Yeah, that just brings me right into our next topic we can jump into maybe. So you're talking about like with Bitcoin, if you have gold, and I know we connected on LinkedIn. I saw how you would share your portfolio, which is very cool actually. You say you recently left gold, but say with that said, like gold or with stocks, and in general, when we're talking about these coins, if you want to compare maybe somewhere where people think like, because there are so many tokens, Bitcoin would be like maybe a large cap stock, and these other ones are probably like small cap, micro, quantum computing, not on the earnings, but on the recognition level. Okay. So not on earnings, not on any intrinsic value, just how people, because there's so many coins.
If you live in a crypto world, right? Then I guess you could say that some are large cap and some are small cap. But the whole idea of cap doesn't really, I know the crypto promoters talk about coins having cap, And all that is the value of the coin times the number of coins, right? That's all that is. It has nothing to do with any kind of earnings at all, right? So,
Right.
I mean, and I guess you could say that stocks are similar because you could have a company that has no earnings.
Growth.
You could have a company that has no revenues, and it can still have a market cap because it's based on future expectations of revenues and earnings. So you can have that, but at least it's based on something that is a real flow of revenue or earnings, even if it's expected in the future. Whereas Bitcoin and crypto tokens, the market cap is basically based entirely on the willingness of somebody to buy that token off you in the future.
See that, and that's the big part too, right? You teach in university, we learn in school, you learn that money, like when you talk about what money is really, or what something has value of. What makes something valuable is what something's willing to pay for, right? Like
Yeah.
if I was like, hey man, I'll pay you $1 million for those glasses on your face right now, like those glasses suddenly become much more valuable. Like you said, supply doesn't create demand. You have to have someone that wants to buy that widget that you're creating with the digital coins and the Bitcoin all in the same. I want to jump into the risk, because that seems to be one of the big things we need to let Main Street know, the systematic risk versus play. So if I was to invest in a stock, right, this has been covered by the SEC, reviewed, maybe not recommended, because the SEC is not going to recommend your stock, but it's been reviewed. Regulators know it's publicly available information. This corporation has to report. And if something was to happen, there will be some way to get some recourse, right? Whereas if you lose a wallet or a token, there's not particularly any way that you can go back about it and find your wallet or your token. Someone could just find. I saw a statement where a guy was like, my dad just invested, I don't know, $200 in Bitcoin. I told him to send me his key or whatever, and I stole it. And I told him that's your first lesson in crypto. Never share your wallet token. So just can you just expand on because I mean, you can have gold, but someone will have to break into your vault and take your gold. So you see, go deeper into the systematic risk if you could.
A couple of things I think about when just based on what you were talking about. So first of all, you mentioned about the regulation, right? And I think that's a very important thing. But again, there's kind of a myth that's come out of the crypto community about how crypto will really soar only if we have a proper regulatory framework. You may have heard of that, right? Crypto will soar if we get a good regulatory framework. Well, what the crypto promoters are really talking about is they want to have a, quote, good housekeeping seal of approval for crypto so that they can keep selling it, right? So they can keep selling crypto and they can say, well, we have the government's approval for this. The government is blessing it. They will misconstrue, some of these crypto promoters, the unsavory ones, will misconstrue what the government is actually doing with regulation and sort of spin that into this is actually a real kind of investment asset because we've got government regulation and everything. So trust us. and the crypto promoters, including the Witkoff and Trump, was it Witkoff? Yeah, Witkoff and Trump sons, right, have made inroads in trying to create this regulatory framework that provides this good housekeeping seal of approval. If there were a solid regulatory framework around this, you would not have crypto at all, right? Because it's not an investment.
Very interesting. Yeah, and the purist of what Bitcoin and crypto, they don't want the government intervention. It's more with the corporation strategy and Coinbase who are trying to get more into regulation. And just so, yeah, you trade in equity. So I'm assuming you would never, and we're not recommending any equity on here, just so y'all know everyone's individual, personal investments, but strategy or Coinbase, you can see through let's talk about strategy. You can see through their books, right? And Michael Saylor's always out here talking about how he'll just keep buying Bitcoin. He says he can afford Bitcoin to go down to $8,000, which is, I don't know how his numbers work. I haven't dug into them. Right now, to mine a Bitcoin, it's about $67,000, I think is the numbers coming out, just to get one. And we know Bitcoin's been trading below that level. It could trade above it, but it's been currently trading below it. So if someone was to say, okay, what would you look at in that company that would make you not invest in the company if he shows you all these things and all this leverage and all this leeway? Or you just saying, I don't believe it, because if he goes out and he's just lying to the world like this is a publicly traded company and he can really get in trouble for it.
Well, I don't think he's lying to the world. I think it's very clear that he promotes Bitcoin, right? He's all over the place promoting Bitcoin. And And I would never invest in his company because it is so dependent on the price of Bitcoin. So I would never invest in it. He's highly leveraged to Bitcoin. Why would I do that? I wouldn't want to do that. So Coinbase, I believe they do trade some other things besides crypto, but they're mainly focused on crypto trading. And, why would I want to invest in that? I mean, if I wanted to invest in an exchange, why wouldn't I invest in the CME or the CBOE or, one of the real,
Commodities exchanges.
one of the real exchanges, right? And at times those are pretty good stocks, right? Because they make money regardless of where the of where the share price is, because they're the trading platform for this, right?
Mhm.
So they make money, and they're more solid. They've been around for longer. I don't know why I would want to invest in Coinbase when I can invest in real trading platforms, real exchanges. Just, I don't get it. So, I mean, you can tell that I'm a little bit on the, you might say I'm really conservative. I'm not conservative at all, right? I'm realistic. And when I look at some of these things, the Coinbase is it's so narrow and focused on such a risky asset that I wouldn't want to be involved in it.
Got you. Yeah. And like you said, you're not risk averse. You understand. You're just risk realistic. You know when you should have more risk on, more risk off. I mentioned earlier that on your link.
And Marcus, it's not just Bitcoin that is something that I wouldn't do, or crypto is something I wouldn't do. I look at, and I don't want to necessarily. I mean, you mentioned Michael Saylor and that, but there's another person who, Kathy
Woods,
right?
Tom Lee.
Well, Tom Lee's more of a big strategist. Let's talk about, I mean, Kathy Woods runs funds that invest in crypto, but they also invest in a lot of newer startup technologies, like real technologies. Crypto is not a technology. In sort of real technologies, quantum, and not to mention things like Tesla and so on. That's what she invests in. I wouldn't invest in her fund either. And the reason I wouldn't is because she's taking long run bets on a portfolio of companies that, many of which may not have any revenues or profits right now. And that's not something I would do. Right. I'm not averse to technology stocks. I invest in technology stocks all the time, but I wouldn't invest in something just because Kathy Woods is involved in it. Right. Uh, and one thing that you see with Michael Saylor and you see with Kathy Woods is that they are sort of CNBC personalities, right? They're out there promoting things, and they have a media platform for doing that. And then, you have to wonder, well, if they're out there doing that, their media platform, why, should I invest? Why wouldn't I want to invest in somebody who's more silently pursuing real investments and doesn't want to talk too much about what they do and how they make money? I would rather invest with those people, right, than with folks who are, promoting themselves on TV all the time.
So that would say maybe you want to invest in Intel over Nvidia. Jensen Huang's out.
No.
World. Look, I'm saying, like, he's out promoting AI all the time.
I would never invest in Intel. No, never.
As we wrap up this enlightening discussion with Clem Miller, it's clear that the world of crypto is as complex as it is controversial. Don't worry, we're not done yet. In part 2, Clem goes even deeper into his pros and cons of Bitcoin and crypto in general. Part 3, we're going to dive deeper and bring into a different perspective. Someone sees a bright future for Bitcoin. Yes, that's right. We're going to bring on a Bitcoin bull who sees the horizon as ready to go and the potential for digital assets that is unlimited. So stay tuned for more insights as the debate continues. Check out the Main Street Meets Wall Street podcast anywhere you can find podcasts. Marcus Sturman Sr. on YouTube, or find Clem or Marcus on LinkedIn. Thanks. Stay tuned for more insights and debates that will change your understanding and perhaps even change your perspective on the crypto landscape. Main Street, hard. Wall Street, smarts. At all.
So it feels a lot like there's some good things that come when we slow down and think about things. When I think about my career, I've been trading options for over 20 years and helping clients with options. And when I think about options, I think about, there's two types of options. There's put options and there's call options. And the best way I've found to explain them to people is to think about there's a trade and there's a desk. And so in the old days in Wall Street, you went down with your certificates and you traded and you put them to people, meaning you sold them to people, or you called them from people and bought them from people. And so that's really what the put and the call are really about, is just the moving of the shares and the movement of future shares. And so an option gives you the right, not the obligation, to buy or sell either a put option or a call option. And so for people who own a lot of shares, they tend to sell call options to people that give them the right to buy their shares at a future price. So if we're talking about, let's say we're talking about NVIDIA and it's at 187, and you say, I like NVIDIA, but I don't think it's going to 250. So you might sell a call option, sell the ability for somebody to buy your shares at 250, 3, 6, or 9 months in the future. And then, as you imagine, the longer you do that sale, 3 months is worth $1, 2 months is worth $2. The longer it has to potentially occur, the more time value is what they call it, then the longer and the more valuable it is, because it gives the stock time to reach that new level from 187 to 250. So selling a call option is the most common form of using options. It's called option overwriting. It's taking your shares and overwriting options on top of it. And so what most people now are talking about is the market too high? Is the market too risky? Is the market something we should all sell it and go away? And in my experience, the big thing that causes people to make decisions is taxes. Taxes matter to people, because if you bought NVIDIA and it's up 1,200%, you owe a lot of taxes on it, right? And so whenever you sell some of those shares, you're going to pay maybe a quarter, a third, or even more to taxes. So you don't get to keep all of the money. And that's where people are very hesitant, because as they grow up and as they go through life, they see every day, every 2 weeks, hey, look at that money go away to taxes. I understand it's good for the country and it helps all things, but for individuals who are trying to attain a certain wealth so they can retire, that's really hard when they see that money go away. So what I've focused on a lot of my career is those people who are 5 years from retirement or in the first 5 years of retirement. Those people are most at risk, right? The market goes down 35, 40%, and you're 2 years from retirement. Your number that you were going to live off of has been affected, right? And so using options can be a way for you to kind of manage that risk. And that's where the second option, I'd say, we first talked about the call option and writing it. Now we're going to talk about buying a put option, which is buying the ability to sell at a price for a given amount of time. And so for that example, if we owned a ton of SPY, which is the index for the S&P, and we said, hey, I really don't think this can go down more than 15 or 20% before it will affect my retirement. Then I say to them, okay, we can sell it today and pay some taxes and then be locked in that market value, or we can buy put options. And these put options will allow you to stay invested, and in case it goes down, the put option will increase in value by about the amount that the stock goes down. And that allows you to stay in the market, and it allows you to behave better. I mean, Marcus, I don't know how you feel about markets today, but when I look at it, I think it's really about behavior and not necessarily about the numbers. I mean, people are not used to, when they've had a certain amount of money and they face all of the news and events that are happening around the world. And I think that behavior is the thing that we're really managing. We're not only just managing stocks and money and bonds and cash. It's really about the client's behavior. And how do we encourage better behavior? Well, if you can take the emotion out of things and get them to focus on longer term, meaning I want to focus on 1 year, 2 years, 5 years down the road. You get people to focus on those things and not the short-term noise. That's a big asset for you because the investor is going to be patient. If he is patient, we know that the probabilities and the returns go up. So, for example, when I think of what's happening, I think about why do we get nervous? And we get nervous because we don't value a dollar going up the same as a dollar going down. We think the dollar going down affects us more. It could create an opportunity for you to buy, but that's really what we focus on when we think about money, is we focus on the downside versus the upside. We don't value them the same as various psychologists, and Kahneman and Tversky did a lot of work on this and won the Nobel Prize for thinking about how do we value losses versus gains. And I think, Marcus, it comes down to how can we as advisors help people do better. And it may just be a conversation where you talk them through, do they really need the money now? What would happen? Would they take some of the stuff they have in bonds and move it over to stocks if they went down 30%? The answer would probably be, hey, it's on sale. It's on sale right before I need to make a last term decision, 2 or 3 years. I'm still working. I can live through 2 or 3 years or 5 years if I have to, because I know I'm getting good prices for the stocks, and I'm also positioning myself for 20, 30 more years than in retirement. I think everybody has thought about this retirement thing and said, oh, it's going to be a 10, 15 years. That's what my mother had or my father had. But in reality, we're all healthier. We've all been in a different health system. We all have these different tools to keep us living longer, not necessarily living better, but longer. And so therefore, I think that thinking about things around retirement is when there's a lot of risk and a lot of apprehension. And that's where tools like options can really be a plus.
Wow. Yeah, thanks. That was a good breakdown to, especially for people who are real life situations, how they can apply it if they're about to retire or if they're close into retirement, how options really can help you out there. Just so just so folks know that on a simpler level, the call option, you correct me if I'm incorrect, call options usually meaning that you're bullish, meaning that you think that the stock's going to go up, like Mr. Stevens said. Put option usually means that you're thinking the stock's going to go down, so you're bearish. You were speaking about protection. I know a lot of things and you were speaking about long term. So, but I know in today's world, a lot of people are using 0-day trader options. That's a different thing. We're talking about investing versus trading for people. And if you want to learn more about investing versus trading, we have videos and other streams for that. We can go a little deeper in that on them. But the people also use options for income. Would that be something maybe someone could use closer to retirement? Can you maybe expand on that?
Sure. I think that's where if you have a big position in the SPY or an index fund, you can sell options for income. That's like the covered call where you say, okay, I'm willing to sell these things because I'm trying to lower my risk and I'm getting near a point in my life where I could use a little bit more income. So my S&P is paying me 1.5% and my bond fund is paying me 4%. So I know I should sell some, and this might be in a tax-free account, an old 401k or IRA. and you sell a call option a little bit higher. And until it gets there, you just take that extra income. And so if you generate 2 or 3% from each option and you write them out 3 or 4 months, then you do that 3 or 4 times. Now all of a sudden you're taking in 5 or 6% income on those shares. That's a nice way to increase the yield and wait for it to get to a price that you'd feel good selling. And so when I think about options, they create, you guessed it, more options for you. And the idea is there's uncertainty in everything we do. There's uncertainty in the weather, there's uncertainty in health, there's uncertainty in everything. And so what you're doing is trying to profit from that uncertainty. And there are times when I look at an option and I say, the historical volatility of this is 18%. Now it's at 26, 27, 28. So it's paying 50% more than it normally pays because the option price is based on that volatility and uncertainty. So therefore, do I think it's 50% more likely that it's going to hit that price? No, I don't. I think that volatility bounces up and down around a mean. And what you should do is when things are priced in a rare way, meaning higher than normal, I think you should try to take advantage of it. When options are particularly low, I've seen them get down to 9, 10, 11%. And then I said, I think I should buy protection because the protection cost just got less by 50%. This happened after the recent Venezuelan move where we took and arrested the president there, Maduro. I don't think that arresting the president of Venezuela is necessarily a reason to think the market is less volatile. But that's what happened. So when the market gives you something, you have to ask yourself, it's given me this. Do I believe it? Do I think it's a good idea? And so I bought put options for a couple of the clients during that time. And it's really about trying to create the right feeling for our clients. Clients can feel very anxious about many different things in the world. And our job is to really help them understand the price of oil going up. What does it mean? The carriers going to the Middle East. What does it mean? All of these things are troubling to the average investor. And what we need to do is put perspective into their lives and the situation where we've been through this 3, 4, 10 times. And so therefore, help them to understand the things that are most important. If the market went down 20 or 30%, would your assets produce the same amount of income? Probably. So if they're living off that income, it's probably going to be fine. And then you say, okay, but let's say we get 4% income and 2 or 3% comes from the portfolio and 1 or 2 comes from selling something. Then we say, okay, we got our 2 or 3, that's going to be fine. But how do we make up for that 1 or 2% we need to sell? And that's what your bonds are for. And that's what your cash is for. So that when you need to go into something and sell it when the market is down, what happens when the market's down for stocks? Usually the market is up for bonds. So they'll usually appreciate 2 to 5%. So in that way, you're selling 2 to 3% or 2% to make up that difference to get to 4. And guess what? Bonds would usually be up, and they'll be a place that you can sell where you're not hurting yourself in terms of your long-term return estimates. Many people have planners like you, Marcus, and the planners look at them and say, hey, you're 60-40, we'd like to see you maybe be 70-30. That makes your average return equal to 7%. And that 7% is what you need to hit your target in 10 years. That's great. The question is, can you get the client to stay and meet that target? Or are they really a 50-50 person who doesn't like having that extra 20% exposed? And then you say, okay, let's think about this. How do we help the client take a little more risk so that they have a benefit in 3 to 5 years of a higher price and a higher market and a higher account value. The way to do that might be using options on that 20%. Hedge that 20% by buying a put option and selling a call option. It's called a cashless caller. And so you do that around the stock where you put 10% down on the put option and you sell the call 10% or more up. And then you say, okay, we can live with this in between here. If it goes up a lot, which we're not thinking it's going to because we're worried about the markets, I'd sell at 10% higher. That helps me with a 15% tax rate. I paid 2/3 of my taxes. If it goes down 10%, my put option gets more valuable and makes up for some of that decline. So it helps clients get through what I'll call difficult periods. And those are periods they're just not, they've never been in retirement. They don't know what it's going to feel like not to work anymore and have a paycheck every 2 weeks. And I think that what you're doing is you're creating some comfort for them around those numbers. And that's what I think, as much as we can talk about, if things go down, you're going to have this safety net from Social Security. You're going to have this much if you have a small pension. You're going to have this much from your assets in your IRA. Those things combine together to create a buffer for that person to get through tough times. And that's really what life is about. If you have a long time horizon, it's great. You can say, I'm long horizon. I don't need to worry about it. It's going to come back. Okay. But when you're 2 or 3 years from retirement, you don't have 5 years to wait. So therefore, this is a way to kind of create a little bit of safety net around that time when you're a little bit uncertain. And that's really what we're just trying to do, is get people to feel good enough that they can walk away and say, I'm focused on my life. I'm not focused on my portfolio. And that's really what we want to create, is that sense of peace. When I put my head on the pillow, am I worried about what my account is, or am I just worried about getting good rest? And that's what we really want for people.
Yes, sir. So the SWAN plan, sleep well at night plan. That's what you want for your clients. You mentioned a lot in there. You used the word protection in there. Protection. So I guess one way of putting it would be if your portfolio was a house, options would be homeowners insurance. Would that be kind of maybe something to that effect? You also also in there you were saying to buy calls or sell calls, and obviously we're talking from a perspective of someone closer to retirement. And second, we're going to talk about someone who's like just getting started, because options can work for you at any stage in your investing career. I said earlier, you were talking about the protection, and then you were speaking about people who were closer to retirement and how they could generate these for income. They could sell calls, but you can't just own 20 or 50 of these stocks. You have to have at least 100. Yeah. Can you break down like what exactly is an options contract for the people who don't understand that, it's 100 stocks makes that type of real quick.
I mean, one way for people to own stocks before they get started and they're, would be buying a call option. And so a call option represents the ability to sell or buy 100 shares. So each contract represents 100 shares. And so when you think about it, the S&P is somewhere around 650, and it represents 1/10 of a share of the S&P, and those shares will go up or down 1% in a day. So a 650 priced stock, 1% move would be $6.50. And so what I've put in place for people is the 620. The 620 put option is, about 6 or 7% down from where the market is now. I think that for younger investors, they might buy a call option that's a year or two out as a way to gain exposure without fully spending their money, right? They could say, hey, I'm nervous. I'm, say, 50-50, but I really know that I'm younger and I should probably take more risk. Well, why don't we take the risk by buying that call option? You don't have to put all your money into it. You put about 5 or 6%. which would be, say, $30, and you'd manage, so 30 times 100 would be 3,000 shares, and those 3,000 shares would be available for you to buy, since you own the call option, at some price in the future. And so in doing that, you get the upside, but all of your exposure is that 5% you put into the call option. So having that leverage to the upside for a young person allows them to still benefit on the upside, but the worst that can happen is the option expires and the stocks didn't go up. And then you've lost 5%. If you had invested the entire 3,000 times whatever the price of, let's say it's 6,500, that's 195,000. That's a lot different than putting 30,000 into something, right? So for that young person to be able to have exposure that's greater is a nice way. And so people will say, I really believe, my son really believed in NVIDIA because when he bought it 3 or 4 years ago, it was a great chip maker for gaming. And so he loved the NVIDIA processor and his gaming computer that he built himself. So when I said to him, do you want to buy AMD or do you want to buy NVIDIA? He said, I want to buy NVIDIA because it's the best. If I had to build a computer, I'd build it with NVIDIA chips. So therefore, I'm building my portfolio. I'm going to buy, and he bought, say, a couple of $1,000s worth of NVIDIA a while ago. It's up 1,200%. So he took his local knowledge about something and he put that towards, kind of like Peter Lynch used to say, know your stocks by following them and tracking them and being right on top of them. And if you're a consumer of chips because you work in the industry or you just happen to like gaming, you got to know NVIDIA pretty well. And then as they became the chip du jour and the whole AI thing, the value is just skyrocketing. And I think that local knowledge and young people's experiences should be a way to help them feel more comfortable. Because when NVIDIA was going down, he was looking at it and said, hey, I just tried to do another computer, and these NVIDIA chips are 30% more. Because I don't understand why the stock's going down. They're still the best chips, and they're getting more and more expensive. So how is this company not a good investment? That's the type of logic and experience you want to bring to the markets, because he felt good about it as a company. Therefore, when you can feel good about something and know that you have a good asset, you can be more patient. And ultimately, that's what we're trying to encourage, is patience and longer-term thinking. Marcus, you mentioned my background. I'm an advisor at Circuit Capital, and Circuit Capital uses individual stocks to help clients build good portfolios. We believe in balance, value, and quality. Those three attributes are what we try to fill our accounts with. We have a core account, a growth account, a value account, and something called faith-based. And faith-based is a strategy where we look at what the U.S. Catholic bishops say about stocks and which are socially responsible, and we buy a mixture of 40 of those stocks using Morningstar data to try to develop a good portfolio, so that if somebody said, hey, I want to buy things that I believe in, that are linked to my principles and my values. That's why we created the faith-based portfolio. And I also, at Circuit Capital, am in charge of option strategies. So what we've tried to do is create a wide range of skills with my partner, Travis Raish, and myself, and bring that to clients at what we consider to be a really good value proposition. So I think that, Marcus, you've been on my podcast, The Skeptic's Guide to Investing. My partner, Clem Miller, and I both we're CFA presidents at various societies, him in Baltimore and Washington, D.C., and me in Atlanta. And what we try to bring is the discipline that the CFA has to helping people understand investing and improve their overall financial wellness. If we can help individuals who listen to our podcast improve their financial IQ, we feel like there's a lack of really good information coming from the media. So we think that this is a good way to people to say, I'm a little skeptical. What should I think about this topic or that topic? And that's what we're called, Skeptic's Guide to Investing. And it really comes down to Marcus trying to help people through what I think is very hard, something that's we're not educated on as a society. And I know you belong to a financial literacy nonprofit. I did the same in Atlanta. It's difficult. What do you think about our financial literacy as a country and how we're doing things?
I think it's a sickness right now that we're going through. It's like an epidemic that we need to really work on curing, like spreading the message. That's part of the reason why we're doing this right here. Main Street meets Wall Street. We want to sit down and just take complex things like options and trading. We're going to talk about crypto, blockchain, the national debt. There's a lot of things that we're going to talk about. And we're just going to try to make them really simple for people to understand, not because people are simple, because these things aren't as complicated as people seem to make them. So that's definitely, one of my big passions. I want to ask you, so you were being skeptical, and then you were talking about investing with options, and you used the example of your son and how he used NVIDIA chips. So let's say from the same time frame. So I'm assuming your son's coming out right at COVID, 23, 24, somewhere around there, 22, 23, 24. Let's say you took the same person, not your son though, take another person, same age, who grew up going to Disney. They went to Disney this whole time. They said, I'm going to buy Disney calls. And they bought Disney calls at that same time. And we know where Disney stock was like $200 in. So it went the other way based on the same thesis. Like, what would you, we know that you can't just invest on a company just because you like it. Like, there has to be different fundamentals in it. So how would you play that with the options besides, I guess?
Well, the problem with, Disney in particular would have been a situation where I would have said, hey, if this COVID thing continues and we don't have any less travel, the parks make up 40% or 50% of the revenue. I wouldn't say that's as simple a story as NVIDIA, where the chips that they're making, they can't make them fast enough for gaming. And then now that they've got into AI, they can't make them fast enough for the demand from AI. I'd say NVIDIA is a more of a technical powerhouse, and I'd say Disney is a recreational or a discretionary powerhouse. And so when we have situations like a shutdown, I thought that Disney went down from 200 to under 100, and my brother-in-law said, hey, I think it's really good, should we buy some Disney? I said, after the correction, yes. I think that it's gotten beaten up, and I think we will eventually open up from COVID. But yeah, there is some discretion that I think you need to help people apply, which is put it in the right context, right? I think a person taking all of their account and buying a call option on Disney is never going to be the right choice. I think a person taking 2 to 3% and putting it in a call option on Disney, that's more of what I would call, it's sizing the opportunity. I think that you want people to have something that they can look at and help understand. It's a lot clearer to them when they look at Disney and they say, yeah, I went and I noticed that the park wasn't as full and as it usually is. And I noticed that the restaurants, there were no trouble getting reservations with, many. Therefore, I feel like something's changed, and it has, because some of the demand for some of their services has gone down because people weren't traveling as much. And so I think everything, Marcus, is really about trying to find the right size, the right name, and the right situation to use individual stocks. I wouldn't say they're for everybody. I think a simpler choice is buy the index. It costs very little, and it has great liquidity, and it's going to give you the exposure to the market that you should have. I think that what I'm trying to do sometimes with individual names is help understand the overall market. And, we added a couple of healthcare names this last year from my son's portfolio. He said, I don't know about all these, he had, out of his 15 positions, 12 were tech. And I said, this isn't really going to hold you up very well over the long haul. So why don't we try to do something where we mix in some healthcare, we mix in some, he didn't want to go with energy though. I couldn't get him to buy, fossil fuels. He doesn't believe that they're good, and I think that when we look at things in life, we want to find things, and health and healthcare were a much easier discussion, right? This pharmaceutical is going to be producing this drug. It's going to be similar to Ozempic. Should we take a chance on Pfizer? It's selling at 8 times earnings. The whole market is at 23 times earnings. It pays a 3.5% dividend. I think this is something that if you're patient, this will be better in 3 to 5 years. And so I agree with you that stocks represent risk and the call option can go to zero. But if you size it right, 1 or 2% of your portfolio, you can live with a 1 or 2% decline in terms of losing the value. That's where I think it can make some sense, and it can be helpful, because then the person can buy as many shares as they want when you get near the end of the expiration. And they might already have a gain, and that way, they buy it at 85, a call option on Disney, and it goes to 105. It's got $20 worth of value, and then they decide to, take the price they get it at, which would be, 95 or 85, and say, okay, I'm going to buy 20, 30, 50 shares of this, and I'm going to take the profit on the other options. And that way they've gotten in, they got to know it for a little while, and they feel comfortable with where they're positioned. I think it's really about gaining confidence in these markets. And I've started to have some worries about these markets. These markets have been a little bit different. And I think we all have to realize that with AI and with the different tools and things that are happening in the market, it's different. And how are we going to react to it and make people comfortable with it? That's really, I think, our job as much as it is understanding the investments.
Right. We help people with mindset and where they're at. Like you mentioned with the options, and you mentioned Peter Thiel earlier. I think I saw his quote where he was saying you only need to have if you can get 6 out of 10 stocks right, 6 out of 10 positions in your portfolio right all the time, you'll end up doing pretty well. But going back into that was great explanation, by the way. With options, in my younger days, I traded some options before, right? And the thing that I found the hardest with options, and you mentioned timing, is when to get out, right? It seems like I always would be like, oh, this thing's going to keep going. So how do you all over there at your firm time your options so people, or how can people plan on timing their options? You were mentioning earlier about the expiration date and people wanting to be out at the expiration date. You also mentioned later having earlier options that are 1 or 2 years out, so you have the time decay. Can you just elaborate on how you use timing, how you use decay, and just to see when you're pulling in and out of options?
So when options can go into the money, I always try to make my decision. Let's say I buy a 12-month option. I'll look at it as having 4 time periods of 3 months. So if it's a 12-month option, after 3 months, I'll look at the position and say, is it in the money? Is it significantly in the money? If it is, then I've had 25% decay in time and I'm in the money. I'm going to sell 25% because 25% has gone and I've got a profit on that 25%. And it'd be great if I had enough profit that all of the other options have been paid for. And so that when I sell, I'm basically taking back my original investment. The best way to not lose money, as Buffett says, rule number 1, don't lose money. Rule number 2, don't forget rule number 1.
Yeah.
I believe we all should look at ourselves and say, hey, I'm a quarter of the way through this. It has gone up. Therefore, it's time for me to open the cash register and take some profit. And then we get to 6 months. I ask the same question. Are we in the money? How much are we in the money? And if we are, let's sell another quarter or the 25% or a third of what's left. And so you can look at it as the original money and look at the original return. But yeah, you see some time decay, which is natural. And then you also see volatility. Maybe volatility has kicked up. And so instead of it being the amount that it's in the money, it's because the market is more volatile. And that volatility is another driver of price. And so, while the first one was just going up because the market was good and the price was good, the second time you look at it at 6 months, it could be the volatility is much higher. October and September are two of the most volatile months. You could be going through those months and have higher volatility. And so you sell a second amount at that point. Then at the 3 month point, you could be sitting there and it's below where you want it to be. It's below your strike price. And you could say, it's all over. I haven't, you've already paid for this option. You probably paid and gotten a return because you sold some in the first quarter and the second quarter. So in the third quarter, when you have still, 3 months to go, I think you got to leave it alone and say, this has already been paid for. I'm going to do this. I might buy the stock. It still could give me, if it goes up $5 or $6, it could give me a little cushion to buy this stock and have a lower purchase price. That means I paid less for it. So I'd say, hold on. You don't always have to sell because your goals have been met. You've gotten exposure to it. It's paid off for you. And you still might want to buy some shares that you want to make a part of your portfolio permanently. And then one day before the end, you're going to make a decision on those, half of the position. And you say, okay, what am I going to do with this? And it's going to be pretty clear. Either you're in the money, a good deal, and you say, hey, I want to own all these shares, or you say, I like it, but after this passing of 12 months, I don't feel as good about the company as I did before. In which case, you might just sell for whatever profit you have and then move on to another stock or another idea. I think you want to try to find ideas that are longer lasting. So when I look at some of the names, in my son's thing, the Microsoft, he doesn't like Apple. He's a Samsung guy. So it's really important that you find things that you say, this company 5 years later still got good prospects, still a good thing to own. And that's where you really find quality stays true and does well. And I think that quality names like a Microsoft or an Amazon or some of the names, I really find they're great companies. And one thing we did in the at Circa is we write a monthly blog. And in the blog one time, I looked at companies that contribute the most to their communities, meaning what do they do in terms of charitable activities? And Microsoft had some number, I think it was like 40 billion of activity in the community. Up in Washington, they're reconverting rail cars for homeless people. They offer nonprofits around them and around the country, free materials, free software, free items to help them run their nonprofit. I think that when you look at companies, it's great if they have a great balance sheet and a great income statement. But the other thing we look at, especially for our faith-based investors, is, are they good companies? Are they working with the community? Are they doing the right things to make our society better? I think it's very difficult to do A and B, good balance sheet and good profit statement. I'd say, hey, you guys do that well, and you do that better than your competition, and you do that better than a lot of other people. You deserve a lot of credit. But if you can also do that well in terms of how you treat your employees, how you treat your community, that to me is a home run, right? That's not a double. It's your company is doing things right for the consumer and their client, but they're also doing right by their employee and their community. I think that's really about the mentality of a stakeholder versus a shareholder. We want to satisfy shareholders, but it's really great if you can satisfy stakeholders, because then you've got people in the nonprofit community who are thankful for them. You've got people in their direct community who see the good work of the rail cars and other things. That's really what I would call success. We measure it different ways, Marcus, but ultimately, I think that's the way we should start to think about it more often.
Perfect. Yeah. And like you mentioned, you just mentioned a lot of different things that people inside of investing. So some people, you said you look at how much companies contribute to society. And that is definitely a theme some people invest in. Like you said, with your son, he didn't want to invest in fossil fuels. That's also a theme that people choose to invest in or not invest in. Some people choose to invest in tobacco or not in tobacco, right? That's one thing, but it's not the same thing as when you see people who choose to invest because we have a Democrat or Republican in the office. Never do that. That's a good way to lose money if you choose to invest based on politics. If you want to invest based on something else, like Mr. Stephen was stating there, that's a different story. But overall, history shows that whoever's in the office, red or blue, it turns green over time. Stock market goes up and to the right. Just wanted to make sure people understood that point. Well, one more thing with options that I really want to kind of dig into your funds. Can you just like break down? So I know this isn't what you do. I know we're talking about investing, but like a huge thing that's happening now, like we live in this world where people are just worried about speed and everything has to be so fast. Could you maybe elaborate on the explosion of 0-day options? I know that boosted a lot with the year of the retail investor last year. So,
sure. I think with the meme stocks, we had a lot of people who realized that owning GameStop was one way they could make a statement against the hedge funds who were shorting it. But they realized very quickly, what do options have in them? It's leverage. And so if I can pay for an option 5% of the price of the stock and buy that option, if I can do it for one day, my leverage is 20 times the return. So therefore, on a 1% return around an earnings announcement, or 2%, or sometimes we see 8, 9%, that multiplied times 20 is an unbelievable way to make money. But the other side of that is, it's a normal distribution. And when you think about normality, there's a big tail there on the left that's negative. And so minus 100 is what you have on the left tail if the stock stays where it is, meaning it doesn't go up. At the end of that one-day period, it doesn't go up, you lose 100%. On the other side, if it does go up 2%, 3%, you get a 20% return, or 40% return, 1 or 2%. So I think that these options are really speculation. They're not investing. What an investor is somebody who believes in something and will stay with it. In my mind, it never makes sense to take short-term profits when you can wait and take a long-term, right? Long-term capital gains, somewhere around 20, 15 to 20, and then short-term, it could be 40, 45, even higher in states like California and Massachusetts. So therefore, you say, how do we justify wanting to speculate versus invest? I'd say the difference comes to first, I only look at things that I want to hold for a year. That's what I do when I buy stocks. If I do something shorter than that, I look at it as a speculation versus an investment. You need to let things go through time so that you're more efficient in a taxable account. Again, if we're in a non-taxable account, in an IRA or something like that, a 401k, you can do other things because there isn't that tax drag that you would have in a normal taxable account. Taxable accounts require patience, and patience pays off in that, when these names keep going up, every year you're paying on, a little bit of tax on the 1.5% dividend. So 20% of 1%, is 0.2. That's not a big drag. if you sell and you pay short-term gains of 40%, that's a drag. To take away 40% of the profit you generated versus waiting till a year and getting it at 20%, that to me is a significant enough drag that you want to avoid. So I guess I would say, Marcus, some of the things that are happening in the market, one-day options, SPACs, some of the things going on with AI companies buying other AI companies, capital investment, it looks and feels like it's a little bit frothy and a little bit overpriced. So I would say try to be long-term, try to be only with companies that you really believe in and have good prospects, and then try to do a good job of watching out for your taxes. Don't let them rule the decision, but just try to be, if you try to take 1 year as a time frame in a taxable account, I think that's a reasonable time to expect to wait to get a good result.
Yes, it's a big difference in investing and trading. I'm glad you broke that down a little bit better for them as well. And then another thing, I know you have and kind of some of these zero-day option traders have the same mentality as the poly market, where you see these people trade with those like maybe the same type of mentality. And that's definitely not an investment if you're jumping in there.
I hate what's happened to sports. I mean, because to me now, every NBA game I watch, they want to tell me about what person's going to score in a quarter, what's how many rebounds is this guy going to get, and how many. I don't want to make everything a prop bet. Life isn't a prop bet. Life is, taking a holistic view for longer periods of time. Like, we're not individually looking at ourselves saying, "Ooh, if I pull down a 3% return on this stock today, I'm a winner." No, you don't measure winning and losing on one day's performance. You measure winning and losing longer term. How have I behaved as a person? How was I as a husband, a son, a brother, a father? Those are the things that you try to measure success at. And I look at these as kind of like we are all looking for that short-term gratification. The average attention span has gone from 16 seconds in 2023 to about 9 seconds today. 9 seconds. So if you don't pick something up in the 9 seconds and communicate quickly in the world of X or the world of Insta, it's kind of like we're setting shorter and shorter time frames, and yet we know that financial success requires a delayed gratification, and that delaying of gratification gets harder and harder when we expect results. And hey, I want to put this prop bet on while I'm still in the casino and I can see the result before I leave. Well, okay, that's taking the amount of things you can invest in and gamble in, and saying, okay, I also want to put it on a constraint that I'm going to find out in the next 10 minutes. I think that what we're all trying to do is find the way in the financial sense of our life, use our human capital to create results that are going to benefit me and those I love over the long term. People coming out of college with debt and no assets, they look around and they say, I'm poor. I look at it and say, you have a college degree, so you're going to earn more than a high school diploma, and you're going to ultimately have a lower chance of unemployment. Therefore, when I take your 40-year career and I discount it back to the present, you're worth about $4 to $5 million. You don't see that. It's in your human capital. But when we look at things in the right perspective, and the guy from the University of Chicago who did this in the 70s, he was looking at countries and how they invested in the education of their people. The higher countries with more education per capita, guess what? They had the more GDP per capita. It was a straight correlation, and that's why countries dedicated resources towards education of their people. Now you look at it and you say, hey, in 2000, people used to talk about the value of a company goes up and down in the elevators. And I'd say, yeah, there's human capital there that manages funds, and we need that human capital. Now, I want people to take the next step, which is let's look at every person as a combination of human capital and financial assets. How do we combine them together? You know, if a person goes back and spends $5,000 on a certificate, a CFP or something else, their value is going to be higher. They're going to have those letters next to them, and they're going to be able to say, I'm worth more. I think that all of us are working on that. And I think it's really important that we don't take a view of you are the balance sheet that you have right now. I'm going to add up all your assets, your car and your, that's not your value. Your value is much greater because you've invested in yourself and you have a degree and therefore you have a prospect. Why do you think the car companies want to give you that lease? Why do you think the credit card companies want to give you those cards? Because they know you're going to be able to pay for them. They see who's graduated from college and they send those people immediate credit. I think that what we're trying to do, Marcus, in this industry is really increase the overall value. That's the human capital and the financial assets so that people can realize their full potential. And I think it's a little bit different. Like I said, the stakeholder mentality versus the shareholder mentality. But I think what I've noticed, Marcus, is people are starting to understand more. I agree that the average, person exposed to financial information is low and is a bad situation. But I think we're getting there. I think now they just said that 64% of high schoolers will have some type of financial literacy class by the time they graduate. When I started in 2015, it was 14%. So think, the national 401k or, program that they came out with last year. I mean, should we have done that in the 70s and 80s? Absolutely. Why does it take pensions going away 40 or 50 years ago, and we're right now saying the whole population can have access to a 401k? I think we should have probably come up with it before 2025. But all we can do is today going forward. And all I'd say to people is take advantage of a 401k, take advantage of these things that the government's creating, because in the long run, the more tools and the more access you have to information and ability, the more you're likely to succeed and build up your financial wellness.
Good. Yeah. Yeah, that was a lot. And I know you used a lot of great terms there. Like we've spoken on like stakeholders and shareholders, right? The stakeholder is the person who's like in the community or the person working at the job, someone who's not exactly owning the stock. That's your stakeholder. Getting benefits from the community, people who are getting, like you said, with the type of things Microsoft and other companies do, versus shareholders who are just, in general, people thinking they're just looking for their returns and their profits, people who actually own the stock, the shareholders. And you can actually be both, right? You can be a shareholder and a stakeholder. And then this just whole lack of literacy inside the country and the world. I know that's something that we talked about offline and online as well, just how the world is moving towards working towards helping the world learn more about financial literacy, but we still have such a great gap to go. It leads me right to where I want to go next. Just tell us a little bit more about, like, so you mentioned back in 2015, and tell the world a little bit more about you, like how you got into this and then how you got to where you are today.
Well, in 2008, I suffered cancer. I had throat cancer during a time of a lot of volatility and stress. And I was trying to tell our chief investment officer to buy puts in July of 2007. And he said, no, it's too risky. Not enough people would understand, and didn't want to do it. And I said, now is the time to do it. Now is the time to differentiate ourselves. And, if we bought the first option, it would have returned 1,300%. Or 13, so instead of our clients losing 36, they would have lost 23, which is a lot of outperformance in 1 year. And in my experience with that, I looked at myself and I said, I don't know what the right thing to do is. I have cancer. I'm worried. I know that it's a very curable cancer. It's got an 80% cure rate. but I didn't like that 20%. So when I looked at it, I said, look, hey, if I get through this, I've been a pretty good father and husband and brother. I want to really be more for the community. And so that's when I got through it, I started mentoring college students in finance and investments. And I went from mentoring to being the president of the society in Atlanta. And then when I was president, I decided that we had a lot of assets on our balance sheet. And I said, these assets aren't helping anyone. Why don't we take 100,000 of them and put it towards financial literacy? And so we built up, and now I think for the last 10 years, we've given somewhere in the order of 300,000 away. We still have 300,000 on the balance sheet. And we've probably impacted with our financial literacy videos almost 1 million people. And
Wow.
so those things that you think about when you start them, 10 or 11 years ago, you don't know what it's going to become. And right now we've got a great program with the Boy Scouts and Girl Scouts. Boy Scouts and Girl Scouts usually come from, Title I schools. They usually come from economically needy areas. Those kids now are learning their financial and entrepreneurial badges, and they're starting to understand, with the help of the Atlanta Fed, more about what's available to them. What can you become? And one of the things I love about the Boy Scouts is they say to the student, you need to ask the person how they came to their career, and you need to help understand whether that career might be something you want to think about. And I just think it's a great opportunity for people to get up and look at the community and say, we would love to have these high school students who are young enough to pick a career in finance, when they graduate from high school, having that experience of talking to another CFA who was an Eagle Scout, and hey, I went through the badges. This one was the hardest for me. Helping people to see their future is, in my mind, worth so much. Because if you can see your future and you can see the pathway, you can make it happen. And I think that what we're trying to do with the financial literacy in Atlanta is to, one, open up the eyes of the people in the community, two, go out to the whole community. I'll tell you one quick story. When I set up these videos, we have 12 videos on 12 main ideas that we think help people be financially, start adulting. And when we think about adulting, we think about savings and investing and all of this stuff. But one of the things is we have a video of 3 minutes that's budgeting. And so ASFIP Foundation is on YouTube page, and we have it in both English and Spanish. When we look at the budgeting app, one of the people we focused on was Athens zip codes and Atlanta zip codes. And when we looked at Athens, we got this response once on Facebook from a minister of a small group from Ethiopia. And he said, I've been in this country 3 years, and I think that this video helps me and all of the people in my congregation to learn how to budget is a key to life. And so I looked at his following of almost 500 people, and they were all members of that Ethiopian parish. And I look at that and say, we pushed that video out with $100 investment to Facebook, and it got about 8,000 views. Well, one of those 8,000 views was this preacher and pastor from Ethiopia, and he shared it with his 500 congregants. I look at that and say, I don't know how many people we affected. I don't know how many lives got changed, but I think it was an opportunity where good things could come. And that's what we need to do as a society, is keep making those investments where good things can come.
Yeah, that's really cool story. Like just that pond and the ripple effect, and you just never know who you're impacting. Like, once again, like part of what we're doing here, I'm so glad that you hopped on with me, and so we could just talk about this kind of stuff and give this information to people who might not ever hear and never receive it. Like the world hears things and sees things from the media or however it is. Like you mentioned in 2000, and we said 2007, 2008, there were other people who saw what was happening in the market and was like, we should short this, right? But the people who had the voice or the table and were on TV or weren't exactly those people, and they were spreading a different message, right? So it's like access is so important. And when you can take access and you can take something like this and put it in a package like your 12 videos, you can just spread it out to the masses. You never know who's going to get it. You never know how it's going to help someone. It's just really good thing.
You know it's good information, and you know it's well structured, and you know it's done from a sense of care. Like I said, the way we started as a foundation was we said, if we could tell our children in an hour what the most important things were there for them to do in terms of finances, what 12 things would we tell them? And that's how we came up with our list. We said, credit cards, managing your credit score. We said, managing your investments in terms of asset classes and risk, and thinking about, fraud. Fraud is, really hard on that bottom 50%. The average person has in their account something like $500. And guess what the average amount of fraud is? $500. So it's, we know where it's happening. We know why it's happening, but we've got to do more to prevent it. And that's what, I love what you do, Marcus. I love the way you talk to people. I love the way, you're doing with ABC Squared. I think that what you want to do with people is the right choice. And that is leading with planning and giving people an opportunity to have different outcomes. And I hope I can do whatever I can do to help you. And I've enjoyed our partnership over the last year, even if it all just started because we were both wearing, Jordans at the conference, and we both had the same taste in sneakers. So you never know where something will lead.
Yeah, thank you. Yeah, you never know. And I don't know if that says like you have the style more of a middle-aged Black man, or I have the style more of a middle-aged white man. I don't know what's at. Or maybe we just both grew up watching Jordan.
I think you're lower middle. I think I'm upper middle.
It's all the middle. We'll just call it all middle-aged. How about that? We'll just keep it all in that range, right?
I like that.
But yeah, no, that's very cool and it's very true. Everything that you just said, especially your shoes, like that was the thing we noticed. Everyone else had on like the square shoes, hard bottoms. We had on suits and our Jordans, which is cool. I want you to, I want to respect your time. I want you to take some time and just talk about your funds, the funds that you're putting out to people, and how, if anyone wanted to invest in these funds, right? Let's say I had, or how much someone would need to just like, could I just pick up the phone, call you and say, I want to invest in your fund? How does that work for Main Street?
So we offer separately managed accounts at Circuit Capital. You can find us on the web at circap.com, circap.com. We're an advisor based in North Carolina, Georgia, Massachusetts, and we have other clients in Texas and Colorado. But our main thing is offering these strategies of active. We usually try to get clients, of different sizes, but I think if somebody wanted to invest, I think somewhere around 75 or 100,000 would be about where we would probably be able to create a nice complete portfolio with all the weights and all the names. We like to buy 40 names in our faith-based portfolio. In our dividend portfolio called Global Dividend, it's 50% US, 50% international, and it has a yield of almost 4%. That portfolio has 50 names. But really what we want to try to do is to create names that people feel comfortable owning. So when COVID happened, my partner, I said, how many calls did you get from people in that month of March of 2020? He said, none. I said, how can that be? He says, I've been talking to people all along in the monthly blog about here's why we invest in these names. And our clients sent me an email and said, I'm so glad I'm invested in Costco. I went there last weekend and they were doing a great job of giving me resources I needed to get through COVID. And when you see companies doing the right thing for their community, when you see companies giving you value, and I've eaten as many hot dogs as the next guy for $1.50. It's hard for me to walk by and not buy it. I can't help myself. I love value. I'm a kind of a cheap Yankee. I guess the word is frugal. But I look at things and I try to identify value in my life, and we try to do that in our stocks. And it's not going to be the high flyers. We are not going to be 100%, equal to or greater than the return of the market. The markets get away from average pretty quickly, and then they revert back. And what we're trying to do is stay with higher quality so that when it goes down, we don't go down as much. When it recovers, we recover more because we have higher quality names that people follow. And that's what we're trying to do. We're not trying to guarantee performance. We're not guaranteeing anything. We're trying to buy names that you can believe in. And by believe in, I mean be patient with, own for the long haul, and try to realize that, hey, U.S. equities operating around the world create some great companies. And those great companies, if they're in your portfolio, you can feel good owning them. That's what we want. We don't want to say we have the highest returns. We don't want to say we're going to beat the benchmark. We want to say we're going to give you a good risk-adjusted return. And I think that's the difference, Marcus, that a lot of people kind of forget about. Risk matters. Risk makes people nervous. Risk makes people behave badly at the wrong time. They sell out at the bottom. They don't hold when they should hold, and they don't sell a little bit at the top because they think more and more is coming. We want people to be balanced, and balance and quality and value are the things we emphasize at Circuit Cap. And we think it's, going to be a good place for most investors. And most of all, we just want to talk to people and try to get them on the right path. And ultimately, getting started is, a big part of this, right, Marcus? I mean, people are smart, people are very capable, but it's hard with all the things you got, hey, I got this weekend, I got this T-ball game, I got this, there's a lot of things happening. I got Easter Sunday is at my house, so I'm going to have everybody over. I don't have time to look at this. And I understand it's difficult. Being diligent and being successful takes effort, and it really takes discipline. And finding that discipline through better ideas is what we try to do. If you can look at our webpage and look at some of our blogs and see how we talk about money, I think that's what I would ask is check us out. And if you like what you see and you think that this is a way you want to invest, give us a call or send us an email we would love to help you.
Excellent. Yeah. And I'll definitely put some links in the description where people can get in touch with you. Maybe some links to those financial literacy tools if you like as well, where people can check them out. Some of the videos you made. I know you inside that comment you mentioned your global strategy, which is dividends, and then your faith-based strategy, which is based on the Catholic diocese around the U.S. What are the other two funds?
So we have a core strategy that's 40 names and is based against the S&P. That's the longest strategy. It's got over 11 years worth of history. We also have a growth strategy that has about 5 years of history and a value strategy that has about 4. Both of those strategies are specific for certain times when people say, I feel the market is too high. We put people into a value strategy where they can feel a little safer, or a dividend strategy. And then we might migrate some of the assets and have half dividend, half growth, or half dividend, half core. And that way they can kind of think about what their needs are. And again, the dividend strategy is really for people who are closer to retirement and want more income. And the value strategy is really more of a, hey, these names have been just beaten up and not given any credit. And now I looked at it, for the first 5 weeks of 26, we're up about 6%. So that's the type of strategy you wouldn't think would be up that much. But this market has started to turn and is offering different things to different people. So these are all, all these ideas are given to you from a sense of educational. We're not guaranteeing performance. We're not guaranteeing any results. We're just trying to give people an educational understanding of how it might be best to structure their portfolios and have many different ways to try to win in the markets.
Gotcha. Yeah, and that's also and that's a big part of it too that people don't realize. Like if you're concerned solely with returns, financial advisory industry, you can go buy an S&P 500 index and pay a small percentage off of it and kind of catch what the market's catching, right? But what we help people with is making sure they have their assets in proper allocations, like you said, for your tax implications for when you're later in life. We help a lot with the psychology because people, we say it all the time that you should buy low and sell high, but people do the complete opposite when panic happens. They sell low and they buy high. So just being able to go in and help people to remember their why, like you said with Travis, how people weren't calling him in 2020, y'all are constantly communicating information to people. Like communication is a big part of it. Information is a big part of it. So what y'all do is a really good thing. And the funds that when you say they're equal weighted, for those who don't understand, that just means he takes the 40 funds and divide them all equally into the out of 100. So, and you just get your percentages out of them. Some may be a little bit higher, some may be a little bit lower, but that's pretty much what he means with equal weighted. And then, yeah, man, this has been a really good conversation. I guess there's just anything else you want to leave the world with Main Street, you want to tell them something while we're here?
I guess I would say that, always protect and enhance your human capital. I think individuals, who the number one source of bankruptcy for individuals is a healthcare expense. So something happens that you don't expect and your costs, and it causes bankruptcy. When you think about your life, your health, your education, and your mental well-being are all part of helping you be the best person you can be. Start there and then start investing. But when you build with your core, meaning your mental well-being and your health through exercise, diet, and learning, I think what you're doing is investing in yourself. And those are always the best investments. You are the best investment you can make. And so take care of yourself and then work on learning and understanding how to invest with guys like Marcus and our podcast. I think there are good people out there who are trying to help. And my thing is to people, first help yourself, then look to others who can help you. And that's the way I would probably end it.
Excellent. Yeah, I think that was a great point, Mr. Steven. I really appreciate you hopping on with me. I think we had a pretty fascinating, wide-ranging conversation for those who check it out. Like I said, I don't know if one person or a million people will hear this, whatever in between. Hopefully they find some value in this. If you do, please check out Mr. Steven. Check out his podcast. If you find value in this particular episode, you can hit like, subscribe, whatever it is you're doing, whatever platform you listen to. Share this with people so people can have more information about how Main Street meets Wall Street. We're going to have other experts coming on to just have conversations about these type of things. We're going to have people talking about the national debt. We're going to have people talking about cryptocurrencies, blockchain, things that people hear about and they think are just really overwhelming topics for them. We're going to try to break them down as simple as possible. So if anyone listening has any questions that they want answered, send them to me or, reach out to Mr. Steven. Let them know where they can find you, Mr. Steven, or would be a good place to reach out to you.
www.circap.com, CIRCAP.com.
There you go. And you can find him on LinkedIn. I know he's on LinkedIn as well. We're connected on LinkedIn. And yeah, I guess that's just another way that Main Street meets Wall Street. I think that was a great conversation, Mr. Steven. And we'll talk to you.
Thank you, Marcus. I think you do a great job. I appreciate you.
Thank you. Thanks, Main Street. We'll talk to you next time.
All right.
Emotions wind up destroying the best laid plans because we as humans are emotional creatures. And the thing I really want you to understand about emotion is the word motion. We tend to do things because we feel a certain way. And that can, as you said in your intro, can destroy the best plan of making a 9, 10, 11, whatever % rate of return and all get blown out in a day or two because of emotions forcing us as humans to want to do something because things aren't going our way.
Gotcha. Yeah, emotions, and that's good stuff. I mean, people generally, logically, you want to sell high, buy low, but emotionally, when we see the market go down, people tend to do the opposite. They tend to sell low and then come back and buy high, jump in and out of the market. Trying to time the market is not a good plan, not a good move. Safe play. We see a lot going into industrials. Industrials are up this year, materials, things like that. Energy's up this year. So we're seeing a rotation. So the money that's leaving AI and software is not completely leaving the market. It's just being redispersed into different areas. We're seeing it going overseas. We saw it going into gold, but gold has kind of leveled off. As I said, but we see money is being reinvested. A lot of money going into ETFs, just like indexes. But this is a time where stock picks will matter. You can't just go out and just say AI and think that you'll have a stock that's going to win. You have to know what you're doing, do your research, check the spending on these companies. The spending levels really matter. When you hear CapEx, how much are they spending on capital expenditures? How much money are they spending? And what's the return on this investment? ROI, return on investment. How much are they getting back for every dollar they put in? If I spend $1, am I going to get back $1.50? I'm going to get back $2. Am I going to get back 98 cents? I'm going to get back 98 cents for every dollar I spend. That's not a good investment. So people just wonder how much exponentially you're getting back for every investment that you're spending.
Everyone's chasing the SpaceX IPO, but Wall Street is banking on your fear of missing out being stronger than your logic. Now, let me be clear. I'm not here to tell you whether the SpaceX is a buy or sell. I'm here to tell you that the ILP mechanism itself is built for institutional winners, not retail participants. But SpaceX is changing that. Whether you believe in the long-term mission of Elon Musk's team or not, you need to understand the retail excitement is often just the exit strategy for early capital. We're going to peel back the curtain on the mechanics behind this launch and why crypto flush is currently leaking liquidity to the broader equity markets, setting up for a bumpy but potentially historic ride through the midterms and into 2027. This is the one you've been waiting for, setting you up for the week ahead, and it also includes the full Elon Musk Jamie Dimon interview. Sit down, enjoy the night, the morning, depending on where you're watching from, and check out what we're bringing to Main Street tonight.
IPOs have been a hot topic, and we've seen the stock market here recently. The S&P was on a record run, right? I think it had been up for 9 straight weeks, and until yesterday, it was supposed to be up 10 straight. It was tracking to be up 10 straight weeks, which would have been the longest streak since 1985. But sell-off happened yesterday, and it definitely did not happen. A lot of people are thinking that the sell-off is, and this goes into IPOs and the crypto flush. People think that maybe the crypto flush is due to IPOs. But once again, like I said, I was sitting there speaking with Brad Olsen over at Benzinga. He brought up a really good point with crypto. Well, first of all, his point is that a lot of the mouthpieces for crypto or Bitcoin have started selling their coins. Mark Cuban came out. I believe he cited the Mark Cuban statement where Mark Cuban came out and he sold all his Bitcoin. Michael Saylor, who owns Strategy, he sold some Bitcoin. Strategy sold some Bitcoin, and people saw that as a big ripple effect. But Strategy still owns a ton of Bitcoin. But we've seen Bitcoin's hit level. We haven't seen hit since the 2020 or 2021. It's been a long time since Bitcoin's seen these levels below 60,000 right now. So it's just a very interesting thing. But people are thinking maybe they're taking money from crypto to prepare for these new IPOs coming out. Like I said, we're going to show the Elon Musk Jamie Dimon interview here in a little bit. So stay tuned for that. But just thinking about these IPOs coming out. So people are going to need money to fund these things. SpaceX is coming out like, I think, 1.7 trillion in their IPO, but they don't really have revenue. They're losing money right now. And the bankers are placing this out to people like, look at their 2030 guidance. That's when they're projected to earn money. One thing that did come out is that Google set to pay them, I think, $900 million a month to use some of their stuff for SpaceX. The other thing with SpaceX, and this isn't a case for SpaceX or against SpaceX, or just so you know, like, no stock recommendations. I can tell you when IPOs come out, especially here lately, and this was some of the things that David Snyder, who I had a conversation with, the mystery broker over CNBC, he stated in his research, he's shown that 5 years after an IPO, the stock's usually down. So that's something to think about and look at. Long story short, you'll probably be able to get these stocks a little bit lower than general, a little bit lower than when they come out. And he showed, I think he was citing ServiceNow as the one, or it was Salesforce, one of them that just came out, and it was like the 5-year mark, and you just saw where the stock had been down, which plays into, so there's another fund like Kathy Woods, she has an ARC Innovation Fund, and that usually takes in, first of all, high beta. So if y'all remember, we're talking about beta and alpha. A beta of 1 is pretty much mirrors the stock market. It's as risky as the stock market, but her stuff is way higher than 1 because it's new. They don't have growth. They have a lot of growth, but they don't have earnings per se. They'll have stable earnings. So it makes them higher risk for you to get your capital back and forth, and it's more volatile. And she creates funds like these. And she tells you ahead of time, like, this is a long-term investment. But that fund came out maybe like 5 years ago. It came out right around COVID, right around before COVID or right around during COVID. And it's really down a lot in 5 years. There are all these IPOs that are inside of them and high beta stocks. So it went up and now it's back down. So that's what you'll see. You'll see this initial rush where people are going out to get them. SpaceX, the second half of this year, which we're almost there right now, in the second half of 2026, sit there and let that marinate for a minute. This year is flying by. And then you have some set for the earlier part of 2027. We saw Cerebras come out. They make really big chips as opposed to other people who make small chips, and that's being really simplified for what they do. But they came out a couple weeks ago. That stock's down a lot from the initial price offering, but it kind of stabilized for. I mean, it's just following position of what it does. But generally with IPOs, so we're talking about IPOs in general, right? Generally with IPOs, retail investors can't get IPOs. They can't really get any shares. They'll go out, they'll have an IPO roadshow, these private companies before they come public. So initial public offer, IPO. Before they become public, you'll have these companies, they'll go out on what's called a roadshow and try to get people to invest. Yeah, they'll have round A, round B, round whatever. And the round is just how many different times they go out and invest. You hear people talk about the valuation. They'll say they'll say a series. Or did Series A at $100 billion valuation, right? So that means that's just like the first round, they went out to raise money. Whoever got it, if you got it, 10% is that $100 billion valuation. They do a Series B, then that's the second time gone out, and maybe the valuation's gone up. Probably the valuation's gone up, but they're raising more money, so maybe it's $200 billion valuation, and that same 10% will cost you twice as much to get it, to invest in. So that's when you hear people talk about those numbers and how they jump. But you have to remember, even if you're buying in at these valuations, say you're buying in where they're at, when they're doing these Series A's or whatever, like you take a couple like Anthropic. Anthropic right now is, I think, on like Series H maybe, or F or H. And so they've raised money, and every time the level they're raising at is going up, right? That can lead to people being diluted earlier down as to how much like your actual volume is worth, unless you set it up in your account, or you set up in the agreement that you set up that you can't get diluted, or you have non-dilution shares that can't be diluted, or someone else is losing every time you do round it, because there's only so much in the pie, and eventually there's diminishing return, because if you keep splitting up the pie, I mean, you create new stocks. I think that's kind of what Ron Cohn was talking about with GameStop. Maybe, I don't know. That's still, I can't wait to hear how that plays out, see how that plays out. But so with the initial public offerings, like I said, you go and then you get these rounds. But let's say you did buy in at even if you bought in at the H series, let's say you bought at the H series at a $1 trillion valuation for 10%. So 10 times more than the person who bought in at the $100 billion valuation for that 10%. But then the stock goes public in that initial bump. But they usually have lock-in times. So you can't sell these stocks immediately. You have to hold them for a while. But that's where you usually see that initial bump, right? So that $1 trillion company, and their companies don't come public at $1 trillion before. They used to not come public at $1 trillion. They're coming public at $1 trillion now. So these numbers aren't exactly crazy. But it comes out at $1 trillion, and then the stock sells, whatever price goes up, and now the company's worth 2, 5, 10 trillion on paper, paper stock prices. And you've 10x your investment. Or if you got in at the 100 billion valuation, you've like 100x it, so it's just, and that's how people make money with the private markets going public. And then you have employees who, in these situations, sometimes the private company stock are part of the compensation. So they may not even pay anything for these stocks. They may have been gifted to them. And those people want to sell those stocks sometimes because they need that money they've set and taken years of pay cuts, waiting for these days. But you have, like I said, you'll have lockup periods where people can't sell their stock. They'll have to be locked up for a little while. And 30, 60 days. And then you have periods, speaking of lockup periods, you have lockup periods before these companies can go into indexes. So like the NASDAQ or the S&P 500 back to SpaceX, SpaceX actually is structured very different. SpaceX is structured where like 30% is going out to retail investors. They structured their initial stock price at $135 per share. So, but I can tell you once that goes live, we're in the open market, that stock price is going to probably go way up to begin, goes way down. Elon Musk's probably going to pull out all his hair, but I would imagine it's going to go way up to begin, as people try to get it, supply versus demand. Well, SpaceX could eventually merge with Tesla and their Gronk. They have AI capabilities, and SpaceX does. I mean, whatever you say, I don't think rocket science is easy. They send spaceships up and they catch them on the way back down. So whatever that may be, there's some value in that. But they spend a lot of money, right? They're burning through capital, right? Hence the reason these companies are going public is because they need more money. Some of the reason these companies stay private is because they don't want people to see their books. There's less scrutiny. They don't have to deal with SEC regulations per se. They don't have to do public reporting. If you want to know more about public reporting, me and Brad Olsen, in one of our last conversations, actually talked about that, whether reporting less or more often is better for corporations and investors alike. But so back to why companies might stay public or private. And then once they go public, like I said, you get that windfall of cash. You need more money to invest, or you need more money. Maybe they're just in a huge deficit. They just need cash to meet their growth and revenue. Sometimes your growth outpaces the actual cash that you have, their cash flow and their burn. Like these companies are spending a lot of money for this AI race and build up. And I don't think it's cheap to send spaceships to space or rockets to space, low orbit satellites, all these things. And now he sent, I think it was 10,000. So that's the thing about with IPOs. Like I said, SpaceX IPO is definitely different. Also in the SpaceX IPO, we have the 30% lockup for retail investors. So you have platforms, I think like Robinhood is going to be housing that where retail investors can get. They are Fidelity dropped their minimum. So usually I think a minimum account has to have, it was like $500,000 to even invest in an IPO. They dropped that down to like $2,000 for the account balance so that people can, quote unquote, more retail investors can get handed this. One thing you have to realize is like Elon Musk and Tesla, that was like one of the original retail investor meme stock movements. And he has a cult of people who follow him. I don't mean cult in like the bad way, like dangerous type cult. I mean, it's a cult that's like, it could be dangerous because they create a lot of capital for Tesla, but I mean a cult following in that people love what he does. Some love him, some hate him. So it works both ways for Elon Musk. That blade cuts either way. And he wants them to have access because I think one of the big things that they were planning on, like I said, this is a little bit different, a lot different actually. They're already going to be fast-tracked into the NASDAQ 100 and maybe NASDAQ 300 indexes as well. So they're going to go into people's retirement portfolios. I actually had Samuel Brent reach out to me about that one over at Business Insider, see my thoughts on SpaceX quick inclusion into index funds, because that impacts your retirement if you have the index funds in there, if you have those NASDAQ index funds. Because generally what they want to see before they include companies into it, and the S&P 500 Global they're not going to allow SpaceX in there without the appropriate time. So S&P 500, you have to wait a year before you can enter, before you can be considered to enter. You have to have a profitable company, and you have to have a certain volume. Market cap. They're going to be fine with the market cap, but we'll see if they're profitable by that time. So there's no reason that they will be. I assume they'll be fine with the market cap. If they're not fine by the market cap by that time, they definitely won't be profitable enough to go into there. But we're assuming the market cap's still fine, and we'll see if they're profitable enough in a year to go into the S&P 500. But why this matters to you, Main Street, and anyone listening is that, let's say this company goes into your retirement account and you're a year away from retirement and it's very volatile. Tesla's already in the S&P 500, so it's already in your retirement account. Most indexes, I should say, because most indexes are some fund that mirrors the S&P 500, especially if you just have a target date fund inside your retirement account. So you probably have some exposure to Tesla is what I'm telling you. You probably have exposure to a lot of companies. But if SpaceX was to go in there, you have this volatility factor going up and down. That's usually higher than companies that are inside the S&P 500. They're inside people's retirement accounts. So you may, but I mean, it would be a small percentage, but that would affect retirees. I don't think it would impact their ability to retire unless it just grew into some oversized position. It just had some parabolic run and became part of that 40% that tech is taking up right now inside the S&P 500. But we saw that yesterday. We saw the swoosh back down when those things sell off. We'll talk about that in a little bit with the flush. But you also have, it's just going to be interesting. It's almost going to be like a case study because they are included in NASDAQ, and then some of the other things. So I want to talk about other things that are specific to the SpaceX IPO. I think there was reports or rumors or whispers that Musk wanted some of the banks that were using that they were going to use, like Goldman Sachs is helping to put out the IPO. Goldman Sachs, Morgan Stanley, Robinhood plays a part. I think they're playing a big part with the retail investor. Like I said, Fidelity's helping to where their people can get to, like retail investors they lowered the minimum, but they want these banks to use their AI. They want to so it's like, I don't want to say it's quid pro quo, but it's definitely, I shake your hand, shake mine. It's not the first time those type of things can happen. I don't think this is new to this type of deal, or it's the first thing that these happen. This type of thing has happened. At the end of the day, we know Wall Street's definitely about, they're definitely about their money. I don't know if you ever noticed, but Wall Street rings that bell, and whether the stock market's up a lot or down a lot, they're usually clapping their hands and celebrating because people make money on Wall Street both ways, when it goes up or when it goes down. And that's just a fact. It's just how it works. So like I was saying, I was trying to think if there's anything else just interesting with the SpaceX IPO this coming. So like I said, the 135, then we have the valuation gap. Like I said, if you and the retail investor, Elon Musk wants to give them access to this so that they can push it more. And, this is what I mean by like Main Street meets Wall Street, is that what he's doing is he helping Main Street meet Wall Street. And people always throw retail investors, like retail investors are uneducated, but that's just so far from the truth. So do they have the financial literacy? And my definition of financial literacy is different from whatever, the ability to evaluate, digest, evaluate, and then make informed decisions about what they're doing. Right. That's more what I consider what financial literacy is. Baseline. We can obviously go much deeper. I could write a paper on what financial literacy is, in my opinion. But you have the IPOs, like I said, and then you have the SpaceX. So it's just generally different. It's going to be different. It's going to be harder. I don't want to say it's going to be harder for him to fail but you saw what happened with Tesla. I think it will be volatile. I think it's something to be watched. I've told Samuel it'll be interesting to see like 1 year from now when you see the 1 year results, how that NASDAQ actually performed, because you can pull it out and see what the SpaceX portion has done versus what the S&P 500 has done. People also said that Musk may merge SpaceX, Tesla, and Grok together so he can reach his compensation package of $1 trillion, which will pay him up to like $1 trillion, if I remember correctly. But I think there may be some language in there where he may not be able to reach it by doing it that way, but he may. Either way, Elon Musk's last compensation package before this one, the one they're fighting in courts, was outrageous at the time, and people thought he could never reach it, and he reached it. So we shall see. But that's IPOs, just how IPOs are kind of broken down. So if anyone ever wants to learn more about IPOs, when you hear initial public offerings, that's just one of the ways. And that's not even including SPACs, which is another thing, because that's how a lot of companies have been going public lately. They're going public via SPAC. But I think we covered IPOs. Like I said, the crypto flush, I think, goes almost directly into the IPOs. It plays a part. And then like Brad said, you have the mouthpieces selling their crypto, selling their Bitcoin. But some of these people have held Bitcoin for a very long time. Bitcoin is reaching levels that it has not seen in a very long time. If you want to see some pros or cons to Bitcoin, we definitely have it covered on both sides of the channel. Some of the videos, some of the Bitcoin skeptics might make you not ever want to buy any kind of crypto. But we cover a lot of things on the channel. So we go real deep into the debt, the national debt, not just the actual debt, but what it costs to service the debt. So not the $39, $40 trillion it costs to service it. But we actually go deeper into the $160 trillion that it is to service the debt. And that's only growing every day, but we'll see. Also, that something that shouldn't go unmentioned is the fact that the Treasury started buying up long-term securities here recently. So Kevin Warsh is starting to put his fingerprint up. We have his first meeting coming up here next week, 2 weeks, in about 2 weeks. So it'll be interesting. I guess he'll probably give a presser since it's his first one, just to explain his stance, but I don't think he'll be giving as many press conferences as Jerome Powell. We also hear a lot of Fed governors now looking and market participants thinking that rate hikes may be the next way that the market moves versus rate cuts. So we'll just see how that works as far as direction. And that could also play into the stock market flush that we saw going yesterday. Because yesterday we saw a very strong jobs data. We saw a labor number that was double expectations almost. So the market is adding jobs. It was really a widespread jobs report. I don't know if the government can keep adding jobs at that rate, but we did see a strong labor report. And I think that in turn push the stock market to say, okay, all right, so maybe we're not going to get rate cuts, because a lot of this thesis coming in 2026, as it was with 2025, is that rates will be lower at the end of 2020. At the end of this year, you will have mergers and acquisitions, and the rates were lower from beginning of 2025 to beginning of 2026. But that rates will be lower. We see a lot of M&A. The one big beautiful bill will stimulate this whole economy. Everything will grow, and people will be buying things hand over fist. AI is going to grow us out in productivity like we never seen before. But you have to look on the backside where AI may cause a situation where productivity gains can cause inflation and force the Fed to cut rates. Another point Brad made, I don't know, we'll see, it could work the other way. I mean, we could just outgrow this inflation, but we haven't seen prices keep up, or we haven't seen wages keep up with prices. So that's definitely something to look out for, because if prices keep going up without wages, but a strong labor market is one of the things that will keep the country out of recession or keep the economy going strong. But GDP growth has definitely slowed here in the last, and expectations have been brought back in for GDP growth. We'll just have to see. This market is different. There's more economy that we speak in. And if you want to learn more about the more economy, I want like a 2-hour video on the more economy, where you just have massive allocation, you have macro impacts, you have momentum, you have operations, you have a resiliency and a realignment, and then you have earnings. Like, that's what was driving these companies and driving the economy. But on the flip side, in the more economy, it can break and flip really fast, because some of these companies in this velocity and this speed, they overgrow their actual earnings projections. Some people are looking way too far out. You have to ask yourself, so we saw a company like Micron, once again, not stock recommendations, but we saw a company like Micron that just shot up. If you looked at it from March, where it was below 400. And so just earlier this week, it was well over 1,000. I believe yesterday it closed under 900, or it will close under 1,000. I saw it, I think, under 900. But just the move in it, right? The velocity of which it changed, right? And this company in the more economy it's booked out with its data, and because they do storage, memory, booked out through the end of 2026. But with software, that's a cyclical type of trade sometimes, so it moves in big cycles. Value perceived, they got well above what is historically their multiple. So sometimes those things have to come back in. But the orders didn't change, right? We didn't see any orders change. And it could have been, once again, back to the IPOs. It very well could have been people taking profits as well to prepare for this SpaceX IPO, because the same investors, not just say because these companies may be in indexes as well, but the same investors who were investing in Micron and companies like this may have just taken some profits. Because, I mean, you can't be mad, you can't be upset with someone who entered that stock in March at less than $400 and sold it this week for 1,000, or trim some of their position. That would be prudent to trim some position. You got to keep some of these gains and maybe put them in lock them. So I don't know if you should take those gains and put them in an IPO, but it's prudent to trim that market position. But like I said, Micron is one of those companies, and it's just one of those things when market sentiment changes. Intel's another example. Intel's earnings were, before the Intel went on that parabolic run, Intel's earnings were 32 times. So their earnings were $1 per share. The stock was $32, and it went up to $130, $132. So their earnings went to well over 100. The price, not the earnings stayed the same. Price went up to 100 times earnings. That's way too high in the market. And that came back down with a whoosh, but they have a different floor. They're real more. They have a lot of, they're the American, for those listening, air quotes, first chip maker right now. So they do have a strong solid floor, I think. And there's a lot of movement in there, but they're getting other competition. And we're hearing a lot of these companies vertically integrating and taking care of some of these things themselves, like Google's making chips. I think Meta said they're making some. Meta can get out their own way. Once again, not stock recommendations, but Meta announced they're spending more capital expenditures on AI development, which may be the thing they need to do. I don't know, but their shareholders in the stock market did not like it. You know? So once again, not stock recommendations, but we see these things. And like I said, we saw the stock market flush. So could some of that money been from crypto? Also, another thing with crypto is you have the crypto winter that comes every now. I mean, people want to deny or say it is what it is, but the numbers point to every about 4 years, Bitcoin takes a big hit. And it's right there in the middle of it right now. So hopefully we'll get someone to come on and go deep into why you should buy crypto. This isn't me saying you should buy crypto. I just want to have someone, I want to have a bull on here because we have such a bear on here as well. So I want to have equal perspectives on crypto right now. But, you know, the bulls are a little quiet right now with crypto. So that's the flush with crypto. Another thing to notice with crypto is when events, and I've mentioned this before, when events happen over the weekend, like crypto may go way up or crypto may go way down because that's one of the only things that you can trade as well. So you can't trade equities. And you may have people who are trading Kalshi or the markets or something like that, but because those go all the time, but you can't trade equities or bonds or things like that. So people may just be trading crypto as well at that time. And you'll see that flush. Think back to when we first bombed back at the end of 2025. We bombed Iran. Crypto oil went way up over the weekend, but it kind of came back down, even back out. Crypto flushed, and then it kind of bounced back out because people were taking money from that to buy oil or buy futures. So it's just I want to say it's a circle. But when times get tough and affordability hits or people need money, and maybe for these IPOs or maybe just for the affordability that we're feeling in the world with gas prices right now, we're not even talking about the war. We don't have enough time to go into geopolitical with Iran right now. Because like I said, I want to play that Elon Musk interview with Jamie Dimon here in just a second. But here, so like I said, you have a crypto flush. And then we saw the stock market just move, perhaps on people, fears of returns from the AI investment. And AI investment, those big companies like 40% index, that's just way too much. We're seeing a rotation in the market. So we talk about the stock market flushing and the outlook. We're seeing a rotation in the market. We are seeing healthcare data okay comparatively yesterday or recently, you know, where we see the stuff going out tech. We're seeing healthcare pick up. I'd say I don't know if you look at the Spurs and then you look at the Spurs, you look at the Knicks, one is the IGB, like one's software and one's SMH and one's semis, right? They're the only, there was a point where there are only two players in this game right now because in the AI game, pretty much everything was made up in that ecosystem where people needed it. And it's like finals where you have to watch, those are only two teams in it. But we've definitely seen a move right now where people are broadening out their investments and looking for other sectors and internationally, shop to watch international. Because every now and then, international just comes back and makes some moves, you know, which goes back to the point of diversification. People, we need to have that diversification inside of our retirement portfolios. So, been talking for a while, been talking for well over about an hour now. Thanks for staying with me so far. We're about to get into this recording here in a second, but just to recap, you know, we were talking about the Knicks and Villanova and Brunson, so the leader of those teams, and how the Knicks have gone from the last time they were in the finals, 1999, where they were pretty much a growth stock. Now they're definitely more of a, you know, integrated, maybe like an Apple, where they're bringing in value. And then you have Wemby and the Spurs, who right now, you know, they are growth stocks, acquiring, trying to help meet their mergers and acquisitions to get to where they're going to right now. But they're facing some resistance. So they're down a couple games. We talked about IPOs, you know, SpaceX's IPO is coming up, Anthropic's IPO, OpenAI's IPO is coming up, which reviewed the Seabricks IPO, which just came out. Spoke about the history of IPOs and how David Snyder's research points out that 5 years after an IPO, they're usually lower. We spoke about whether crypto is a reason for this, the crypto flush, some of the reasons for it. Maybe it is investors wanting to spend money or building funds for these IPOs, for the SpaceX IPO, which is about to come out. We spoke in depth about the SpaceX IPO, but we're going to even look deeper into it here in just a while. And we just spoke about the stock market. So the stock market flush, some of the reasons, which can kind of be tied to it. I mean, investors, like I said, the stock market has been on a historic run. It's been on a very long bull run. Some would say a 17-year bull run. And even like the 9-week run that we just ended last week, where we were pushing for 10 to be one of the longest runs since 1985. That's just, the markets need to pull back sometimes, people. You have to understand, sometimes the market needs to pull back, and it might pull back even more as we go into this week. Like, you can see it deeper pullback. We're far from correction. We're far from bear markets. Markets have to move. And I think we still have a lot of consternation happening in our government right now. So that could be some things like we're not even talking. We haven't even really played in that as to why the stock market is moving. The other day, President announced or stated just when he was talking that the war could go out past Labor Day or up till Labor Day. So markets adjusted to that, the geopolitical moves. And then Kevin Warsh, like I said, he's coming in and he already started hiring some people. We'll see how the market reacts to that. And history has shown for maybe 6 of the last 8 and 5 of the last 6 Fed chairs, they've been tested by the market when they come in with some type of event. Now, even if it's by the market, I think Jerome Powell had COVID not too long after he came in. And then there's just a lot of things going on. And a lot of people just in this market realize that we're almost, I mean, they say irrational exuberance all the time, referring to this market, and people saying invested, maybe people should be invested. You should be invested. I shouldn't say maybe people shouldn't be invested. You should be invested, but you can't. You have to be invested in a very smart way. You can't just go invest in something because everyone else is investing there. You can't invest in something because it's the hot thing at the time. You need to know what you're investing in. You need to know your why, right? So I said I was going to speak about the Knicks, and maybe the Knicks are the IGP, right? Maybe they're durable, man. These Knicks, your assets. You're thinking of the large cap software, maybe some dividend playing stewards, but they also have the defensive side, right? You got the cybersecurity or broad indexes. They provide you some systematic consistency in there. They're not going to dunk on the market every time, you know what I'm saying? They're not going to dunk on people, but they provide reliable compounding points growth needed to secure retirement. And then, like I said, the Spurs, they may be a little bit more like SMH, a little more aggressive, Their assets, you got to think of semiconductors, high growth techs or emerging sector funds. They are, to win beyond them, man. These dudes come over internationally, like I said, you got to have your international exposures come over from France. He's taking the world by storm. Massive upside could drive your portfolio and your alpha, but they require the Knicks score to keep the portfolio stable. You know what I mean? While the market flushes. And the Knicks, I don't know. Is this the new blueprint? We'll see. So, like I said, you just have to understand how this mix is applied to you. Are you a younger investor? You're an older investor. When you heard Wemby speaking, he was referring to how the Knicks are an older team that fought and they've lost, but he also spoke how they're not intimidated by the Knicks. Just because they're young. I think he didn't even know the fact that they were like one of the youngest teams in almost 50 years. That stuff doesn't matter. Once they toss up the ball, it doesn't matter whether you're the first guy or the 15th guy. When they put you on the court, you're one of the 10 guys on the court. So you got to play and fulfill your role. So and then the 2026 market outlook. So I'll probably recap that a little bit more. I want to give you a couple tips here at the end. Also, while we're sitting here, just take a second. If you hadn't hit subscribe to the channel. If you haven't listened to any of the old podcasts, you should go on over there and check those out. We got some real cool stuff happening over there. And yeah. So we'll get over here to the Elon Musk. Whoops. Starting right there. Give me a second. We'll go over here to their interview, and this is run on Musk's platform. So X, like I said, no politics here. We've had stuff from CNBC, Fox News. We've shown all the platforms. So no politics here. But I do want people, because there are a lot of people who may never hear this interview, may not even get to hear them speak from their own point of view, their own perspective. So I want you to hear from the people who are bringing these initiatives to the world. Some of the leaders in AI and finance, these people are going to go down in history for our time. So good or bad, they will go down. So it takes time, sit back, maybe get you a beverage.
Of the nowhere near where you go generally in space, but as high as we can get in New York City. But before we get started with you and Jamie, we had a very special guest that wanted to welcome you here this afternoon. And so your mother, May Musk, is here to welcome you.
Great.
May, please stand up.
I don't think you can see me or everybody here. Or you
They can see you. Yes,
Okay.
he can.
This is your party.
I actually can't see my mom, but I can hear her certainly. Yeah.
Okay.
Oh, there you are. Okay.
So what I'd like to say is when you were 3 years old and I told people I have a genius son, they would roll their eyes. And then
Sure. Well, understandable, frankly.
I knew. And then when you said you wanted to start with rockets, then I rolled my eyes.
Sure.
And then you did it. And so this is just a great party here, and we're celebrating.
Sounds
Love
good.
you, love you so much.
Love you too.
One proud mama, please.
So let me privilege to have this for us, but it's an important thing, the trajectory of American innovation. You know, we're here live, 3,500 people of our top individual investors around the world are in 100 branches. There are 350 people here, 3,500 around the country. This is a very unique thing, by the way, because Elon has spoken to me about democratizing finance. This is part of it, treating individual investors the same way institutions are treated, and hedge funds and all those things. So, my view is it's a wonderful thing to do. Elon, very brave, by the way, because I would never let my mother speak publicly when I was in the room. God knows what she would have said.
I had no idea she was there, actually.
But Elon's the Edison of our time. I remember visiting Elon in Tesla like 15 years ago. A whole new way of building cars, vertical integration, which had not been anything remote what our car companies are doing. Now you have SpaceX. I visited the SpaceX factory in California, and it's kind of exceptional to have more than 650 rockets. And you told me one today, putting satellites in space. You have 9,000, almost 10,000 Starlink satellites up there. Starlink 3 is coming, which is a whole new generation, which hopefully will replace some of these undersea cables. It's been an extraordinary 24 years with watching Elon grow over time, and now making a massive leap into the future. So welcome and coming here. Elon, I have 10 questions for you. So I want to make sure I get to each one. Some of them came from folks here. They're all kind of important. But one, just to start, is why SpaceX public now? Because you had choices, you didn't have to. Why now?
Yeah, I've been asked for many years about taking SpaceX public. So it's probably been, I don't know, almost 10 years that people have been suggesting to me that I should take SpaceX public. We've been positive cash flow for quite a long time. I think since around 2014, 2015, and we've been self-funding. In fact, in our sort of private equity rounds, they actually have not been fundraising rounds. They've been liquidity rounds for investors and employees, because we give everyone at the company stock. And SpaceX has actually bought back stock in most of our sort of funding events. So what's different about now is that, well, it's a number of things, but we are embarking on a significant growth phase, like a capital growth phase, where we are going to put in orbit probably 100,000 satellites, probably over 100,000 satellites just for communications. And these will be of the version 3 and beyond versus version 2 and version 1 that are currently in orbit. Version 3 is, depending on how you count it, 10 to 20 times more capable than the version 2 satellite. And there were 3 chips that the SpaceX chip design team taped out that are specific to this, that are far beyond state of the art. Which means it's 100 times more bandwidth than the SpaceX Starlink system currently offers, and also half the latency, because the altitude will be about half the altitude. So I think it will actually be the highest bandwidth, lowest latency means of communicating. And the future with AI and robots is actually going to require a lot more bandwidth than we currently use. Because you can imagine, like, what's the bandwidth of a human? It's peak bandwidth of a human is a few hundred bits per second, but bandwidth of a computer can be 1 trillion bits a second. So the appetite for bandwidth of AI AI robots is going to be enormous. And then we're also doing the AI data centers in space, which is another massive capital endeavor. But I think it'll be the primary means by which AI can be expanded. It's increasingly difficult to build power plants on the ground. There are very few people who want a power plant in their backyard. So if we wanted to, say, double the electricity usage of the United States, which is on average about 500 gigawatts, we would have to build about twice as many power plants, which I don't think people are, well, most communities are not super excited about that. But actually, if we go to space, we can go far beyond the electricity generation of Earth. In fact, this is going to sound kind of crazy, but you could actually increase harnessed energy by a factor of 1 million and still be using much less than 1/1,000,000th of the sun's energy. So the current human civilization uses much less than 1 trillionth of the sun's energy output, which is kind of humbling to think about. We're really a tiny, when you see the true size of Earth relative to the sun, we're a tiny dust mote in a vast darkness. And the sun is enormous. The sun is 99.8% of all mass in the solar system, and most of the remaining 0.2% is Jupiter. Sometimes people ask me, I'm sort of maybe going a little wide-ranging in this answer, but because they just asked me why you're being public now, I'm like, I'm like talking about the sun's power output. I'm like, sort of a long-winded answer. Yeah, if I was an AI, you might tell me to, okay, but also, but it is important. Like, some of these things are kind of important because people sometimes wonder, what's the future of energy generation? And I could say that it is absolutely solar power, or maybe a better word for solar power is star power. It's the power of a star. And the crazy thing is that if you burnt all mass in the solar system that was not the sun, the amount of energy produced by the sun would still round up to 100%, because the sun is 99.8% of the mass of the solar system. Even if you teleported 2 more Jupiters from another, somehow teleported 2 more Jupiters from another solar system and burnt them too, the sun would round up to 100%. So it's very much the sun. And you can, you could scale to 1 million times Earth's economy in space in terms of harnessed power, which is a good proxy for economic output, and still be much less than 1 millionth of the sun's energy, which is humbling, really, to think about how tiny we are. And this is just one star among many. So I guess the TLDR, it would be, we're embarking on a massive new growth phase, and we need capital for that.
Okay. Okay, number 2.
Another thing is the revenue. I also feel pretty good about the revenue projections. Meaning before, revenue was a little unstable. But now I feel like the revenue's much more predictable. Yeah.
I always learn listening to you, I guarantee you. So when people hear about multi-planetary species, travel to space, one of the most exciting ideas in human history. Can you explain the bridge that you speak about? I've heard you talk about from the Earth to the Moon to Mars.
Yeah. Yeah, so you don't necessarily have to go through the moon to get to Mars. I just think that we can build a self-growing city on the moon faster than we could do so on Mars. And there's also the potential, if you say you want to scale far beyond what you can do from Earth, is that because the moon has no atmosphere and about 1/6 Earth's gravity, you can use an electromagnetic accelerator, a railgun or mass driver. Basically, you don't need to use rockets to do AI data centers into deep space from the moon. You can literally just shoot them like a railgun type of thing. And you can manufacture the solar and the radiators, solar power and radiators on the moon from moon materials. That would allow scaling potentially to beyond 1,000 terawatts a year, which is a truly staggering number. Like I think we can do 1,000. I think we can do probably somewhere around 1 terawatt per year of AI space compute from Earth. But we can do 1,000 terawatts or more from the moon. And like I said, we can also make a moon base. And I think it would be pretty cool if you could, vacation on the moon. Like that would be the most epic vacation, like not everybody wants to go to the moon, but I think a lot of people do. I think it would be pretty amazing to sort of, obviously provided you could do so safely. And come back safely and everything. But I think that will be possible in the future. And then Mars is another step beyond that. That's Mars is a whole planet, and with gravity much closer to that of Earth's, and it has an atmosphere, albeit it's an atmosphere. And if you warm up Mars, you could one day make Mars like Earth, meaning with like liquid oceans and life, and where you could walk outside without a spacesuit type of thing. So Mars is I call Mars a fixer-upper of a planet, but it's got a lot of potential.
Let me go to number 3. But I never ever thought you'd be in the hospitality business.
Yeah, absolutely. We should have moon hotels, don't you think? Yeah,
Musk hotels.
Well, it could be other. Actually, you think of us more like we're kind of like the Union Pacific, when they built Union Pacific back in the day, people thought they were crazy because, like, why are you trying to carry all this cargo and people to California? No one's there. But now California is the biggest state in the country.
Not for long, but yeah.
Admittedly, it's self-defeating.
Yeah.
Yes.
So Starship, you built it, unbelievable ship. I think it's already had 12 flights, I read. But obviously, technically, it's just hard to do. What were some of the breakthroughs you had that people should know about that they don't know about?
Well, our webcasts are very good, so I recommend anyone who wants, if they want to learn about Starship, the SpaceX website or any of the Starship live casts are a great way to learn about it. But the fundamental breakthrough of Starship is that it will be the first orbital rocket that is fully reusable. So this might sound like an obvious thing, but because in every other mode of transport, whether that's aircraft, cars, bicycles, horses, you name it, ships, these are all, we take it for granted that they are reusable. An aircraft journey would be very expensive if you had to throw the plane away every time. And that's how rockets have been in the past. But it's very difficult from a technology standpoint to achieve full reusability for a rocket. We've got part of the way there with Falcon 9, but we'll get all the way there with Starship. And once you achieve full reusability, then it's simply a cost. It's simply the cost of access to orbit is just the cost of propellant, because now you can reuse all aspects of the vehicle. And the propellant we use for Starship is liquid oxygen and liquid methane, which is the cheapest propellant you could possibly get. Just literally get oxygen from the air and methane from natural gas. So the cost of propellant for Starship will be less than the cost of jet aviation fuel, which means that you should be able to actually send cargo to space for less than the cost of cargo on an airplane going on a transoceanic trip.
Unbelievable. Starlink, another thing that has been amazing, global communications. We already mentioned Ukraine. You had mentioned to me that V3 would maybe be able to replace some of these cyber cables, which, by the way, is a huge security risk for all of us because several have already been cut in the Baltic Sea. So what's the next view for Starlink, both V3 and maybe V4?
Yeah, so the V3 satellite is a gigantic, and you can look it up on the internet, is, as I said, it's 10 to 20 times more capable than V2. It's a very big satellite. In fact, it can only be launched on Starship. It's too big to be launched on any other rocket on Earth. So Starship has a 30-foot diameter cargo bay. The V3 satellites are, they're about 7 meters, so about 22 or 23 feet wide. So very, very big. That, like the size of a small bus, essentially. And there's a bunch of technical details about, we have much bigger phased array antennas. We've got more KU ground links. We've got more of our laser. Our satellites communicate with each other with lasers that we developed and manufacture. So it's got a lot more lasers and more advanced lasers. It's also got W band and E band. I mean, these are kind of technical details, but it's got a lot of. It's like a crazy orbiting radio station.
Okay, and doesn't Starship do like 12 of them or 15 at once?
Well, it should be able to do 50.
50.
Yeah, because Starship V3 is aiming to do 100 tons to orbit with full reusability, and then Starship V4 we're aiming for over 200 tons per mission, and then being able to launch every hour.
So next one, data centers in space. You've been talking about that. Other people have mentioned it, but obviously it has different technical capabilities. It's colder up there, it's less vibration. You also got to get the data back to the Earth by some method. I think you mentioned to me lasers in good weather and bad. And so how hard is it to do now that you've looked at it for a while?
We don't think this is a particularly difficult thing to do. In fact, we think it's easier than our communication satellites. Like quite a bit easier than our communication satellites. The Starlink V3 communication satellites is an incredibly complex machine. The AI data center would be much simpler by comparison because it's really just solar power plus radiator, some basic equipment for operating the satellite, and then the laser links which would connect to the Starlink communications constellation, and then back and then to the ground. And the connection would happen no matter what the weather is, because once you connect via lasers to the Starlink communication constellation, the Starlink communicates to the ground with frequencies that are cloud penetrating. So they, in fact, even roof penetrating to some degree. So you would always be able to close the link with the data centers.
Right. Talking about America, one of the big things here, we've been talking about the reindustrialization of America for a long time, bringing back advanced manufacturing. Now you're talking about building the Terafab, building chip fabs in New York. What compelled you to do that now with all the other things you're working on?
Well, we try to, so what's the limiting factor? And the limiting factor, what we see as the limiting factor is being able to make chips, both logic, memory, and packaging. I mean, it's worth noting that there's not a single high volume computer memory fab in America right now, zero. There's one being built in Idaho by Micron, but that will not reach volume production until I believe 2028. And we built it in New York, but they are in, I think, 29 and 30. And this is a tiny fraction of the memory that's needed. And in fact, even if you take the best case assumptions of the memory makers and the logic makers, it is not enough to meet the demand that is anticipated. Which is why you're seeing, stocks of like Micron go to, I think, 1.2 trillion, or it's some quite high number. So there's just clearly a need for AI logic, memory, and packaging, AI computers essentially, that is far beyond what even the best case assumptions of the existing market do. That's why we need to do the tariff fab. Yeah, it seems like essential. Otherwise, there will not be enough chips.
I'm going to do one more on some of the stuff you're building, and then a little bit more on other issues. AI strategy. You've also took Grok inside into SpaceX. How does that fit into this platform you're building?
Yeah, so we do intend with our SpaceX AI satellites to allow people to put whatever GPU or TPU they want. So if NVIDIA GPUs can be put on it, Google TPUs can be put on it, Amazon Trainiums, or any other chips that you want to put on can be put on. We will also offer our chips in the future, and I think we also want to offer our software, our AI software as well in the future. But it will be such that you can run anyone's AI on hardware or software on the Tesla AI satellite, SpaceX AI satellites. Yeah.
So the next three are completely different. I'm going to mention each one. I'll ask you each one, but one's about his view of patriotism, his service to this country. One's about culture and bench. How do you actually build these wonderful companies? Because a lot of people here have those issues. And then kind of leadership. And I have a very specific question about that. But first, I'll start with patriotism. You've served this country. I know you're a patriot. You've spoken about it. How do you view your role of being an American patriot, helping the United States?
Yeah, I mean, I'm incredibly pro-American. And frankly, always have been. So SpaceX does do a lot of work for what used to be called the Department of Defense, the Department of War these days, I guess. We have a division called Star Shield, which provides military communications, and there's some other stuff that's kind of classified. I guess we can't talk about that, but we are helping the Department of War and Intel, part of the government. We're a vital element of that. Yeah, I mean, I'm just super pro-America. Always have been.
Thank you. Culture bench. Brett and Gwyn have been with you for 15, 20 years. I know you've built a huge bench in SpaceX. How do you keep it going? What's important to you? How do you make sure you keep the best talent?
Yeah, I guess Gwyn was, I think, around the 7th person to join the company, and that was 2002. So it's been like 24 years. And generally, the senior executives at the company have a very long tenure. I think Brent Johnson's been CFO for 15 years. Yeah, so I think because people really believe in the mission, I think they want to stay and they want to keep building it. Like we want to make humanity a space-faring civilization. We want to, take humanity to Mars and the Moon and ultimately beyond. We want to it's like science fiction, make it real. So like, go to places that have never been explored before. Like make Star Trek real.
That was one of my favorite shows.
Yeah.
Excellent. And then last one, you've built multiple companies. How have you changed from maybe 20 years ago? Maybe I should ask you guys, how have you changed from like when you started to today, lessons you've learned, how you've changed both as a leader and as a person?
Well, I think I'm probably more chill than I used to be. So it's probably a little. I'm way more laid back than I used to be, which I'm still not that laid back, but but more than I used to be, for sure. One of the things I found over time, and I've mentioned this before, is that like in terms of like recruiting people to the company or having people work at the company, like their individual abilities and their intellectual capabilities matter a lot, but also it also matters if they have a good heart. Like it's not just about whether somebody has certain IQ or whatever, but like just are they like a good person? That matters a lot. So I don't know. I guess I've learned a lot. Although I feel like I still have a lot to learn and make a lot of mistakes. But I suppose I think like maybe the future AI will say like not bad for a human.
Listen, before we thank Elon for coming, I just want to thank him. Just watching him build companies, and I can't wait to watch the next 10 or 15 years about what you accomplish and what you dream of, and getting to Mars and building new businesses and being creative. So, Elon, I want to thank you on behalf of everybody for coming here, sharing your ideas. There are brochures out there about the whole SpaceX thing. But Elon, thank you.
Thank you. Thanks for having me.
Yeah, so that's the full conversation. And someone may ask, why in the world would you put that full conversation up here? First of all, I say this, and I don't know if people realize it, like, don't let politics or personal influence get in the way of investing, okay? Stock markets up to the right, regardless. Sometimes it's down. I shouldn't say it's up to the right. Historically, long run stocks go up to the run, up and to the right, regardless of administration. So regardless of red or blue, because investors and these long-term investors are more concerned about their money than they are concerned about who runs the country. It does play something in the short term, but also it's rare that you get a chance to hear, quote unquote, two of the most powerful men in the world sit down and have a conversation like that. So you need to sit down and take your time to listen to what they're saying. If you're going to invest inside of a company, if you're looking to invest inside SpaceX, Elon Musk just sat there and made his case to you. That's why you should. So sit at it objectively and decide if that's something you want to do or if it's something you don't want to do. Not an endorsement for SpaceX stock, one way or the other, or Tesla or any of Elon Musk companies. But there's a chance that you have to sit there and listen to it, right? Because these are all things that you should take in. Like I said, I listen to Jerome Powell's speeches at the end, every FOMC meeting, because I want to hear what he's saying. I want to hear how he's saying it. I want to hear, I don't want the media filtering it through to me, trying to tell me what it means. But I've learned what these things mean. So when I hear them and the signals and the filters, like what I'm looking at, what these things mean. So I don't want other people to tell me what this means. I don't want to lose my own agency in understanding things. So, we'll sit there and listen to, and this was like I said, it was part of the road show. It was like part of one of the big finale parts, maybe getting closer to the end. But you have Elon Musk and Jamie Dimon sitting there, and you don't get those two on the record out loud together very often. I'm sure they say a lot of different things behind closed doors, but you don't get those kind of things outside very often. So 10 questions with Elon Musk, that was actually, and about SpaceX. So take that information, digest it if you want to invest in it, or if and find, so it's not just Elon Musk, time back to the IPOs, but all these companies go out and do this. So all these companies have interviews like this too. Like Anthropic's CEO has one like this, Sam Altman has them like this, so you can find them, and as they get closer to the IPO dates, there will be more of them. So we have a chance to actually listen to someone who owns a company or who is the CEO of a company you own. Do it. Like, sit back and listen to that. You can probably turn some of that noise and nonsense off of the TV. I don't want to say it's noise and nonsense because everyone needs to nerd out or just veg out, quote unquote. Just let your brain go free, and watch mind-numbing things. But if you really want to be, the algorithm you're listening will control all your money when these people are speaking, and as well as institutions and hedge fund managers, they're listening. So like I said, everyone knows my mission is to help Main Street meet Wall Street. So you have to sit back and digest some of this stuff. Sometimes you have to sit and listen. And you all know that I'm all about actionable steps, right? So you got to think about like this, like the 401k is the Main Street bedrock of your financial life. And yeah, guess what? We're going back to the Knicks. The Knicks and the Spurs, you know, they're professional athletes. Elon Musk, Jamie Dimon, some of the richest men in the world. But you're the general manager of your own retirement account, of your own household. Your 401k isn't just an account or whatever, however you may have your retirement set, whether you're investing in real estate, however you're invested, set yourself up for long-term retirement. It's your long-term team roster, right? So you're building your team. So there's just some questions that you could ask yourself, you know, just going and tying back to the 6 topics. No, so building up a grit. Like investing isn't about the biggest win. It's about the grit, the consistency of being able to stay in the game and contribute through all these bear markets, right? The Knicks are on a winning streak now. Like I said, this series isn't over with, but they had a losing streak during the season. Teams have winning streaks, teams have losing streaks. Is your 401k or whatever retirement account you have strategy built on Knicks style? Habit of consistency, you know, consistent in your contributions, or are you gambling more a little bit high stakes growth? Is that what you're looking at? Then we look at the Wimby path, you know, that man's an alien, you know, a stock that is, you know, a high growth tech stock that's holding, but it needs some support, you know, it needs constant cash flow. Like you heard the richest man in the world right there just speaking about how they need cash for the things that they're doing for their companies, right? So do I have a balanced roster, diversification, or is my 401k like too heavily weighted to these growth stocks and these alien stocks? Like I said, we have nearly 40% concentration in some like 8 stocks inside the S&P 500 got that high. So that's too high of concentration risk. And we have videos of concentration risk as well. Check out the channel. We got so much stuff on these things. So, and then the IPO. So IPO SpaceX, which is big, you know, the big shiny things, the rookies, you know, they're volatile. They lack the history. And now they're in a 401k. So I don't know, maybe these definitely have to be like some spice that you're putting in there, sprinkling on the top, but they can't be the main course. Like, they just can't be the main course. Like if you're offer shares in a hyped IPO, you know, are you buying them because you understand the fundamentals? Like, did you look at that video and sell something from that interview, or looked at some technicals because people can say what they want to say, looked at some information. I know it's not publicly available, but there are ways to find information and saw what you want to see and like think that, or even his thesis that they're going to build data centers. Like a lot of what he said with Tesla was that full self-driving cars, right? And his projection for that has already passed, but Tesla stock is still volatile, but people really don't even talk about the full self-driving cars anymore. They kind of bring it up. But so do you believe in, are you investing there? Are you believe in investing in Elon Musk, or you believe in investing in, I don't know. That's for you to decide, but you need a thesis, right? So, or are you just buying the hype? Are you buying it for a trade? Are you buying for investment, right? Are you going to buy it in the morning and try to get out of it later? That's another thing. Ooh, let me speak about that with the IPO, with this, for retail investors that retail investors usually aren't used to. Companies like Fidelity, I think one of the things Fidelity said is if you buy the stock and you sell it within 60 days, 30 days, first, I don't think you can. But if you try to sell it within 30 days or 60 days, you'll get a warning, and then maybe you won't be able to buy it into the next IPO. But it's like after 3 times, like they take your social security number and like you might get banned from Fidelity. Like they want people not to sell these stocks because that's part of the reason people worry about with IPOs is that with the IPOs that people are flipping them so fast, they want people to hold them. And then with these being included into that index, the NASDAQ so quickly, that could really throw off some retirement savings. So I did want to point that out with the IPO and the lockup time and the Fidelity. If you buy that and you try to flip it, you're going to get hit. So be careful. The crypto flush, right? Volatility, you know, is a risk and it's a test of temperament. And flush that we saw in crypto, did you pants sell? Not crypto in general, but like when these things come in life, are you going to pants sell, or you want to sit down and reassess where you're at, or you just going to readjust where you have? And when the market flushes, you know, do you have the patience to hold on to what you believe? Like I said, is it time to double down, or is it time to expand? If you thought the Spurs were going to win the series, you know, and you still believe in the Spurs, nothing's changed in spite of the Knicks winning 2 games in San Antonio, but you still believe Spurs, like, right? And definitely not telling people to, like, you should have even more conviction, even though they're down to in the Spurs, because nothing's changed, right? Or maybe you're just oblivious to reality. I don't know. We'll see. I think that series still has a lot of games left in it. I don't know. And then the stop flush, right? So we also have to remember that it's June, so it's the middle of the year. A lot of portfolios are definitely getting back into position. There will be some rebalancing in the quarter. So you do your own personal rebalance and just make sure and see what you're holding. And wonder if you're holding too many of these high flying stocks. It's just something that's going to make your portfolio go way up or way down. If you're close to your retirement, you probably can't handle that volatility. Or if you're already in retirement, maybe you can't handle that volatility if these are funds that you need. So think about that. And then the outlook, right? Retirement isn't a one-year game. So your 2026 outlook should be about whether your current strategy is going to go out in 20, 30, 40, 50. So how far out does this tie into it, right? You set up the building blocks. You don't build a house that's only living it for a year, right? You build a house to live forever, or to stay, I don't want to say forever, but stay for a while. And in that house, you have to do upkeep. You have to do maintenance. You have to maintain that house. But you build that house with a foundation that's built forever, right? You want it to stay forever. Maybe you add rooms, maybe you add a deck in the back, maybe, I don't know, maybe you do something different to your landscape, but the foundation of your house is the same. And then if some natural disaster comes through, a tornado or a fire is not a natural disaster, it could be, but something destroys that home, you can change some of the things when you rebuild it. Maybe, I don't know if y'all have seen Batman, Dark Knight series. Bruce Wayne burns down his house. Spoiler alert for those who haven't seen it. Although that movie might be about 20 years old now. That movie's definitely got some age to it. Great movie. But anyway, he burns it down, and when he builds back up, he's like, now's the time for us to make some upgrades. So you just gotta, what does your playbook look like? Like, that was, the whole thing was burnt down. Is it time to start from scratch? Was it? Well, it actually was his doing. Spoiler alert for anyone who hasn't seen that movie. You should see it. It's way too late. But so, those are just some actual things that you should think about and steps you should take. I love these Saturday sessions where I can just sit back and kind of just, take my time and share things with everyone, like what's going on, what's happening in the world, what we've been seeing. I just released the episode with Brad Olsen, part 1 of it. Part 2 is coming out soon. It's just such a wide range of conversation. He's the chief content officer over there at Benzinga. It's a great conversation that we have. We're going to have some things for y'all. Because Benzinga, they're great over there as well. They love Main Street. So if you check it out, there's a link in there where you can check out some of their research. Their Benzinga Pro. It's cool stuff over there. So we've been sitting there talking about Benzinga. Let me actually share their site here for a second. So like I said, we've had the Benzinga conversation with Brad. It just came out. The Invest America accounts are out. Well, they're not out, but a lot of people miss sign up for them. They go live July 4th. So they may be out, depending on when you listen to this, to where you can fund them and where they will have the initial $1,000 funding. Benzinga is a really cool site. You go in there and you check it out and just see some of the great things they have with their research. Then we have the newsletter. So just released the latest edition of the newsletter. The latest edition of the newsletter we're covering, actually, we're coming up on 30 years of Tupac Shakur's murder in September. It's actually about to be 30. His birthday coming up as well. He passed away, I think, 25 years old, but just the impact that he had on society and actually the economy, some of the things he tried to tell the world, as well as inside that same issue, it's called Greed is Good. We have the Gordon Gekko comparison, where we go deeper into that. So it's a really fascinating newsletter as well. Check that out if you want to. And it has some of those interviews as well. So it has an interview with Brad, has the interview on the AI bubble with Mr. David Snyder. Yeah, we're just trying to be an outlet for people. People don't want to maybe plug you in or let you plug in. So sometimes you just have to create the outlet. I've been watching a lot of financial channels, other people's channels here lately, and more power to people and the message. Like, I see people spreading a lot of great things. Like, I see people making people take action, having people take action to at least ask questions about their financial situations. But I am hearing some real, fuzzy information coming out from some of these people. And I mean, some of these people with the biggest followings. I'm obviously not going to say anyone's name or anything like that because they probably wouldn't hear it anyway, but it wouldn't matter. But just be careful. Do your own research as well. Like, even if you're sitting here listening to me, I have no problem with going back and looking at anything I've ever said or anything I say. Check it out. When I say something, misspeak on something, because I will, I would love for you to let me know. Like, I want this to be a community where we can speak and grow together. Let me know. But like I said, so when you're bridging this 401k or your retirement account, your IRA, or if you're already retired, you're trying to figure out what you know with Social Security, we do have the ABC Squared. You can check us out over there. That's my business. So that's a place where you can find me. And we have the website, actually have a website covering a personal website. So if you ever want to check that out, we have that. And then we have the Monarch Money. So if you want to try out Monarch Money, we have an affiliate link with that as well. So you can go check out Monarch Money and see some of the things that they have going on. Monarch Money is another cool place, another cool tool. So it helps you with your budgeting. It helps share your budgeting with different people, with your different individuals. This is a personal website that I'm about to share with you right here. So if anyone wants to check me out, if they want me to come speak to a group or anything, I'd love to come speak to your group or do a little bit closer thing, maybe moderate a panel, or if you're looking for someone to come bring content. We are trying to get this spread out to more people, right? We need more people in the world hearing these things and from different voices and different people, because it can get numbing to people to hear the same thing over and over again, if that's all you hear. Or if you only hear from the same person. You see it when you coach kids, like these kids say they won't listen to their parents as much, but then someone else can say it and they're listening to it the whole time. Parents definitely get frustrated with it, but it's a thing. Like I said, so yeah, that's the personal website right there. Some of the interviews, some of the things over on YouTube. Check it out. And then you see that's AI right there, because I'm right here. How can I be checking that? But some of the things on the website, and then we have just take a second here, because I guess people probably forget that I do have a business. Even though that's not really the purpose of this, the purpose of this is really to spread information to help people learn financial literacy. But sometimes people are a little bit past the level that we're speaking about, high level stuff. Like I said, I can't give you personalized financial advice. I can give you some broad information that works, but I can't tell you what works for you personally because everyone's situation is different. But if anyone ever wants to check out, holler at me. Here's the company website right here. So the ABC Squared. Like I said, even there, we're helping Main Street meet Wall Street. We have some of the media, have some cool calculators over here. Most powerful force in the universe, Einstein, so not Einstein, it's compound interest. So people who are looking just, and then, if you ever want to book a meeting, you can do it right here from this page. And we're partnered with Altruist for security over there. So that was, a little shameless plug for the company and for myself. But if anyone wants to connect and use, the services that I have or do provide, I would be more than happy to help anyone from Main Street meets Wall Street. It would be my honor for someone to reach out and say, hey, I saw your show or saw an episode and really want to work with you now. But the main thing is that you take this and share this information with the people that you love. Like, that's what we really want to do. Share it with the people who need this information. Been going for about 2 hours now. I think we've covered a lot, Main Street. I think we've covered quite a good bit. Let me know what questions you have. Let me know what's on your mind. I love these Saturday sessions, like I said, where I can just sit back and take my time. It's not so macro, micro focus. It's just more on questions that I've been receiving throughout think when you start watching this video that somehow that Chris Jenkins shot, which I'm just now getting over. I don't know why I brought that back up from today. Just now getting over from it. Just now getting over, could lead us all the way to how this stuff plays in 2026 in the market. So the outlook, like I said, with 2026 is choppy, still a little more volatility. I think we'll probably be higher by the end of the year than we are right now. But that's with the dip to come. There's some volatility to come, and that's based on historical patterns for one thing, and the fact that earnings were really strong. We saw strong earnings, but we know there's geopolitical tensions and consternation that could be coming in the upcoming days and upcoming months. There's not resolution with the war. We'll have to see what Kevin Warsh does, how he's received by the markets, how his policy actually works, and if he can even get the rest of the governors on the board to agree with him on his direction and his policy, because he is the chair and that's a powerful person, but he's only one person on board of 12 other voting members, I think 19 total governors. So you have to realize that there's a lot inside what Kevin Warsh has going on. We'll see what's happening with the NBA finals. Like, who would have thought, the Knicks would be up to? I don't, maybe the bet money went that way. So yeah, I think it's just been a wide range of conversation where we covered the sports, Knicks, Spurs, IPOs, how they work, what you can look for, cryptos flush, stock market flush. And then, like I said, the 2026 outlook. If you time in the market, not timing the market, usually calluses that you'll see in midterm years, these are usually the worst years. This year is like the worst year inside the president's second term, and it's usually the worst year of presidential election. There are different reasons usually in this term, like the House and Senate may flip, like there's one party loses control versus what they already had. So there's more consternation. A president may become a lame duck, quote unquote president. So the administration may lose power in this term. But once you may see bumpy roads up until the end of the year, right to the election. But then once the election and we have some clarity, and that's assuming we have clarity from the election, right? That's assuming we have clarity from the election. Once we have clarity from the election, from the end of November until like the beginning of the year, and even some at the beginning of the year, you should expect to see the stock market return and go higher again. So that's based on just kind of how history works for the stock market in midterm elections, midterm years, and the earnings that we have projected. So listen to these calls, listen to the people you may not want to listen to, because that's just nonsense sometimes, like not for the political points or anything, but they're talking about money while they're investing, how they're investing, or maybe you're just going to say, I think that's completely wrong, and invest on a contrarian point of view, right? Because there are ways that you can invest if you think SpaceX is going to zero or whatever. There are ways you can invest in that too. And I don't even mean short and stop. Be careful, short and stop. But there are different ways that you can invest if you think the price is going down. I appreciate everyone who sat on here with me for this deep dive. I think it's been a great one. I feel the value. Hopefully you all found some value in this. Like I said, subscribe to the Main Street Meets Wall Street podcast. Give it a 5-star review. Listen to it. Download it. Spotify, Apple, all the places you get your podcasts. We have the nice international audience going on as well. So shout out to the international audience. Thanks for everyone tuning in. Like I said, Main Street Heart meets Wall Street Smarts. If you're playing the 2026 game like it's 2021, you aren't investing. You're just donating your capital. That was 2026 market mastery. We cut through the noise. We got a deep dive into the SpaceX IPO. We saw the full Musk Diamond interview. If you want to start guessing and start building, here's some things you should think about. First, the shiny object, SpaceX IPO, everyone's talking about it, the retail allocation, and the cold hard truth. Wall Street loves retail liquidity because they think it's dumb money. You got the IPO truth. Now, how do you handle your portfolio this week or any investments that you're thinking about? Actionable steps. The election volatility, think about it. We may be in a lame duck period, but don't expect stability until we hit clear political milestones in the coming months. It could be choppy, but a lot of money is made in volatility. Stay your course, have your investment thesis ready. Geopolitics. Keep your eyes on those commodity charts. When headlines spike, look for the contrarian entry point if that's something that you do. When oil goes up, stocks should go down. We'll see.
This market's been different. The Fed factor. Listen to the rhetoric on the Fed board, specifically regarding the Warsh policy shift. Don't trade on the rumors. Trade on the voting record. And then the 401k stress test. Look at your top 3 holdings. If you can't explain their business model in one sentence, are you just holding hype, not grit? Is it time to flush it or fix it? Don't rush any brash decisions. Now, if you go over and check out some of the information on the Wall Street South Journal on LinkedIn, bookmark it. Also, check out Benzinga Pro. Check out the affiliate link where I may receive a commission if you use it at no extra charge to you, but Benzinga Pro. Everything we just discussed, the IPO traps, the election cycle, the macro uncertainty, the crypto flush, is exactly what the world's most powerful thinkers are debating. You've seen the vision. Now you had the playbook. If that must-diamond debate changed how you are looking at your cash allocations, those 10 questions to Elon, how we're seeing stress testing portfolios for the next month ahead, go ahead, have a productive week. Stay disciplined. Be ready for the next audit. You know we're coming. There's plenty of content on the channel. Share with someone you love, someone who needs to hear this. Keep growing the Main Street meets Wall Street movement. That's the full picture, from the IPO traps and the crypto-driven liquidity flush to the macro shifts define our path through these midterms. Remember, the goal of this isn't to predict every tick in the market. It's to ensure that when the volatility hits, your portfolio is structured for resilience, not regret. We covered a lot today, but the work happens when the market's open, before the market's open. Take that meal checklist, stress test your holdings, and ensure your strategy aligns with what you're going for in the rest of 2026 on the 2080, not where you've been. Don't forget to check out the Wall Street South Journal, the Main Street Meets Wall Street podcast, and subscribe to Marcus Sturban's YouTube channel if you found value in this video. Thanks for subscribing. Part 2 with Brad Olsen from Benzinga be dropping soon. Main Street Heart, Wall Street Smarts.
Let's just establish that. The reason you're in debt is because you don't have money. The reason I owe on my truck is because I didn't have the money to pay cash. If I had the money to pay cash without destroying the integrity of my other financial plans, why would I borrow? Why would I borrow for a house if I just have the cash to pay for the house? Now, yes, you can get into the whole, well, using other people's money and time value money and interest, whatever. You have debt because you don't have the capital to pay cash, period. So until you can have the cash for the emergencies, for the urgencies, and for the things that other people make you feel are important right now, until you can have the cash for those things, you'll always find yourself in the cycle of debt. So I'm a firm believer that getting out of debt starts with having cash first.
Why is it that two people can have the exact same amount of money, the exact same investment portfolio, and the exact same financial advisor, yet one retires in total peace while the other lives in a constant state of market-induced panic? The difference isn't in the math, it's in the machinery. Most people treat their lives like a series of random events, while the elite treat it like a repeatable system. On Main Street, we're told to work hard for our money, but we're rarely told how to build a system that keeps us from sabotaging it. I'm Marcus Sturban Sr., and today we're looking at the blueprint behind professional excellence. I'm joined by Johanse Harrison, who's cracked the code on behavioral alpha, the measurable value of keeping your cool while everyone else is losing theirs. In the first half of our conversation, we're pulling back the curtain on how to systematize trust. And this is whether you're an entrepreneur trying to grow a business or a family trying to grow a legacy. We're moving past the what of investing and getting to the how of high-level execution. If you're tired of reacting to the headlines and ready to start installing an engine of growth, you're in the right place. This is Main Street meets Wall Street. We don't just talk about the markets. We talk about your life. Let's bridge the gap. Main Street Heart meets Wall Street Smarts. 10% market return looks great on a spreadsheet, but it doesn't mean a thing if a 20% behavioral mistake wipes it out in a single afternoon. Most people spend their entire lives chasing the perfect ticker symbol or the next hot sector, completely unaware that their own psychology is their biggest hidden tax on their wealth. On Main Street, we're taught to watch the numbers, but we aren't taught to watch ourselves.
I'm Marcus Durbin Sr., and today we're going behind the math to find your invisible edge. I'm sitting here with Johannes Harrison, who's mastered the art of behavioral finance, behavioral alpha. We're tearing down the headline noise of 2026 to show you how to build mental guardrails that protect your portfolio from your own emotions. If you ever wonder why your financial plan feels solid until the market gets volatile, this is the episode you can't afford to miss. Johannes, it's great to have you here. You built a career around the idea that technical financial literacy is actually incomplete if you don't understand the person behind the money. We see people with the right data still making the wrong moves. Why is the behavioral side so often the missing piece of the puzzle for the average investor?
Marcus, thanks for having me here. It is exciting to be here with you today to spend some time. My Charlotte native, Carolina in the house. Let's get it. Shout out to those boys up there. Since they're in the shot, we'll go ahead and say what's up to them. I need to put a Hornets basketball up there. It has nothing to do with your question, but actually has everything to do with your question. But I want to say one thing just in case this episode comes out a little sooner than I think. I'm still technically a CFP candidate. No, it's okay. It's okay. I passed the test. I got the experience. I just got to wait for the official results to come out and pay that fee, which supposedly is happening next week. So depending on how fast your editing team does, we good. But yeah, got all the components. So my message about sports teams has everything to do with the technical piece of finance. Because we all know, for those of us that follow sports, we all know those teams that have all the technical pieces and that should win championships. Or they'll have all the technical pieces, they should just win the game tonight. But then something goes terribly wrong. Is it started to rain and it didn't plan on rain? Is it that someone just had an argument with their spouse the night before? At the end of the day, what I'm talking about, the things that get in the way, is emotions. Emotions wind up destroying the best laid plans because we as humans are emotional creatures. And the thing I really want you to understand about emotion is the word motion. We tend to do things because we feel a certain way. And that can, as you said in your intro, can destroy the best plan of making a 9, 10, 11, whatever % rate of return and all get blown out in a day or two because of emotions forcing us as humans to want to do something because things aren't going our way.
Gotcha. Yeah, emotions, and that's good stuff. I mean, people generally, logically, you want to sell high, buy low, but emotionally, when we see the market go down, people tend to do the opposite. They tend to sell low and then come back and buy high, jump in and out of the market. Trying to time the market is not a good plan, not a good move. We'll get deeper into you and like you said, the Charlotte connection a little bit later on. We're coming out right now for those listening. We're mid-April, and we just came out of, since February to April, a deep correction. Well, it wasn't a deep correction, but 10% pullback. People were worried everybody's hair was on fire. What were you seeing, and how do you feel that your behavioral approach with your clients helped in this time? Were your phones ringing off the hook, or did they already know the plan?
8%, or probably 99. Let me do one. 99.5% of my clients already knew the plan. But there's always the few stragglers out there. And funny enough, the stragglers were the people that had the least need to even be concerned. Meaning, had they actually, because they didn't look at their portfolio out of fear, but had they actually looked, they would have seen that they're fine. And what I mean by fine is that I believe that we manage portfolios for risk tolerance or loss tolerance is usually a better way to say it. I manage portfolios for loss tolerance, not a return. So we will only get the returns, those higher returns that are sought after, if they have a high enough loss tolerance. So the clients that unfortunately were a little concerned, their loss tolerance was low, so they weren't getting the same result that they saw in the news. And that was my conversation with them. It was like, what do you think's happening in your portfolio? Well, I'm hearing that the market is down. The S&P is, as low as it was, and fill in whatever time frame it was, November, October. Does that mean I've lost everything since October? I was like, well, let's look and see. And they pull up and look, and I was like, well, I haven't lost anything. I know. Why is that? Because you have a very low loss tolerance. So we design your portfolio in that way. And that also means that when you hear that the market recovers, because it will, I didn't know it was going to happen 2 weeks later. I said, but when you hear that it recovers, don't expect to participate in that either. And it's like, well, what if I want to? No, because you cannot have one without the other. These are lock steps. If I step with the left foot, then immediately after I have to step with the right. And that is the relationship between this volatility and risk in the returns that you want to seek. And then I also say, you don't need that much money anyway. So please find something else to do with your time. I usually wind up quoting Kendrick Lamar and I say, just turn the TV off. Turn it off.
Man, that's interesting to say when we're both from North Carolina.
I mean, I can also say, take your shirt off and wave it around your head like a helicopter. That'll make you feel better.
No, I'm good. I feel you. And the emotional side, as you just explained. So, and that's another thing. Most people mention is risk tolerance. You mentioned it's like loss tolerance, right? How much can you stand to lose? And when you're not losing as much as the market, you're not going to get as much on the upside when the market goes up. And sounds like you do a good job explaining that to your clients and people who come on board with you. I want to dig into that a little bit in a second, but I have a thought here. You know, I'm huge on financial literacy, right? But financial literacy without the behavioral aspect, that's incomplete, right?
So the first portion of financial literacy, if you pick up go to some of the top experts in the area, and you ask them about financial literacy, they're going to begin with behaviors. They're going to begin with helping people understand their biases, and some of their money scripts that are already ingrained in them, that they picked up as a child, that they picked up as a teenager, that they picked up when they were first introduced to this wonderful concept called money. So because of those ingrained behaviors and biases, until you can learn how to rise above those, think through them, or even repurpose them, all the other stuff, time value of money, the different types of taxable versus non-taxable, etc., none of that will matter until you can overcome your preconceived notions and relationships that you have with money. So I believe behavior is actually step one. And even if we think about from a cash flow, whether it's day-to-day, week-to-week cash flow, month-to-month, or even a retirement cash flow scenario, you can't out-earn bad budgeting. So, and that's true whether you have a job or you're talking about a portfolio. If you are bad with your budget, if you have more money going out than coming in, we can't solve that by just making more money, because you'll continue to have more money going out and coming in. It's a spending problem. It's a habitual problem. So that has to be repaired first before any of the other things will have a lasting effect on the portfolio. It's like and we've all seen it, when you have an individual that lives paycheck to paycheck, barely getting by, and then they get a raise or they get a bonus and they find ways to spend that as well. And so they continue to live paycheck to paycheck no matter how much money they make. That's a behavioral problem.
Right.
So until that can be repaired, they'll continue in that same cycle all the way through their retirement.
Oh, that's deep. And that's so true. And that's one of the things, like when I sit down with my clients and we're talking about building up, depending on where you're at stage of life. Because like you said, if you're spending $110, but you're only earning $100, or even if it's $1 million and you're spending 1.1 million, you know, like you said, the amount doesn't matter if your cash flow is negative. So we're talking about like things we should establish first, right? First, you need that emergency fund. Then work on paying off that highest debt, right? Interest rate. Some people prefer the snowball method. Whatever method you prefer, work on paying off the debt. They'll usually say, why not pay off the credit card debt first? That goes to your behavioral set right there. Because if you're already in the habits of running up this credit card, you'll get close to paying that credit card off and something's going to happen. You won't have it in cash, right? And you're going to put it back on the credit card and you're right back there again.
Yeah, it's a scarcity mentality. The way I like to share with it is share on the whole credit card and debt concept is the reason you're in debt is because you didn't have money. Let's just establish that. The reason you're in debt is because you don't have money. The reason I owe on my truck is because I didn't have the money to pay cash. If I had the money to pay cash without destroying the integrity of my other financial plans, why would I borrow? Why would I borrow for a house if I just have the cash to pay for the house? Now, yes, you can get into the whole, well, using other people's money and time value money and interest in it, whatever. You have debt because you don't have the capital to pay cash, period. So until you can have the cash for the emergencies, for the urgencies, and for the things that other people make you feel are important right now, until you can have the cash for those things, you'll always find yourself in the cycle of debt. So I'm a firm believer that getting out of debt starts with having cash first. I freak clients out sometimes. So I'll meet, clients every now and then, usually referred. It's like, can you really help out my brother or really help out my sister? They got some debt they need to pay off. And it's like, okay, that's not so much my line of work anymore, but I want to help people. And I'm like, okay, I'll help them out a little bit. And then I'll tell them, hey, for the next 90 days, you're only going to pay the minimums on these cards. Oh, but the interest and this and that and the third. I say, yeah, but your bank account has $8 in it. You put all that money on that credit card. You know what's going to happen tomorrow. You're going to wake up with a flat tire. How did you know that happened last week? I said, because it tends to happen to people that live in a scarcity mentality. You'll be surprised how the amount of emergencies that happen when you have money surprisingly tend to go down. But when you don't have money, you're living in fear of the emergencies all the time. So you're giving that energy. So guess what? Universe just lets it show up for you because you're looking for it. It's the whole seeking you shall find. You're looking for problems. And so the problems keep showing up. But if all of a sudden you start looking for solutions and the solution is I'm going to have this money set aside, for some reason, the amount of problems start disappearing. It's not more money, more problems. It's not what they meant when they said it in the song. They were talking about something totally different. It's actually when you have more money, it helps reduce. You have the ability to cover those problems, or they are not problems. Cars break. They're not built to last forever. So it is not yet. Is it an inconvenience that you have to change your tires? Sure. But tires don't last forever. It only becomes a problem when you don't have the money to pay for the tires. When you have the money, it's like, oh yeah, it's time for new tires.
Right. So when that's when you seek the problem, you'll find the problem. It's a conversation me and my wife have far too often. If you're looking for a problem, you can find it. Same thing with me. If there's something you're trying to find, you'll uncover it. But also what you mentioned, these people have cash reserves, the ones who don't see these as emergencies. What is an emergency? I was quoted in an article with Newsweek a long time ago, and it was speaking about a mother who's wanted access to her full-grown daughter's bank account at any time that she could just take out for emergencies. And yeah, man. And the daughter was like, I don't think that's good. And I was saying, like,
privacy, geez.
Right. And I was like, one of my big things is what is judged as an emergency, right? Different people see different things as an emergency. So if you have the funds to get those new tires and you probably already budgeted for them, that's not really that emergency when your tire goes flat, right? You mentioned something that a lot of people probably don't hear a lot, money script. Can you elaborate on what the money script is? And then can you tell us a little bit about what your money script is?
So a money script is an idea, or it's a thought process that has embedded into your mind, into your behaviors as it relates to your relationship that you have with money. So some unfortunate money scripts that some people have adopted and still believe to this day is the concept that money is the root of all evil. When money itself is just a tool. Money, it isn't evil. That's like saying that a shovel is evil. Well, I can be evil with the shovel and knock you across the head with it. Now that makes me evil, not the shovel. So money being the root of someone's evil acts. No, greed is the root of their act, or envy is the root of their act. It's not the money itself. Or the concept of money doesn't grow on trees. Tell that to an apple farmer. If I'm an apple farmer, I sell apple. My money absolutely grows on trees. Actually, one of the first concepts of money back in the day, in the old days of South America, were cocoa beans. Money literally grew on trees. Okay. And I believe that money does. I mean, the idea of my money making money is the same idea of an apple tree producing apples. So the money tree concept, I actually believe that. So those are money scripts. That's how the relationship that you have created with your money, and then how that influences your behaviors today. So I believe that we all have the power to rewrite our money script, but it starts with, as we mentioned earlier, understanding what are the biases, what are the behaviors, what are the thought processes, what are the emotions that have already associated with money. Some people have emotions, like I said, greed, there's fear, the envy, scarcity. Some of those things were ingrained in us when we were very young. It was ingrained in me when I was young because I watched my family, my parents suffer financially for a long time. I woke up one morning and our car had been repossessed. And my father didn't know how to explain to me that what had happened was that he didn't make the payments for 3 months. I'm running around like my hair's on fire, like, oh, Dad, somebody stole the van. And he's like, just take the bus to school. I'm like, but someone stole the van. And, it became a moment where he's getting heated with me, like, bro, just take the bus.
Yeah.
The bus is gone already. That's why I usually drive to school. Why are you so calm about this? Well, because he knew that the car had been repossessed. So, but that also came into my life where this scarcity aspect made me want to buy and consume as many things as I could because I thought I wouldn't have money in the future. But I had to, it took me, as a financial advisor, I've been a financial advisor for 25 years. So I spent the first 10 years of my advisory career with bad money scripts and poor financial habits, making great money though. I was saving, I was putting money in my 401k, I was doing that, but my bank account, oh, it would sit near empty all the time. My credit cards would sit with higher than average balances all the time because I was constantly, and I was playing the whole keep up with the Joneses, another money script, because I was in those situations where, oh, I finally have it now. I want to enjoy it because somebody might take it from me. So I had to work through that. And that's the same thing that I do as a financial advisor, is to help my clients understand what are those values, what are those behaviors, what are those goals that you already have, and what are the biases around those? Why is it that you're coming to me saying, hey, I don't know if I'll ever be able to retire? Well, you didn't just realize that yesterday. How long have you been sitting with that? Sometimes they've been sitting with that forever because they watched their grandfather or their grandmother or their mother or their father work until they die and never have a sense of retirement. So they think they have to sign up for the same thing. So I know it took a long trip to get to that, but that's what money scripts are. And that's how I help people kind of work through it.
Got you. No, take your time, man. This is great information. Main Street needs to hear it. Like you said, you've been doing it for 25 years, and it took you 10 of those years to even realize that you were caught into your money script. You're like your own, what is it, test patient zero alpha case going through there.
What was the hair club man? Hair club for men? I'm not only the president, but I'm also a client. Yeah, that one.
Gotcha. Yeah, man. So you talk about your business, your financial planning firm. Talk a little bit. Let's go. I told the listeners that we would give them a chance to learn a little bit more about you. So let's go, like you said, 25 years. Talk a little bit about how you first got into business, then how you went into your solo practice. And your practices, heard you on podcasts, we spoke before, it's crazy with referrals. Talk about that referral engine, that process. So no rush.
Yeah, the referral engine began very early on. So I started my financial services career at Nations Bank as a teller. And as a teller at Nations Bank, part of my role was to refer business to the personal banker for loans and refer business to the financial advisor for investing. And this was in the late 90s, so the heyday of the dot-com era. And in referring that business to the broker, I was very interested in what the broker was doing because, we had these mutual funds and this was all phenomenon to me. And also back then, CDs were paying like 6 and 8%. So there was that as well. One day I just kind of wised up and I said, well, wait a minute. I got a t-shirt for referring $1 million. What did he get? And my branch manager was so graceful. She said, you know what? He wants to meet you. And so I went and asked him, simple question. I got a t-shirt. What'd you get? And he showed me his paycheck. And his paycheck was for 2 weeks was more than I made in the entire year. And I said, I'm in the wrong part of the bank, aren't I? And he said, yes, you are. So I was, I think I was 19, about to turn 20 at the time, still in college. And I got referred into what then was Bank of America's training program for brokers for Series 7. And this was shortly after the Nations Bank and Bank of America merger, which I'm sure you remember back in the day, or you probably remember NC&B, North Carolina National Bank. And then that became Nations Bank and then Bank of America. Well, in that whole corporate commotion, the training program I was in was shut down. So I experienced my first layoff very early on. And from there, I just wanted to work for any financial planning firm that would hire me. The problem is that none of them would. Edward Jones said no. Merrill Lynch said no. Payne Weber said no. Morgan Stanley, all of them, any of them. I went to every single one and they all shut the door in my face. And their reasoning was trifold. 2 of them they said out loud and one they didn't. I kind of knew it inherently. Number one was I had no what they call natural market, meaning I didn't know anyone with money. So if I got started as a financial advisor, I didn't have an uncle or aunt or grandparents or anyone I could turn to say, hey, give me. And I also didn't have peers. All my peers were still in college. So most of them said, come back later and when you can find the market. And then the college thing came up. I didn't have a college degree. I was still working through that. And then the third one that was unspoken, but I knew it because we could pick up on these things in the questions they ask. Sometimes these interviews is I was a young black man in an old white man's world. I never got interviewed by anyone remotely brown or even female for that matter. So I knew that it was going to be an uphill battle. But that was also around the time that monster.com came onto the scene. And I had the ability to upload my resume and have access to jobs anywhere in the United States. And when I did that, I checked the box for financial services and I wound up getting an email from a small company, maybe you heard of them, American Express, financial advisors. So American Express had merged with another company, IDS Life, and created their financial planning arm. And they gave me an opportunity to join the firm in one of 3 cities that were creating a new employee-based financial planning department. And so my choices were to leave Charlotte to go to either Boston, Dallas, or San Francisco. In my mind, Boston was too cold. San Francisco just sounded expensive. And Dallas and Charlotte tend to be on the same like latitudinal line. When I looked at the map and I said, I'll go to Dallas. So I quite literally put all of my stuff in the storage. At the time, my girlfriend was also pregnant. So I put all my stuff in the storage and drove to my first interview and made it to the second interview and then the third. And they basically said, if you pass your Series 7, your Series 66, and your Group 1 life and health insurance license, you get to have a job. But if you fail a test, you are fired. And I said, what y'all don't know is I am an awesome test taker. And so
Standardized.
yeah, so I was able to pass all 3 and was able to start my practice, but I still had the same obstacles to overcome, that I did not have a natural market. And a lot of their training was based on going through your natural market and asking them for referrals so you can start to build your practice. And again, I didn't have that. Didn't know anyone with money. I was in a brand new city, didn't know anyone in the city. And so I learned this referral script that was given to me, and anyone that was willing to have a conversation, I would offer them the referral script. And so I started to build my own market. Now, fortunately, since it was American Express, they also had some American Express leads. We would get the crap ones, of course, because we were brand new. And it was smiling and dialing, pounding the phones for 13, 15 hours a week, waiting for someone to pick up and try to convince them to come into an appointment. But anyone that was willing to talk to me or come in and meet with me, I would also ask them for referrals. And I got really good at getting referrals from people. And as a matter of fact, I was able to get some pretty prominent referrals from one young lady who now, from her referrals, the ongoing referrals from those individuals are somewhere around 60% of my practice a day. So over 300 clients a day, 60% of them I can all trace back to one person.
Nice.
Who referrals from referrals from referrals from referrals. So somewhere in there, my son was born. I got married, moved to California, went into leadership, spent the next decade in leadership, not really growing my practice anymore. Just kind of held on to the same 60 or 70 or so clients. Started to get a little fed up with my life I created and the relationship that I had with now my ex-wife and my son, and the splitting the time and all that stuff. And then also building a new relationship with my wife today. My mother had passed away. My father wasn't doing too well. He had a stroke. I'm trying to help my sisters manage their way out of the house and things of that nature. And I just realized that I'd lost myself in the process. And in that, I decided that I didn't want to be in leadership anymore. However, my leaders wanted me to be in leadership because I was a valuable leader, and we were at an impasse. And I said some things I probably shouldn't have said to one of my upper management, my regional directors, and he decided to fire me. And so I found myself in 2014, after almost 14 years with American Express, and then became Ameriprise. I found myself in the unemployment line. And meanwhile, I had this core group of clients who had been with me for 13, 14 years that didn't really like the new advisor that they got assigned to. And so they were still calling me like, hey, what are you doing? Are you going to go somewhere else? And I didn't know what I wanted to do because I'd spent so much time in the firm. So I was lost for a little while. It took me about 9 months to finally say, okay, let me start my own firm. And that was thanks to a mentor that I'd had over the years. I finally called him up and he said, I've been waiting on this call. Because of course, I was in Long Beach, California, still kind of a small town in a big city. So everyone knew. And so he had heard the news that I was gone. And when I called him, he said, this is the day I've been waiting on. And so he sat me down and said, here's how you build your own firm. And I think in my mind, I'd made it up to be a lot harder than it really was. He was like, no, some paperwork. Fill this out, get registered, find a custodian that can hold your money, and you're off to the races. And so it took me about 30 days, and that's what I did. And then called all those previous clients, and the right ones came back. And then I sat down with one of those prominent clients from early on in the day. And I said to her, she's an emergency medicine doctor. And I said, hey, I think I want to focus on emergency medicine physicians. If you were me and you were starting a new financial advisory practice and you wanted to focus on emergency medicine, how would you go about doing it? And her response changed my life. She said, what are you doing this weekend? know, what am I doing this weekend? She said, come with me to a conference. It's called the Women in Medicine Conference for Emergency Medicine. And I'll give you a few minutes to say a few words. Okay. So I'm kind of a smart guy, I like to think sometimes. So I said, okay, what's the best thing I can do in this situation? I'm going to be a man in front of a bunch of women. Some of them highly educated, or all of them highly educated. Some of them making good money already because they're already practicing physicians, and others that are still working their way through residency. What can I talk about? I decided to talk about the pay disparity that exists in emergency medicine, which is real, still is real to this day. Not as bad as it used to be, but still is real. And apparently it resonated with the room because there were about 30 women in that room. 10 of them became my clients.
Really?
And they started giving referrals, and they kept giving referrals. I just got back this week from an emergency medicine conference out in Seattle. There's about 800 emergency medicine professionals, some of them residents, some of them medical students, and some of them, of course, attending. I've even started a podcast called Becoming an Attending, where I interview emergency medicine doctors, and they talk about their transition between medical school and residency, and becoming an attending, hence the podcast Becoming Attending, wherever you get your podcast, by the way. So that's out there. So part of my role now is becoming just this voice in the emergency medicine space, because I've been working with emergency medicine doctors for 25 years. So I kind of get their vibe. I understand the struggles that they go through, and they happen to make pretty good money. So, you know, we both make a pretty good living together by working with each other. So the referrals is really just about, number one, serving my current clients well, letting them know that I'm here for them and that I want to help them, helping them work through their own money scripts, their own biases, et cetera. And then just saying to them, hey, you were referred to me, and that's how this works. And if history repeats itself, will be excited to refer me to someone else that you also want to see do well for themselves. And so now it's to the point where the referrals come in unsolicited. I still ask via email once a year, but most of them just come in unsolicited. When I went to the conference, my clients that are already at the conference, they're dragging people to my booth. I set up a booth, pay a few $1,000s to have a booth there. There was 3 financial planning firms there. Mine constantly had people at the booth talking, meeting, greeting. The others, people would stroll by every now and then, but they didn't have that excitement there. And half the time I'd look by their booth, the advisors weren't even there. They got bored. Whereas I got to sit at or if I'm not at my booth, I'm getting texts. Where are you? I'm at your booth. I want to introduce you to someone. It's like, bathroom? Can I get a minute? So, but that has come from the culture that's been created around that concept.
Man, that is a beautiful story. See that, and that's a thing that people miss. Like in there, there were a couple big things that people should take away from that. One is that you had a mentor who helped you and gave you, it sounds like he gave you the game, sat down, just explained to you, this is what you need to do. Listen to what I'm saying and it'll work. Especially when it came to setting up your business, because people spend a lot of money setting up RIAs, trying to figure out the way to go about it. And 2, if I'm doing back in the napkin math correct, you got 180 clients from one person with referrals, right? Can you, that's outstanding. And it shows that you care, because people are bringing other clients to you, even unsolicited now. So do you think you could even can you walk someone? So say advisors listen to this as well. So say there's an advisor listening to this and they want to know from the first meeting, because it sounds like from the first time you talk to someone, you're pretty much letting them know that you want referrals, or you work best from referrals, because that's Maslow's hierarchy as well. If your advisors out here worried about their shelter and those type of things, they can't take care of you. So there's basic needs need to be taken care of. So can you dust it off and maybe explain, if I met you as a referral, what would that look like? What would that conversation, how would it?
So even if I know the answer, some of the best questions you can ask is the one you already know the answer to, because then I can spend some time, because I know what I expect them to say, but I can spend some time focusing on how they say it, their body language, etc. So even though I may know that you were referred to me by David, I'm going to ask you as soon as we meet, Marcus, who referred you to me? And go ahead, play with me here. Marcus, who?
David.
Oh, yes, it was. Wait, how do you know David?
Oh, we played ball together on Saturday mornings.
Okay. Is this something recent? You still play, or?
Yeah, we play, old man ball every now and then.
Okay. So you met him on the basketball court?
I met David at the ER because I got hurt playing basketball.
Okay. I actually spent some time in the ER. I got hurt playing basketball as well. Actually broke my hand. And I was an idiot and kept playing too. It's fine. Kept going. By the time I'm done, my hand is the size of 2 hands, and found myself.
I literally done the same thing.
That's good. Oh man. Well, David's awesome. Yeah, he's there. He's the admitting nurse there at the hospital, right?
I don't know what he was. I think he should be running the place. He was pretty
He
on top
does.
of
He
things.
does practically run the place. He does. That's awesome. That's awesome. All right. Well, Marcus, I'm glad we get to spend this time together to talk about your finances. And, you know, what I'm hoping is that since, as David referred you, that you're going to have a lot of the same experiences in our relationship that David has had. And you'll be excited to tell other people about my services as well. Right now, let's talk about you. So what I did there is I established a rapport back to the person that referred, helping you solidify that the only reason you're here, the only reason you had access to me was David. Okay. And then I just very gently nudged you to say, hey, you know, if this goes well, you'll be wanting to shout this from the mountaintops as well. That's it. I've laid a foundation, a groundwork. You understand you were referred, and I've let you know that you're probably going to refer me as well. The ask now, at the stage of my career where I am now, I don't have the need to grow as fast as I did in the past. So my ask now will come to you 2 or 3 months from now in the form of an email. And that email will be after we've set up some accounts, we've done some stuff. It basically says, hey, this has been an awesome journey up to this point. It's so excited to work with you, Marcus, and help you reach your financial goals. As I mentioned before, I work primarily on referrals. You were referred to us by David, and my hopes is that you can think of someone that may be interested in my services. Here's what I'm looking for. Now my ask in the email says I'm looking for medical students that are transitioning to residency students that are transitioning, or not students, but residents, well, they're still students that are transitioning into an attending, or a brand new attending that's facing, you know, the financial questions of how do I manage my life at this new stage. So if you can think of anyone that fits in those categories, if you would send them an introductory email, CC me on that email, and we'll take it from there. I appreciate you, Marcus. I'll see you in the next session. So that's the email that you get from my assistant. I don't even send the email, but every person gets that email at least once a year. Nice. And the referrals roll in. Now, that's what it looks like now. In previous times, that would be a conversation, Marcus, that I would have with you, very similar to that conversation that I had with that doctor almost 10 years ago when I went independent. And I would say to you, Marcus, let's pretend that you are a physician. Actually, let me back up a second. Find a niche and double down on growing that niche.
Yeah, I was going to mention. That wraps up part 1 of my conversation with Johann Harrison. We covered the invisible edge and how to build a referral engine based on trust, but we're just scratching the surface of what it takes to master your financial psychology. Before we sign off, I want to share some incredible news with the community. Our LinkedIn newsletter, the Wall Street South Journal, has officially crossed 1,200 subscribers. Just started a couple months ago. So those 1,200 professionals and families who are choosing market data and headlines over noise every week, thank you for your trust. If you aren't part of that group yet, head over to LinkedIn and join the conversation. It's the best way to stay updated on the trends we're tracking in real time. Also a big part for your mental mind state. Now you want to make sure your notifications are turned on and you've hit that subscribe button, because part 2 drops next week. In the second half of this interview, Johann and I dive deep into the 2026 market landscape. We're talking about everything from the SAS Apocalypse to the psychological tug of war between people with Bitcoin, gold, and how to ensure you aren't passing your own financial anxieties down to the next generation. You don't want to miss the conclusion of this podcast. I'm Marcus Dermott Sr., and this is Main Street meets Wall Street. Main Street Heart meets Wall Street Smarts. I'll see you back here next week.
It's the middle of May. If you're a sports fan, you know it may be the best time of the year. We got NBA playoffs kicking off, deep into the semifinals. Major League Baseball is going. The NFL just completed the draft. The Detroit Pistons and Cavs are just wrapped up Game 3 by the time this airs. Cade Cunningham's leading the postseason in scoring. OKC Thunder is setting the pace in the West. The Knicks have a 3-0 stranglehold on Philly in the playoffs, but you don't get a second chance if it's a bad rotation in the playoffs. The same is true for your money. As of this morning, the national debt is right around $39 trillion. We're hitting a new trillion in less than 150 days. That is the definition of dilution. Meanwhile, Ryan Cohen, CEO over at GameStop, just put over a $50 billion hostile bid takeover on the table for eBay. Is he trolling the board? He's auctioning off personal memorabilia to prove a point, and he's testing the limits of corporate Mo Green maneuvers. We're watching a total decoupling. Gas is pushing $4.50 nationally because the Strait of Hormuz is effectively closed. Commercial traffic is down a lot. Today we bridge that gap. This is going to be a long one, so sit back and enjoy. Just know before we dive in, take a look at that progress bar. It's going to be well over an hour. Why so long? Because this recording is coming directly from your questions, DMs I've been getting, and comments over these episodes. You didn't want sound bites. You wanted deep dives into the GameStop, the $39 trillion debt that's over 160 trillion to service, the SAS Apocalypse mechanics. You also asked some questions such as, Marcus, you put a lot of stuff on here, but where do I even start with investing? Where do I start? You want to know, what do I think of the current markets? How can I use AI? How do I use AI? Maybe how do I AI proof some of my things that I do? I got a cool story to tell you about Jamaica. Trump accounts, that's been a big question here lately. And then I want to share some investment filters that I use. There are plenty of them and plenty more that even I use myself, but just some general ones that people can take a look at before they decide to invest in anything. So before we dive in, I just want to give a huge thank you to over 1,300 people who've joined the Wall Street South Journal this quarter alone. Special shout out to all the people who listen to the podcast. I know we have a lot of people over in Asia, Japan, Vietnam. We got a growing audience over in Jordan as well. Argentina, thank you for the people who are tuning in. Really appreciate it. Like I said, this is going to be, a little bit longer. So we're going to take a little bit of time, sit back and just talk, because there's a lot going on. So people are asking, why don't we just print more money to fix the debt? That was an actual question from my daughter. As of this morning, like I said, the debt's sitting somewhere around $39 trillion. And we're adding over $1 trillion. Right over 100 days, we're adding $1 trillion. Every dollar printed is a direct withdrawal from your family's purchasing power, right? So this is, every time money comes out, your dollar gets weaker. So every time a dollar comes out, it makes your family's purchasing power weaker, like I said. We're watching a total decoupling. Gas is pushing, $4.50 nationally. Like I said, because the Strait of Hormuz is closed. And then once again, we just look back at Ryan Cohen and his bid for eBay. I mean, he's selling his socks on there. Is he use it? So if you're using the 1990s playbook in this world today, you're being liquidated. You're being liquidated. Your purchasing power is being depleted as we speak. And once again, it's May, so the stakes are just as high on the court. Depending on what time you listen to this, the Detroit Pistons and OKC Thunders, they're both heading to their game threes, and both may be heading to their game. Yeah, they're heading to game threes, and both may have a 3-0 lead, looking to put their opponents on life support. The Knicks took a 3-0 stranglehold on Philly, and Wemby dropped 39 points in double-double to put the Spurs up 2-1 in the playoffs. You don't get a second chance to fix a bad rotation, like I said, and the same is true for your money. So this is the playoff edition. Playoff edition is about the logic of the ledger. We're moving past the dating phase of the SAS Apocalypse, or better, and into the marriage reality. Whether you're a new grad who's out here facing the challenge with the SAS Apocalypse, or a veteran investor watching a Mo Green power play, I'm giving you the filters I use. So, like I said, some of the filters, but not everything, but some of the things that you can look at. There will be actionable steps that you can take in this video. Sit back and enjoy, take some time. We thank you for watching. And then once again, just thanks to all the people, Japan, South Korea, Argentina growing, all the people listening, all the people watching. There's a lot of people over on LinkedIn who take time to watch these things as well. So let's jump in. Let's think about the GameStop. How does a $12 billion company with GameStop put in a bid for like $50 billion for each? And then I don't know if anyone saw GameStop CEO Ryan Cohen. He had a viral interview on CNBC the other day where the question was, how are you going to fund this investment? His answer was, half cash, half stocks. They wanted him to get into the numbers since this company is only valued at 10 to 15 billion. We'll go high on the high side. We'll say 15 billion with the stocks and everything. Then he got $20 billion letter, I think from TD Bank, that said they would front that cash to go into a deal, or a confidence letter saying that they would front that cash if they could get the rest of the deal together. But that still leaves a massive gap from the bid that he made, right? So the question was, how is he going to fund it? His response then, and he's updated his response since then, but his response at the time was, look at the website. And then he also said, half cash, half stocks. So let's just think about it. And this goes back to why we just don't print money. Half cash, half stocks. Okay, so let's pretend that, let's just go with that half stocks. Okay, so in order to get to that number with the stocks, he would have to, one scenario would be where he would have to create more stocks. but you only have so much value of a stock. So if you create more stock, it's kind of like a stock split. But it wouldn't be a stock split, but it's kind of like a stock split where one share would still have the same amount of value. It'd just be split into whatever denomination of stock, say it is 1 for 10, whatever it may be, 10 for 1, however it may be. So if you already own this stock at, say, $100, and then the GameStop's not $100 right now, by the way. And once again, these are not investment advice. This is a scenario. Everybody's investment situation is different. But say you are an investor in GameStop. I actually think GameStop was $20 to $30 range right now. Yeah, the GameStop from the meme rush back in the day. Say you're investing in GameStop, but let's say the stock's $100 for math purposes. For simple math folks like me. It's $100, but say Cohen needs to increase his cash to double it from the shares. So he issues twice as many stocks. That $100 worth of stock just mathematically would be worth $50 because it would be cut in half, so it would be diluted that much. But actually, it would probably be even less than that because if shareholders and the markets and investors see that you are diluting the stock for no apparently good reason, they're losing value. The eBay people might not appreciate the value that you're pledging with these stocks because they're going to be diluted. And at that point, you could actually lose more than half the value because the stock could go down lower. Stock could go up. Maybe he's making some kind of master play and the stock goes up. But that goes the same way. That's the same thing when you are using your home budget and dollars. You can't just print more dollars because for every dollar you print, you essentially are diluting the dollars that you have already, right? Or they're having less purchasing power, which is coming also from inflation and purchasing power raises not keeping up with the rate of inflation. We all see what's going on in the Strait of Hormuz right now with the oil and the gas prices people are paying right now, over $4.50 nationally. I think in California it's pushing close to $7. And what you have to understand is those are things that are going to take a little bit of time to come back down. I don't know if we'll see that $60 a barrel oil that we saw earlier this year. Oil goes up like a rocket ship, but it comes down like an escalator. So it's going to take time for those prices to come back down. Back to your family's budget sheet, right? So here you are, and they've diluted your dollar down, your dollars by less, right? That's why you don't want to print more dollars. And that's high level, right? That's really high level. There's so many more reasons why you don't want to just start printing dollars, right? Other than the dollar just losing value or actually being diluted, from your self-diluting. I guess the government's actually doing it if they're the ones printing the dollars. But you don't want to just increase dollars. You may want to increase cash levels. That's where the Fed comes in. They come in, they can raise some of the requirements for banks that banks have to hold, or they can change something that interest rates. So that kind of can help with money supply. If it costs more to borrow money, people in theory will borrow less money. And when interest rates go down and money is quote unquote cheap, people will borrow more money. So bad to GameStop. I was talking about Mo Green earlier. So I don't know if anyone's ever seen the movie The Godfather. It's a good movie. It's very interesting. It's some great scenes. People of nowadays you see a lot of stuff now that was from The Godfather or the first, second, or the third one. You don't even realize it's from the movie. But that stuff is from other stuff as well. Like these are old quotes. Everything's reused. Anyway, there's a scene in there, spoiler alert for anyone who hasn't seen The Godfather. So maybe take a second. But it is from like 1972, I think. But from anyone, so anyway, Michael Corleone, Al Pacino's Michael Corleone, he goes to Las Vegas. It's the 50s, maybe 40s or 50s. He goes to Las Vegas to a man named Mo Green. Mo Green is the head of Las Vegas. He's built it up out there. He goes in there, tells Mo Green basically that he wants to buy him out. That's what he said. How much would it cost for me to buy you out? That's what he said to Mo Green. Mo Green got extremely upset, to say the least. To put it mightily, he got extremely upset. So he said, The Godfather, he yells, "You don't buy me out, I'll buy you out." Excuse the accent. I shouldn't even done that, but that's just kind of the way he said it, right? You don't buy me out, I'll buy you out. I'm Mo Green, and I'm paraphrasing here, but he said something he was making his bones doing what he was doing back when Michael Corleone was in high school dating cheerleaders. He was just saying he's been doing it for a long time, right? So maybe eBay is Mo Green. I'm not going to tell you more about how it ends for this movie, so that's the spoiler parts I already wrote. That goes. Maybe eBay, old established player, is Mo Green, right? And maybe, although Michael Corleone did not want Mo Green to buy him out, maybe Ryan Cohen's playing some type of long game where he wants eBay to buy him out. Because he was in the interview when he was talking, he was speaking about their fiduciary duty, right? He said, when you make an offer like this, the board has to look at this duty. And the person interviewing him, I think it was maybe Andrew Ross Sorkin or Becky Quick, one of them. It was on CNBC early in the morning. They asked him if he would take an offer from eBay to buy out his company, GameStop, because eBay is worth a lot more stock-wise, purchase-wise. Think about all this stuff, eBay's and eBay's actually had a pretty good year, had a pretty good run returning stock-wise. Once again, not making stock recommendations, just talking about situations where we are in the world right now and just a comparison. Once again, this ties back to you, Main Street, back to our dollars, back to how they work. But so yeah, eBay, like I said, probably doesn't want to buy GameStop. I don't even know if Ryan Cohen wants him to buy GameStop, but when he makes that offer, or even when they put that in the media, that's also another thing. Like, just when they say that kind of like that out loud in the media, that board kind of has to listen, right? Because that's kind of like an offer, maybe not an official offer, maybe not a hard offer. You just saw this play out with Paramount. Another thing with offers, like, so there are several things that, and I got to digress a little bit, but
Talking about money is very difficult, and we are typically not taught how to do that growing up in our formative years. We adopt strategies that we saw growing up that we ourselves that have been useful or helpful for us. It is designed to help us stay safe. Sometimes the starting point is just sitting down and talking about, what does money mean to you? How does it feel to talk about money? That might actually be, for some, enough of a conversation and being able to tolerate that. What does sitting down and talk about money feel? One partner might say, well, this feels really uncomfortable, or I feel really anxious.
And communication is so key. And we just keep coming back to communication and education in this situation. Let's do so. Main Street meets Wall Street. We want to talk about like real life scenarios, real situations. Let's take a scenario maybe here in the world. Young couple, young 30s, getting starting a family. They are completely on opposite ends of the spectrum when it comes to money, right? They may go sit down and talk to a financial advisor or a person in an hourly situation, do Dave Ramsey's program, something to that effect, get the advice, go home and change exactly nothing. Where do they actually begin?
Yeah, so talking about money is very difficult, and we are typically not taught how to do that growing up in our formative years. Adopt strategies that we saw growing up that we ourselves maybe that have been useful or helpful for us, going back to helping our brains, it is designed to help us stay safe. That's the entire purpose for our brain, is to help us stay safe. And so when we look at where couples start, sometimes the starting point is just sitting down and talking about, what does money mean to you? Or how does it feel to talk about money? That might actually be, for some, enough of a conversation, right? And being able to tolerate that. What does sitting down and talk about money feel? One partner might say, well, this feels really uncomfortable, or I feel really anxious. Or one partner, like my husband, when we first started, wanted to talk all about it and show me all the spreadsheets and was so excited to walk through all of it. And for myself, it was very overwhelming. Not because I couldn't understand, but because, having a response to something, numbers don't lie, right? And numbers, they're numbers, right? You can't argue with numbers. That's what I was taught. You can't argue with numbers. It's a number, right? It's fact. But having just kind of my own response, just sitting down and seeing all that can be overwhelming. So for couples, sometimes just talking about, hey, what is it like to talk about money might be a great starting place. So I encourage couples, though, to schedule regular money dates and to have regular conversations. Treat it like a meeting, like you would maybe with work. So for Clayton and I, and where I, have seen a lot of success for other couples, particularly those where one or both partners is a professional, is schedule them during the day. Schedule them during the work day, if you can. And treat it almost kind of like that. And the reason I say this is because the last thing that any of us want to do at night is to talk about money, a potentially, conversation that could lead to friction. My brain is fried. I don't
I don't want to engage in that. I just want to zone out, watch, trashy TV so that I feel good about myself. Like that's my capacity at the end of the day. As it is, I think, for a lot of younger couples, is particularly those who are raising families. So treat your money date like a working meeting, right? Schedule it if you can during like business hours. Put a time limit on it. This doesn't have to go on forever. Even just 15 to 20 minutes is better than nothing. And what I think is important here is, talking about the numbers, talking about some type of numbers, but also talking about the emotions and the thoughts around it. And what I mean by that is, if we're talking about, let's just say, saving for a vacation, you can talk about the numbers and one partner might say like, okay, well, if we're going to save for a vacation, we probably need to be cutting back on these like expenses, right? Sometimes where that conversation can go. Or if we're going to save for a vacation, we want to allocate like this amount to it like every month. But the other side of that is, how do we want to feel on vacation? Do we want to be able to, feel relaxed while we're spending on vacation? Do we want to maybe go on a vacation like a sandals resort where you pay everything up front and then while you're there, you don't have to think about anything because spending money on vacation causes a lot of stress?
Yeah, sandals.
Yeah, right. Yeah. Or a cruise, right? Like once you get there, you're kind of there. So how do we want to feel on vacation when it comes to money? Do we want to feel relaxed? What's the impact of that? So I think talking about, both the technical side, but also the emotional, relational side is equally as important when we're having these money dates.
Yeah, money dates. I don't think I've heard anyone put it or describe it as that, and especially having them like in the middle of the day. That's very interesting. So you mentioned having hard conversations, and we're in the world right now, current events, people are getting married. We're seeing celebrities getting married. Taylor Swift and Travis Kelce just got married, and the talk has been something, if you guys cited, something with a prenup. How would someone, this is going out through LinkedIn and other professional networks, so people may have a need for something like a prenup. How would they bridge a conversation like that?
Yeah, I think prenups get a bad rap. I think that they have, and probably still are, just viewed as dooming a relationship to end, is what I hear a lot of clients say. And this is coming from maybe clients who grew up in family systems where a prenup was not like standard practice. So there are certainly families, particularly if you're looking at the high net worth, ultra high net worth space where like prenups are like, I say standard practice, but like they're part of it. Like those families know like, yeah, you guys can go into this relationship, but prenups will be signed. Like it's common, I guess I could say, within those family systems. But, for others, like, especially if you didn't grow up in that, it can feel like, my gosh, you're, trying to say that our relationship is doomed and that's going to end. There's a lot of emotion behind it. I think there's some mislabeling there. So talking about prenups is, I think we need to understand first going into that conversation that everyone has their own feelings around it. And while the idea behind a prenup is to, by and large, keep both parties protected, to keep both parties safe, to keep also the assets, the wealth protected, we all have different responses to that. And so it needs to be handled delicately and sensitively. So some of where, I see this come into play might be with parents and their adult children, and they will want their adult child to have a prenup. And, maybe that adult child is like, oh, like, we don't need that. She's never going to take me for everything that I've got. We're never divorcing. That might be true. And no, I'm speaking with some sarcasm here, but that might be true. But that's like what I hear, right? In terms of a response. I think for parents, the conversation needs to start before the actual engagement like happens. So if this is something that you and your partner have maybe potentially an interest in, or maybe for a fact, like, I'm going to want my kids to sign a prenup. Those conversations need to start before, in this scenario, your son asks someone to marry them. And starting those conversations early sets expectations, but it also allows the opportunity then for your adult child to, decide and make certain choices, and also for you to make certain choices too. I think that prenups can be really wonderful when done right, but I've also seen them cause a lot of harm. And typically that's in families where the conversations have not been handled well. There's been a lot of fear around it, around having the conversation. There's not been enough upfront education, um, or communication around it. So I could talk a lot, Marcus. So I know I'm keep going on and
Keep
on
going.
about it. But I think that, by and large, I think prenups can be incredibly helpful. If you find yourself in a position where it's like, well, we didn't do enough kind of on the front end of talking about prenups, find a professional that can help facilitate a conversation. And there are those professionals out there who do help facilitate conversations and provide education around what a prenup is for both parties. If I'm talking heterosexual couples here. So if you're looking at, let's just say your adult son and his soon to be bride, like, gift them a, meeting with someone who can just help educate them and understand what a prenup is. And maybe that will dispel some of the myths that maybe they have. Or maybe it will just further flesh out things that they want to be or go in the prenup, or to ask questions. So, for parents, I think bringing in a professional is a great way to go. Because one, it removes you from the position of, okay, all of this information is coming from, in this scenario, like my future in-laws. How can I trust them? They don't have my best interest, at play. But bringing in a professional then allows that person to ask questions to make sure that they are also protected as well.
That's pretty good answer. And I don't think many people actually think about prenups in that way as a useful tool. They just, like you say, hear the word prenup, and then they're just like, they just think they're planning for us to fail. Like 50% of marriages end in divorce. And you want to, be prepared for whatever you may obtain in your marriage. What are some of the best uses you've seen for prenups?
Best uses.
Outside just, like your common everyday, you keep this, you keep that.
Yeah. I think when I've seen them go well, some of the best uses, and this is a pre or post nup,
Yeah.
is that it opens up dialogue and communication about money, which is a very taboo subject in and of itself. It's hard to talk about. It's not easy. And so I think, sometimes prenups or postnups, they really force that conversation. They can be the thing that forces us to talk about, like, we got to talk about money now. Okay, here we are. And so when they're done well, it really can be a benefit to just learning how do we talk about money? What does money mean to each of us? What does security look like for each of us and mean? And so I think that can be truly one of those, unexpected side benefits, is that it really does and can bring a couple together in talking about a really hard subject matter.
Yeah. And what are some of the worst examples, like cases you've seen with like a prenup?
Oh gosh, how much time do we have, Marcus? I feel like we
Expand.
all know like the worst examples and how they've played out, and that's where, albeit the evil in-laws, like, kind of force this or put things in a prenup that the couple wasn't aware of, or have left one spouse high and dry. I think, somewhat kind of jokes aside, where I see harm kind of being done is in a coupleship where, and I'll say for heterosexual couples where the female partner was taking care, maybe home, taking care of kids, gave up a career, gave up a job, gave up, really the ability for her to build her own, path. I have seen then where, prenups can, I'm going to say it this way, it's probably not PG, but screw that person over, essentially leave them high and dry. And so that I think is not okay. And I've seen where then that female part is very resentful, I married this person. I trusted this. I trusted this, arrangement and how we had things. And then now, like, I'm left with nothing. And some of that might in part be because in this scenario, maybe the female partner didn't really understand everything that was in the prenup. They didn't fully, or maybe they did fully kind of trust like their partner or those that were advising them. They didn't ask their own questions. And, truly like no judgment. But that's where I see that things can get really bad. Again, that's why I advocate for bringing in like a professional to do some education and for both partners to have an advocate in it, someone that is helping them think through like all the possible scenarios. So on the front end, like, hey, what if you guys have children and one of you wants to stay home? Like, how do you guys want to do that? How do you want to set things up? So, being able to look at what are the worst possible like fears, if you're doing this on the front end, I know I'm deviating a little bit, doing this on the front end, thinking through what are the worst possible fears? And then how do we talk through and talk around that? I think can be immensely helpful in making sure that some of those worst things don't end up ultimately happening.
Great explanation. And I really don't have a chance to have conversations about prenups, and we weren't even going to go deep into this. I kind of threw the prenups on actually, the fun of live, but it seems like something that you enjoy speaking on. So if you don't mind, we can talk about it just a little bit more. So with prenups, you mentioned the prenup, and then you mentioned the post-nuptial agreement, right? So I think in general, prenups before you get married, post-nuptial, you can do that while you're married or even after you get married or after you get divorced, correct? Do you want to explain a little bit more into those?
So I'm probably not the best at explaining the divorce piece. I do know like while you're married.
Talk about why you're married then.
Yes, while you're married, you can. So this might come into play if a partner, and I've worked with clients in this capacity where they've received like a sudden windfall, or maybe particularly like an inheritance. So, one partner receives an inheritance from their parents. Maybe it was unexpected, and maybe as part of receiving that inheritance, they want a post-nup put in place, and that can be really tricky.
Yeah.
It can bring up a lot there, but that is probably where I like more commonly see them is when there's some sort of, inheritance or sudden windfall that's come into play after the fact, after a couple is married and they want to put things in place legally in the form of a postnuptial.
Got you. And you speak about once people are married and windfalls and generations of wealth being passed along. Do you think you mentioned bringing in professionals to have conversations with couples? Do you see you see couples bring in like multi-generations to have the professional come in and talk them through the prenup? That's one of the best ways you would approach that.
Yeah, absolutely. I'm of the mindset that the more the merrier, to some degree, right? But really trying to communicate across generations can be immensely helpful. One from just an awareness place, but also like an education. And modeling like, hey, like we talk about money in this family. Like money is not taboo. It's not like a secret. Like we talk about it. And this is how we talk about it. And it really allows like families, especially those of older generations, to start to model how we go about talking about money. But more than money, like how do we talk about security and freedom? How do we talk about legacy? How do we talk about relationships? How do we talk about philanthropy and giving? All of those things that come into play.
Right. And what we've seen now, and we're in the middle of one of the greatest generational and just wealth transfers in history. It's great to have a woman on here, because there's not a lot of women in the finance industry. Or I should say not enough. There are plenty smart, talented women in this industry, but they're not enough that are being seen. You may come across, or a husband passes away and the wife has no sense of what's going on, like financially. How do you approach that? Do you get in front of that? And then if you're not ahead of it and it happens, how do you approach it? Like if you just come into the back end of it.
Yeah, I think if you have the ability to be proactive, to say, hey, we as a advisory team, we have a couple where the male partner, and this is stereotypically like what happens, the male partner is very engaged. He's the only one that really shows up or participates. Like the female spouse, don't really know much about her. She's got like a few small accounts, but other than that, like don't really know anything about her. There's an opportunity to be proactive and engage that unengaged spouse more thoughtfully And there are a lot of strategies for doing that, where a lot of them boil down to is just getting to know her on a human level, connecting with her, finding out more about who she is. If she likes horses, right? Asking her, hey, sending her an email. Did you see the Kentucky Derby? Who are you cheering for? Right? Just trying to kind of, have frequent enough touch points with her. And then inviting her into a conversation of, hey, we're talking about retirement here. And I know your husband, John handles kind of everything, and that's okay. But we're talking about kind of this one piece, and I just would love to hear your thoughts. Would you be willing to jump on a call with me? As an advisory team, I think that there's a way to strategically be proactive to helping to connect with that unengaged spouse, unengaged partner. And when you do that well, when you can do that well, you earn that partner's trust, and they learn like, okay, well, even if I don't know a lot about money, I know that Marcus cares about me, and I know that he is willing to help me, right? And so when John passes, then it's, well, I really don't know all about this money stuff, but I know John worked with Marcus for a long time, and Marcus, I didn't go to all the meetings, but Marcus always checked in on me around Kentucky Derby season. And, he always asked me at least like once a year, like, what vacations I wanted to save for, spend money on, and, asked me to send him pictures. Like that really speaks to clients, right? In a way of, I can trust this person, like they're there for me, I can count on them. And they're more likely to stick with you as an advisor. So being proactive is, by and large, like my preference is, how can we be proactive like as quickly as possible? Now, the second part of that is, well, what if you've not been able to, and there's a widow that like you're working with, and you want to continue the relationship? I think that there are a lot of ways to continue that. First, just educating yourself on the grieving process and widowhood. What does it look like? Because the education is helpful. What you will find in and within that is that it can look different for every person. But getting some basic education around, grief and, widowhood and how to engage with a client. Kathy Balasek, a dear friend of mine, is fantastic with grief literacy and education, at least for advisors. But, understanding what is this client going through and how do I need to approach conversations? Hopefully my hope would be is initially putting aside first the goal of retaining assets. My hope would be is that we've put that aside and that we're putting the person first and foremost and making sure that we can be helpful with helping them with any and all of the financial matters that need to be helped with. So, be proactive if we can in engaging those partners, but if we can't, meet them where they are in that human place, educate yourself on grief and widowhood, and focus first on connecting with them as a human in those early stages and those early places.
There you go. Proactivity. I don't know if that's the word. Being proactive is a good way of going about it.
Yeah.
I saw a stat or a headline yesterday that really threw me off, man. This generation is different, this younger generation. And it said that nearly 50% of adults under 30 live with their parents last year at some point, up from 32%. How are you having those conversations with adults and with their parents? Because what we're seeing now is kind of like a prodigal son type thing where parents are also giving their children their inheritance early. I don't know if they're coming back and getting more later, but they're going into their retirements. I've seen, and these are not just case studies. I'm talking about parents having to go back to work just support their children. How are you having these conversations? That seems to be something hard to break because I know with parents and children, it's a hard subject to break.
It is. Yeah. I mean, first, just validating that this is incredibly difficult. It's not what you planned for. And, I'll say there's a grief element to that, I'm sure, right? That many parents, I try to put myself in their shoes, there would be some grief in that. And not that it's maybe the child or adult child's fault, but just hey, this wasn't what we planned for. This wasn't how this was supposed to go. And I think it's important to own that and just say this sucks. We didn't plan for this. We didn't want this. And there's some grief here. And acknowledging really that part first on both sides for the parents, but also the adult children of this kind of stinks. I think that where parents can really be of service to their adult kids is going back to connecting them with a professional. Connect them with a financial professional. Maybe it's your advisor. I know a lot of advisors now who are doing like young adult education or supporting them in that place of, hey, you've got your first job. Hey, let me like kind of help get you started on mapping out like a few things of where you could be. There are accredited financial counselors that you could connect your adult child to, but having them connect with a professional that can be another source of information, maybe even an accountability partner, or just someone to lean on and ask questions about can be a gift. Can be a gift to them. And so I would start that like early on, even maybe while they're in college, maybe last like year or two of college, is connecting them with, some type of financial counselor, financial professional that can help them start to lay the groundwork for, hey, when you graduate, here might be some folks, right, that you can reach out or that can help set you up for when you do leave. I just had a conversation recording for my podcast, Planning and Beyond, with Colby Goodman, right before Marcus, you and I jumped on here. And he is a career coach. And so we're starting to see this a lot more too, is connecting adult children or even professionals working with career coaches, but connect them with a career coach, like somebody like a Colby who can help develop some skills for going out and being successful. Going back to what we talked about at the very beginning about figuring out things that you can control. As parents, what really, really stinks is that, and I've realized this the older like my kids have gotten, is that I have less control over them. And
You haven't really had any control.
I know. But I used to think that I used to have like a lot more of it. And I don't really like that, but it is true. And so knowing that we really can't control like our kids, especially as they grow to be young adults, but what we can control is maybe offering opportunities for them to meet with professionals that could help set them up for success, or, set them up in such a way to where maybe they don't come back. Maybe they don't come back home, or maybe the plan is for them to live in your home for a set period of time to build up enough savings for a down payment. Or as a parent, if you're looking at how do I help my adult kids? Maybe it's instead of paying like $1 bajillion for a Taylor Swift, Travis Kelce wedding, maybe it's saying, hey, we will actually gift you this money as a down payment for a home. With housing prices being what they are, like cost of that might be much better, right? Than, getting married in Madison Square Garden, having the Empire State Building light up. I don't know, maybe not. But I think that there's a lot of thoughtful ways that parents in particular can start to look at helping set their kids up for success, albeit bringing in a professional or, again, down payment like on a home. And you can talk to your advisor about that. Like they are likely a wonderful resource to be able to have those conversations with.
Very good, very good. And once again, I love all the resources you're mentioning from Colby to just different people that you can reach out to and things to find out. Education is a very powerful tool. So we're talking about, the parents. Let's go down to like a generation below, like kind of in our generation, because now we have this sandwich generation where our parents are getting older. We're having to take care of our parents, but we're also having to raise families. And it's not a new phenomenon. We're not the first people to have this happen, but we have the internet. We have ways to put it out and create terms. How would someone in this sandwich generation, approach this for their financial planning? Just from how do you approach that? Because you deal with the psychological and the financial piece.
Yeah, you're throwing out all the great hard questions. I mean, how do you deal with it? I don't know. Like, I don't have there's not a framework, at least that I'm familiar with. There's not a framework or book that says, if you do it this way, this is what's going to work for you, your family, and your parents. If you're married, like you might be looking at taking care of both sets of parents.
Yeah.
And like with grandparents as well. So my grandfather is 91 years old and still lives independently, like in his home, in his house that he's been in he moved there when I was 10. So like 30 years now. So you might not just be looking at your parents. It might also be participating in taking care of your grandparents as well. So, it could be multi-generations. How do you deal with it? I think first and foremost, if you're married, this needs to be a topic of conversation with your partner. And it has to be something that you talk about. Like, hey, what are we able to do first and foremost from a financial standpoint? Like, what are we able to contribute? And it may not just be financial. It might also be time, might be, mental, might be emotional. I think that there's an opportunity here in looking at if you've not had conversations with your parents. So I'm thinking like our generation, Marcus, like, the peanut butter jelly in the sandwich. If we're looking at that, like, how can we start to have conversations with our parents? What information do we need to know? Like, what policies do they have in place? What does their insurance coverage look like? What type of estate planning have they done? Are there any holes there? What are things that you need to know that would be helpful? What's their long-term care plan?